So guys, we are done with our time value of money concepts. Now next aspect we will discuss is in this section B we are going to start, sir. In that, if security valuation is what we are going to do. So that security valuation, even though it looks very small, it is basically two different chapters again. One is a concept called as bond valuations. Then there is a concept called as equity shares valuation. How to identify the worth of a bond, how to identify the worth of a equity share. This itself is two different chapters actually. After doing these two, probably we will be doing mutual funds, and once mutual funds is over, we will hit the main chapter which is called as portfolio management. These three chapters put together are called as portfolio management. Last one, efficient market hypothesis, small technical analysis case, that we will see towards the end. That's easy only. So all in all, if you check the weightage, 35%. If you carefully listen to the concepts, practice the questions, 35 marks is like you already have it even before going to the exam. It will be that simple, but conceptually it should be good. Okay, anyway, without any further ado, we'll start off, sir. We'll start now with our discussion on bonds. So under security valuation, you have equity and bonds. In that, presently we are starting bond valuation. Actually, bond valuation is such a big chapter, like the concepts, there is no end. It's like very, very huge chapter. But luckily for you, in our syllabus, the content that is there, the coverage that is there is not vast, it is limited. So that makes this chapter a little more bearable actually than what actually it is. Anyway, now you tell me, sir, what is the meaning of a word bond? What is the meaning of the word bond? Bond basically is nothing but, sir, do you know the word debenture? Tell me what is the meaning of debenture? It's a debt instrument issued by the entity for raising money. Just like how company takes loan from a bank, which we call it as a term loan, like that, if company takes loan from various people by issuing instruments like equity shares, these instruments, they don't give them ownership, they give them a right to claim the money back along with interest. The debt instrument, that security, is called as a debenture, and a debenture a bond. Technically, there is no difference between debenture and bond. When we say bond valuation, we are talking about debentures ka valuation. Now, next point. Sir, when debenture and bond both are same, why to call it as bond valuation? Let's call it as debenture valuation only. Call it, no problem. Only one small difference is there, sir. Now, debt instruments issued by company for raising funds. Debt instruments issued by the company for raising funds called as debentures if issuer entity is a company, and they are called usually as bonds if issuer entity is government or public sector undertaking. This is for general understanding I am telling you, sir, but as such these terms are used interchangeably. These terms are used interchangeably. There is no fixed rule and also the general understanding I am telling you, but as such in the questions you will see the word debenture also, you will see the word bond also interchangeably, we can happily use of. There is no problem in that. Now come here, sir. Imagine this is balance sheet of a company XYZ Limited. XYZ Limited wants money. So what they have done, they have taken money from a bank, 12% term loan from ICICI Bank. Some 100 crores they have taken. Now, in a term loan, typically what will happen is the company has to pay interest every year, and one day they have to also repay the principal amount, correct? So who lent money? ICICI Bank. So the investor is only one person called as ICICI, the lender, and you are the borrower. Our company is the borrower. Investor is who? Single party called ICICI Bank. This is one borrowing. Look at another borrowing now. In another borrowing, the company issued %10 debentures and raised 300 crores. Now 10% debentures the company has issued a security, and some people have invested money in this. Now who are these people? Let's see here. These people are investors who wants to earn some interest income from the company. So they supplied money to the company and company gave them debentures. Investors of debentures or bonds. Now, company raised money. If you take one fellow and zoom in, bond or debenture, and in this debenture what will be written is they will identify something called as face value or par value of the bond. Let's say in my example it is 100. It can be 100, it can be 10 rupees, it can be 1000, 10,000, 1 lakh, it can be anything, sir. That's company's wish. And along with the face value, they will identify something called as coupon rate, which is also called as interest rate. But careful, sir, don't use the word interest rate, call it as coupon rate only, because interest rate is generally supposed to mean the running interest rate in the market. Coupon rate is supposed to mean the interest rate that is fixed in the contract between investor and the company. So both are interest rate only. So to differentiate, we are calling this as coupon. Interest rate means general interest rate in the market. So coupon rate is, let's say, 10%. Maturity 5 years. Randomly I'm writing some numbers, okay? What is the meaning of this? What is the meaning of this? The meaning of what we have written is the bond is redeemable at 5 years or at 5th year. Each year coupon amount they will pay. How much coupon amount they will pay? 10%. 10% you have to apply on what? Face value or par value, that into coupon rate. So in our example, that is 100 into 10%, which is equal to 10 rupees. Now, at the end of 5th year, the bond can be redeemed at par or premium or discount. That depends on the agreement between the company and the investors. If the company says they'll redeem at par, they'll redeem at par. Premium, discount, it's all matter of agreement between both the parties. Here one note point what you have to remember is, if question is silent, what will you assume? Obviously you don't have a choice, no sir. If you assume that it is redeemable at premium, how much premium? You do not know. If you assume that it's redeemable at discount, you don't know how much is the discount as well. So you don't have a choice basically. The question is silent. Assume bonds are redeemable at par value. Par value, face value, nominal value, all are same. They are all different names. Par value, nominal value, face value, they are all the same. Right? Next. Now sir, general question. This investor with a lot of josh, he paid money to the company, purchased one bond, and nicely he is receiving interest. 1 year he received, 2 years he received. 3rd year, sir, this fellow is in urgent need of money. He went to this company, told company, I gave you money, you owe me money, take this bond, pay back my money. Will the company pay? What will the company say? Ray, come here. What is the maturity period? 5 years. So you can't ask repayment before that date. So you have given me money, I will give you definitely after 5th year, not before that. So but this fellow is in urgent need of money. How will he get? Company will not give. Next. Another case. The company issued the bonds. The offer was open for a period of 15 days. Whoever applied, they got allotment. They all became bond holders of this company. You were sleeping at that time. You got up. You saw, wow, fantastic interest rate. I also should invest. You went. That fellow says, sir, issue date is over. We already issued, allotted also. Issue is closed. We can't give you. Your ego got hurt. How can you say no to me? I'll pay extra, give me a bond. Take money, I'm giving you money. Take, buy whatever you want. Give me one bond. Company says no. I issued bonds, offer was open for some time. You did not come at that time. Now I will not offer any bonds to you. That means existing investor cannot get out if he wants to sell the bond. New investor cannot enter. Correct? So there is a problem of liquidity now. A liquidity problem, how they will solve is, they will get these bonds listed on stock exchange. After the bonds are issued, bonds are listed on stock exchange. Now here, this company issuing bond to the investors for the first time, this is called as primary market. This entire thing, whatever we are studying, we are discussing till now, this is referred as primary market. In primary market, what happens? Company issues security, let it be share, let it be bond, directly to investors. And investor is also buying bond from whom? From the company. Correct? This is primary market. Now, to create liquidity, issuer entity may list the bonds on stock exchange. What will happen if you list the bonds on stock exchange? It creates a market now. And thus provides liquidity. What is the meaning of the word liquidity? Ability to convert anything into cash. An existing investor who wants his money back, he can't go to the company and ask money, but he can sell this bond to Some other investor. So who will pay money to him? Some other new investor will pay money to him. He will exit. Our place, this fellow will go and sit, the new guy. Are you getting it, sir? Company will pay interest to whoever is the owner of the bond, not to the same person who purchased it on the first day. Whoever is the owner of the bond, that fellow will get the interest on the due dates. Right? So this creates a liquidity. Sir, in secondary market, stock exchange and all is nothing but it's second hand market, sir. You want to buy a car, you can buy in two places. One, directly from the showroom, the primary market, or from some other existing owner of the car. This is called a second hand market. The secondary market is that. Primary market means directly from the issuer, first time when you buy, no, that is called as primary market. Once already company issued, I issued securities trading in the market stock exchange, you go and try to buy that, that is called as secondary market. Clear, sir? Now, in this chapter, predominantly we will think from investor's point of view. Say 99% of the questions are from investor angle, not from company's angle. So tell me, bond is an asset or liability? It depends on for whom. For the company it is a liability, for the investor it is an asset. Now, the entire chapter is constructed in such a way that we do most of the analysis from investor point of view. Of course, company also we will analyze, but mostly it will be from investor's angle. Okay, next. So what is the meaning of bond valuation? Bond valuation is nothing but determining the fair value of the bond. You identifying the fair value of the bond is called as bond valuation. Sir, what is the meaning of fair value? It is the ideal price at which investor should buy the bond to earn his required return. So in order to earn his desired rate of return, how much should he pay ideally? That is called as fair value. Also called as intrinsic value, equilibrium value, theoretical value, that's all. These are the names of bond value. So if the question asks you intrinsic value, theoretical value, fair value, everything is same. All you have to do is apply one small formula and get the value of the bond. That's it. Now, coming to what is that logic? How to compute the fair value of the bond? Very simple. Fair value of the bond is nothing but take the present value of future cash inflows. What are the future cash inflows from the bond? PV of, tell me sir, bond gives you what cash flows? Coupons, that is present value of coupons plus towards the end of the period you will get redeemable value also, that we call it as maturity value. Present value of maturity amount or redeemable value. Now whenever you use the word present value, you are duty bound to ask me and think for yourself also what discounting rate I should use. Discounted at, make no mistake, let it be capital budgeting, let it be derivatives, let it be bonds, let it be shares, let it be business valuation, let it be any valuation. From an investor angle, if you are doing by default fix off, your discounting rate is required return. Your discounting rate is nothing but required return. On the other class, when we were discussing NPV concept, who was making investment in the machinery? Company was making a, investor is making a, company, not equity shareholder. No, equity shareholder invested money in company. Company is trying to buy the machine. So who was doing the project evaluation? Company. So company point of view required return. Here, who is buying bond? Investor. Investor point of view required return. Whoever is putting money, that fellow I will ask, Babu, how much required return do you want? I want 80%. Sir. Not like that. A required return ki one calculation is there. Simply wishful thinking is not required return. Required return ki logic is there. If you take some stupid dummy number, how will you get fair value? A required return also some logic should be there. So the ideal correct required return of the investor must always be used as discounting rate in order to obtain the fair value of the bond. Clear? Now, so which means it is something like this. Imagine, sir, you are having cash flows like this. There is a coupon amount here, there is a coupon amount here, coupon amount here, coupon amount here, plus you are also having a maturity value. Your goal is to work out the fair value of the bond. Based on the above discussion, what is the answer? It's present value of all your future cash flows. That means I have to discount what all, you tell me? I have to discount present value of all these 4 coupons. I have to also discount the maturity value also. That means the entire coupons ka present value and the maturity ka present value. So let me write like this. Is it correct? Now next question is what? What is the discounting rate? That already be identified. Discounted at what rate? Required return of the investor. Now, the pictorial formats just to make you understand where the cash flows are, where you are dragging it and all. Formula model if I write, it will become even more cheap. Look at this. Fair value of the bond is equal to coupon. How many coupons are there? 4 coupons. Every year interest amount is same, no? Therefore, there is an annuity cash flow only. Since that is an annuity cash flow, take one annuity cash flow and multiply with what? PVIFA required return 4 years in the above example plus. Tell me, sir, a maturity value comes every year, only once, only once. So that's a single period cash flow only. So take the maturity value and multiply that with PVIF RR 4th year. That's all. Over one line la answer is ready. This you should have in your mind. This should be on paper. Initially I will do both, but over a period you should know how to think on timelines. A timeline, if you understand, SFM will become very easy for you. Am I clear till here? Now, Now, nobody will have any doubt about these numbers because they are matter of agreement between the company and the investor. A bond ka terms, so they will tell you how much is a coupon rate, how much is a maturity value, and that is not something which is estimated or something. It's a matter of fact. That's not dividend, no. Dividend may come on. No, coupon, pakka it will come. How much it will come, I know already. Stated interest rate, everything is there. Now, how to compute or how to identify required return? Required return is based on two things. Market interest rate, that is risk-free rate. Not only that, and also the riskiness of the borrower. Sir, Reliance company is issuing bonds. You went and purchased that. So who is investor, who is borrower there? You are the investor because you are paying money. Who is taking money? Reliance. So Reliance is the borrower. Now how risky the borrower is, depending on that you want some extra return also. Now, high risk. If it is high risk, then you want high required return. Low risk, low required return. No risk, then you don't want any extra return, but definitely you want your risk-free return, RF. This is what you will expect. Okay, now how will you know the risk of a company? If a company is issuing bonds, whether it is risky or not, or if it is risky, how risky it is, how will you know? Risk of issuer company is identified by its credit rating. Sir, what is credit rating? Credit rating means, sir, for example, when if you are an auditor, what is your ultimate job as an auditor? To express an opinion, whether things are correct or not, whether things are reflecting a true and fair view or not. So, as an auditor, your obligation is to express an opinion. Like that, debt issuing companies, for example, I am a company, I want to issue bonds. If I want to issue bonds, public don't know about me, no. So how risky I am, public do not know. So what I am supposed to do is, I have to go to an independent authority like CRISIL, Standard & Poor, Fitch Ratings, CARE, these kind of companies are there, who are individual rating companies. Go there, furnish all your past history of borrowings, how you have repaid them and all, what are the current assets, liabilities, what you are having, what kind of projects and what kind of businesses you are doing, all that if you explain, that fellow will see all your history, your present position, forecasted position, and then he will express an opinion that a company is less risky, moderately risky, high risky, some opinion he will express. Based on that opinion, the investor will understand how risky it is. Okay. So, for example, if you are getting a rating of AAA, what it means is absolutely safe investment. AA, little safe only, but risk. Like that, single A, triple B, double B, like that it goes on. Sir, up to what level? Z is also there. Z means invest at your own risk. Like how bonds have ratings now, countries also will have rating. India entirely as an investment place, it has got certain rating. India investment. How much risk Indian country is for investment? Pakistan, Z. I'm not joking. It's not like our hate for Pakistan. Nothing like that. The rating is Z. Meaning what? Invest there. If you get, you get. Otherwise, you have to forget it. Either you'll get back your money or you'll get back a bomb. So, something like that. See, the financially duped countries, sir. They don't have money, they are begging. That country as a whole, they are unable to repay their existing loans only. If somebody wants to go and volunteer and give, at your own risk, you can do that. Nobody gives money to Pakistan. That's why they are borrowing from IMF. Where they are a member, they have a right to borrow, they are borrowing. So other countries and all won't lend any money to Pakistan because they don't have capability to repay the loan. Worst capability. A bad rating. India rating was under below B. Last 10 years this government, it improved. It's not very great now, but it is relatively better. So lower the rating, higher the risk. Higher the risk, higher the required return. Like that it depends. Okay, now. Look at this, sir. For example, let me take 3 bonds. All bonds have common features, sir. First, the bond has a maturity of only 1 year. Sir, maturity 5 years you can take. No, 1 year I will take. It's easy to handle. And at the end of 1 year, they will give you 1000 rupees inflow. Your job is to tell me how much is the fair value of the bond today. What is fair value of the bond? That's nothing but present value of that 1000 rupees only, correct? Discounted at required rate of return. Now, case 1. Bonds are issued by Government of India. If Government of India is issuing the bond, riskiya. Ours is not Pakistan government, no sir, Indian government only, RBI is strong only, capable of repaying your money even if you give also. So, it is a risk-free investment. Tell me, if it is a risk-free investment, how much return will you expect? Risk-free rate only. So, required return is equal to, let us say, 6%. Which is nothing but the risk-free rate. So value of the bond, how much will you give today? 1000 rupees divided by 1.06. You can multiply with PV factor also. Or single cash flow directly I am doing. How much is ma? How much did you get? 943.39. Okay, 943 you will make. That's okay. What are you trying to say there is, I am giving money to you, government. You are not risky. Since you are not risky, I don't want any extra return. I just want risk-free return. Since I want risk-free return of 6%, if I invest 943 rupees in you, on 943 if I earn a 6%, 943 into 6% if you check, it will be exactly equal to 57 rupees. 943 plus 57 will be my 1000 rupees. I will recover it after 1 year. This is what you are saying as an investor. Case 2. Bonds are issued by Reliance Industries. Tell me sir, Reliance Industry is risk-free investment, risky investment? Reliance is government ka friend, not government itself, no. And you know what happened to second Ambani? First Ambani, lot of money. Second Ambani ka credit rating, very bad. Lot of defaults. Company worst position. Just because name is Ambani, you should not go and invest there. Should be careful. Sir, nobody is noble in real life. They are all limited liability companies for a reason. Ambani is the face of it. But you are not giving money to Ambani, no, you are giving money to Reliance Industries. People scold Vijay Mallya. That fellow never suffered loss. A company suffered loss. Kingfisher Airlines suffered loss. He is having money. But out of noble, even though my company is in losses, I will come and repay the loan of SBI, and he will tell. No. You will not. Promoter is a face, but ultimately you are giving money not to the promoter, to the company. And company it is limited liability entity. Okay. Now, this is definitely risky company. So, risky investment. What is your required return? You want certain risk-free rate surely, plus some extra return for the risk. The extra return for the risk only, we actually call it as risk premium. Let us say that works out to 10%. So 4% extra return is what this investor is expecting. Tell me now, what's the value of the bond? 1000 rupees divided by 1 plus 0.10. 909.09. Okay, 10 I'll make. Closely observe. Both the bonds are giving you same amount after 1 year. But in the first bond you are investing only you're investing 943. But in the second bond you are investing only 909. Both the bonds will give you same cash flow, same maturity, everything is same. Only difference is issuer company ka risk. First entity no risk, second entity risk is there. Now that risk is there, you want more return. Since you want more return, you are investing a lower amount. Cash flows are fixed. If you want more return, there is only one way of earning more return. What is that? Invest less. That's what it is. Next, case 3. Bonds are issued by some ABC Limited, which is newly formed. Since it is a newly formed, it's very risky than Reliance Industries. Therefore, your required return is equal to 14%. Sir, all our assumptions only. I'm just telling you some proofs, that's all. Therefore, value of the bond is equal to 1000 divided by 1 plus 0.14. 877. 871 na 7 na? Okay, fine. 877. So guys, 877 rupees you will give. You see, all the 3 investments after 1 year you will get what? 1000. But the amount what you are giving today is not same. First case you are giving 943. Second case you are giving 910 rupees roughly. Third case you are giving 877. Why? Because even though the cash flows are same, the risks are not same. Since the risks are not same, your desired returns are not same. Since your returns are not same, your investment is also not same. Are you understanding what I am trying to say, sir? So, more risky, investor will expect more return. That's all. So, this is the background of bonds. Now, tell me this. Okay, summary. Fair value of coupon paying bond. Fair value of coupon paying bond is, we already discussed this. Take the coupon amount, multiply it with PVIFA for n periods, plus maturity value into PVIF. This will come only once. Correct, no, sir? This is coupon paying bond. Next one. Zero coupon bond. Zero coupon bond means the coupon rate is 0%. The company will not pay you any interest at all. Sir, when the company does not pay any interest, why the hell will I invest in that company in the first place? That's all. A bond is issued at discount, redeemed at par. So a difference, whatever is there, a difference is your interest income. Every year you won't get, at once you will get. So in zero coupon bond, the bonds are issued at discount. And redeemed at higher value in future. On maturity date. There will be no intermediate coupon cash flows. It will be like this: 0, 5 years, first year, second year, third year, fourth year, nothing you will get. Fifth year, directly you will get the maturity value. Let's say maturity value is 100. Tell me, sir, what's the fair value of the bond? All you have to do is what? Discount only one cash flow. So, above formula, sir, coupon part is not there, only the second part is there. At what rate? Whatever rate it is, discounted at your required rate of return. So, formula type if I write, fair value of zero coupon bond is equal to, you will consider the maturity value and multiply that with PV IFRR of nth period. Are you understanding, sir? This is a classic application of time value of money, nothing else. You just have to do the same time value of money chapter again with the flavor of bond in the background. That's all. IA formulas, ade PVIF, ade PVIF, nothing. Everything same to same. This is zero coupon bond. Coupon paying bond already over. Another bond I will tell you, answer you should give. Perpetual bond. Tell me, sir, what is the meaning of this? Good. This bond pays coupons forever. There will be no redemption. Maturity is not there. Maturity period is unlimited. Maturity value is 0. Which means 0, 1, 2, 3, so on, so on, so on, up to infinity. Tell me, sir, what is the fair value of the bond? What is the present value of all the coupons? Now tell, sir, you have covered time value of money now. That's all. This is a level perpetuity. Since it's a level perpetuity, fair value of the bond is equal to coupon amount divided by required return. How did we learn this in time value of money? Cash flow 1 divided by PIR. A PIR, now I am calling it as required return. In some other case, I will call it as something else. Depending on the chapter, I will change the name. But story, the skeleton is same. Clear, sir? Over? Now, we will learn some more concepts. Let's come to the first question. Look at this, sir. Mr. A is willing to purchase a 5 years rupees 1000 par value bond having a coupon rate of 9%. 1000 rupees par value, coupon is 9%, maturity is 5 years. And our Mr. A's required return is 12%. Okay, nice. How much Mr. A should pay to purchase the bond if it matures at par? How much should he pay to buy the bond? And a wording is nothing but indirectly what is he asking? Fair value, also called as intrinsic value, equilibrium value, theoretical value. How much I should pay in order to get my desired return? Correct? No? So chalo sir, let's work out. Question number 1. Sir, you can do it in the form of table also, formula also. Whatever is comfortable, you do. Presentation is your wish. I will do one presentation. If you want to follow the other one, please follow. That's up to you. Sir, fair value of bond, present value of future cash inflows, discounted at required return. Periods, cash inflows, PVIFA oblique PVIF at the rate of, what is this fellows required return? 12%. PV of cash inflows. I am drawing table for now. Once you get more comfortable, directly also we can do. Tell me, sir, coupon will come once every year? Every year. Like that, for how many years will it come? What is the maturity period? 5 years. So first year, second year, third year, fourth year, fifth year, 5 coupons will come. And maturity value will come at the end of 5th year. So how much is the coupon value? 1000 rupees is the par value, ma. Coupon rate is 9%. So that is rupees 90. And 5th year ending la, you will again get an amount of 1000. So now that 1 to 5 is there, that means every year ending. So that's an annuity. Apply annuity factor. Only 5 is there at 5th year ending. Apply PV factor. So do it, ma. 12% annuity factor. 3.604. 1 divided by 1.12. 1, 2, 3, 4, 5. When you do 5th year, no, first write off this. It will be easy for you. Then press GT. Multiply this 90 into 3.6048 and 567.4. 891.83. This, even if you don't fill up, nothing will happen as waste. What will you do by filling up? Multiply M plus MRC. You have GT, even more simple. This into this equal to this into this equal to GT. Directly answer will come. You want to write, you write. I don't have any issue. So this is called as what? A fair value of the bond. Now come to interpret. Sir, question is over here only. Answer is over. But there is a lot of interpretation in this. That's very, very important for us. Interpretation, sir. Let's start. If investor wants to earn 12% return, he should buy the bond at rupees 891.83. and hold it for 5 years. So what is the meaning of fair value is whatever present value future cash inflows you got, which you are calling it as fair value, rate if you are able to buy the bond, then definitely you will get your desired rate of return. That's the meaning of that. But whether this fellow will be able to buy the bond at that rate or not, that is not in his hands. Correct? No. So we'll take three scenarios now. Case 1. Actual market price of bond is equal to 891.83. That means what he did is, with his Casio calculator, this fellow computed fair value of the bond. He got it as 891.83. Immediately NSE website he opened, checked the price of this bond. Bond ka price in the market coincidentally quoted at 891.83. Surprise, shock. Sir, whatever I computed, that's exactly there in the market. Fantastic. The bond is correctly priced. The bond is correctly priced. What is the meaning of correctly priced? How much I should pay? Bond is also trading at the same price. Actual market price is equal to fair value of the bond. What is the meaning of this? Bond is correctly priced. Tell me, sir, when bond is perfectly priced, will you buy or you will not buy? You will buy. Definitely you should buy the bond. If I want to get a return of 12%, I should invest 891.83. Luckily, bond is also available in the market at 891.83 only. Why am I waiting? Buy. Now, in one angle, okay, another angle I'll tell you later on. Too much is confusing. Case 2. Actual market price of the bond is 870, or let's say 850 you take. Or tell me, sir, I am willing to pay how much for the bond actually? 891. I am mentally prepared. When I checked online, marketly bond is available only at 850. Its worth in my eyes is 891, but it's trading at 850. Will I buy or not? Yes or no? Yes. You're already prepared to pay 891, but that same bond, same future cash inflows, you are getting only at 850. Cheaply available now? In cheaply available case, we call it as bond is underpriced. First one is called as correctly priced. This is underpriced. You should always go and buy underpriced investments. So, bond is underpriced. Therefore, we'll buy the bond. Correctly priced, we'll buy the bond. Underpriced, happily we will buy the bond. Now, look at this. In case, sir, first case, if you buy the bond, your actual return, what you will earn, will be exactly equal to your required return. Because that's the whole concept, no sir. If you want to earn a return of 12%, you should invest 891.83. Luckily, bond is available in the market at 891.83. I will buy. How much return will I get? 12%. Exactly you will get. But second case, you won't get 12%. You will get higher than 12%. Why higher than 12%? Cash inflows are same, but my initial investment instead of 891, I'm just investing only 850. Returns are, there is no change. Cash inflows are same, but my initial investment is lower. Lower investment return will be higher. You understand, sir? So this is the case where your actual return will be higher than your required return. Right. Since the bond is available cheaply, nothing wrong, right? It will give the investor return, actual return higher than required return of 12%. This fellow wants 12, he won't get 12, he'll get something very high than that. That's the reason he should buy. So till here, did you understand? Should I confuse you for some time? I'll try to confuse. If you get confused, you learn more. If you don't get confused, then you have already learned. Any of these two things will happen. Let's try. Focus on case 1, sir. Tell me, what is your initial investment? Which 891.83? Red or blue? Don't tell me both are same. I also know both are same. Initial investment means how much you have to spend today to buy the bond. Market price. Correct? No? How much are you spending to buy the bond? Bond is available where, sir? In your home or market? You have to pay market price only. No? How much is market price? 8. That's what, that only will become your initial investment. Agreed? Clear? Okay. Tell me, what is your PV of future cash inflows? Which one? Red or blue? Blue. What is NPV? What did we establish earlier? If NPV is 0, you will not stand there which way to go on. You have to go forward only. You have to go and buy, accept it. It's exactly that case. NPV 0 wala scenario. NPV 0 scenario interpretation was what? Actual return will be equal to required return. That's exactly the same concept. NPV concept, instead of evaluating NPV, we are converting that into fair value valuation and we are talking overpriced, underpriced. Story is same, background same, presentation different. Clear? Move on. Answer this. What is your initial investment now? Careful. 850. PV of cash inflows. 891.83. This time your NPV is 41.83 positive. NPV positive, accept or reject? Accept. Why? If you accept a positive NPV, what does it indicate? You are earning a return higher than your required return. That's exactly what I wrote. Are you understanding, sir? NPV, if you learn properly, all these are different variants of that. Time value of money, if you know, the formulas are various variants of that. So as we go progress further, things slowly will sink in. Ultimate feeling will come as we cover more and more cases. Okay, continue further. Here one point I am writing. This actual return, whatever we are saying, he will earn more than 12%. No? What is the name for actual return? We studied already. Good. This actual return is IRR. And it is referred as yield in this chapter. Brackets are called it as YTM. YTM means yield to maturity. If you hold the bond till maturity date, how much return will you get? IRR computation, nothing great. We will do IRR computation again. Only thing is we don't call it as IRR, we will call it as YTM. Next thing, sir. Case 3. Actual market price of the bond is rupees 910. So actual market price 910 is seriously higher than the fair value of the bond. If actual market price is higher than fair value of the bond, tell me, sir, it correctly priced or underpriced? Overpriced. So your bond is overpriced clearly. Tell me, sir, we should buy the bond or we should not buy? We shall not buy the bond. But if you say and still go and buy the bond, what will happen? You will earn a return definitely, but that return will be less than your required return. Sir, all these are not just conclusions we are going to prove. Later on, we will have questions on YTM. You will be having questions on mixed. Then you will realize entire concept, underpricing, overpricing, what is IRR, what is YTM, what is required return. A full level clarity will come as we go further. Basics, if you are strong, SFM always is your friend. Okay. In this, another analysis is there. Third case, write that also. If investor already holds the bond, then he should sell it. Suppose, sir, you are the owner of a bond. You did not buy now, you already bought. You today, a bond ka worth is only 892 rupees, 891.83. But for some reason, the market price is 910. Market price 910 ka meaning is what you know? Some people are buying and selling the bond at 910. You know, a bond ka worth is how much? 891 only. Oh, here, what are you waiting? Go sell. Some fool will buy this bond at 910. Let him buy. I don't understand, sir. Not only you, many people like you will start selling the bonds. When people start selling the bonds, more and more sellers will enter into the market. More sellers means the supply of bond in the market is high. What will happen? Price falls. A correction naturally will come from 910 slowly. It will come down to 891.83. Are you getting it, sir? Similarly, the underpriced case you see. What is the worth of the bond? 891. But it's available at. What did you do? Today you bought the bond. You are not stupid to buy one bond. No, you will buy multiple bonds. You will pick up as much as you can. Not only you. I also know bond valuation. I will also do. Somebody else also will do. She will also do. You will also do. When everybody does that, what will happen? More and more buyers are entering into the market. Demand increases. What will seller do? Increase the price. 850 become 860, 860 will become 875, still people will buy. 875 will become 880, 885, 889, 890, 891.83, it will stop. Some fellow will quote 895, nobody will buy. Because by then the bond is already overpriced. Are you getting it, sir? This is theory. Reality lo demand supply conditions lo also same thing will work. But the background logic is this. Are you understanding? Sure. So this is one analysis. Now you tell me, on general thoughts, sir, it will be slightly confusing, but you will understand. Case 3 is overpriced or underpriced? What is the meaning of overpriced? The bond is trading at a price higher than its actual worth of the bond. Right. Do you agree bond is trading at discount? Do you observe that the bond is trading at discount to par value? Par premium discount and one concept is there. Underpriced, overpriced, correctly priced is another concept. Par premium discount is something which is comparing bond ka market price with the coupon price, coupon amount. So not coupon amount, face value. Face value 1000. When face value is 1000, actual price is above 1000, bond is trading at premium. Market price is exactly 1000, bond is trading par. Below 1000, bond is trading at discount. Bond trading at a discount and underpriced are not same. Bond trading at par, premium, discount is a analysis which we are making looking at face value of the bond and market price of the bond. But instead of face value, if you compare the bond price with fair value, then we will not use the words discount, premium, par. We will use the word underpriced, overpriced, correctly priced. For a decision making, whether to buy the bond or not. For decision making, which one is relevant? This one. What we just now discussed. That is, compare the market price of the bond with fair value and observe whether it is overpriced, underpriced or correctly priced. If you see the third case, 910, what did we write? Adi overpriced. But if you technically see, compared to face value, it is trading at discount. So the discount loans are, I will go and buy. Wrong answer, stupid people. Decision making should not be done based on par, premium, discount. Decision making should be done based on pricing. And pricing is based on fair value and market price of the bond. Are you understand? So there are two analyses. Another analysis also will come slowly. But the point here is, decision making ki you should only compare market price with fair value. Par, premium, discount is not for decision making. That is just a simple observation, that's all. Okay, this is one concept. So based on this, one more question we will do and then we'll come back. Question number 1 we are done, sir. Question number 2 is an examination question. I'll just take you through it. I'm not solving this as it is. We'll solve better questions. Read once. An 8.5% bond. What is the meaning of that line? Good. Of rupees 1000 face value. That I need not ask you and insult myself. 5-year maturity. Life is 5 years. Maturity at par. That is also nice. And yield to maturity of 10%. Has. Yield to maturity is a discounting rate. Has rupees 954.74 as the current market value. Okay. He is asking, calculate the price of the bond and compare it with market price, and what action should the holder of the bond take. Okay. As such, it's easy only. What is he asking? He gave you bond terms. Bond is having a life of how many years? 5 years. So next 5 years ka cash flows, you will discount it, work out the price. You got one price. How much fair value did you get? 943.17. So in order to earn your desired return of 943.17, you have to invest, in order to earn your desired rate of 10%, you should invest how much? 943.17. But actually bond is trading at 954. The bond is overpriced or underpriced or correctly priced? Overpriced. When bond is overpriced, will you buy a? No. But if you already have the bond, that's all. The bond is overpriced. Now, sir, I don't want to find a fault with the question purposely, but there is a flaw in the question. I'll tell you what is the flaw, correctly understand. They used the word yield to maturity. Yield to maturity means actual return and not required return. Okay, so this, even though the question used it as yield to maturity, their intention is not YTM. This is intention of the question is required. Sir, how can you so confidently say that their intention is required return? Sir, when I am working out fair value, I have to use only one discounting rate. What is that? Required return. Fair value versus actual market price I will compare. Then I will take a decision. Okay, sir. Fair value calculation ki you will never use actual return. You have to use only required return. That's all. Okay, another proof I will tell you. Come here. Look our case 2. Case 2, sir, tell me, what is your required return? Required return, all the 3 cases is same only. How much? 12%. But in case 2, my actual return will be higher than 12%. Why higher than 12%? The bond is cheaply available, underpriced bond. If you buy that bond, your YTM will be more than 12%. Now, for identifying fair value, I'll discount with 12%, more than 12%. Fair value, 12%. You'll never discount with YTM, no. If you want to obtain fair value, you have to discount your cash flows with which rate? Required return. The examination question, CMA final, I did not create that question. But questions of loss will be there, sir. Welcome to CMA final. Lot of loss will be there. Sir, flaw is there, no, we will learn like that only. Every question it will not be there. That's the problem. If entire concept they messed up, no. I will not teach you original thing only. But entire concept they did not mess up. Sir, which stupid will discount with YTM to get fair value, sir? That's conceptually wrong. For example, what will you do? You tell me, sir. If you are literally sitting in the exam, he is asking what should I do with this bond. You prima facie in your heart you know. Market price question given. What I want? Fair value of the bond. For computing fair value, I need required return discounting rate. I enter question only one rate is there, which is 10%. That stupid is calling it as YTM. What will you do? Our required return is not there, I will not do, and you will come off, sir. You don't have a choice, sir. A question of flaw is there, what can I do for that? The reason I told I will not solve that question is that only. My hands will not come. Flaw is there. Anyway, let's make one more small conceptual discussion. Easy one. Come here. Consider a bond which has cash flows like this. 1 year. It will give you coupon of 10. So fine, leave all this, just simply write cash inflow. $100. Now, required return is 10%. Tell me, sir, what is the fair value of the bond? Very easy, no? 100 divided by 1 plus 0.10. I'm not doing PVIF and all, only 1 year, sir. Directly I'm doing it off. You're getting 90.91. Tell me, interpret. What's the meaning of 90.91? Fair value interpretation, you have to tell 100 times. Don't worry. Shamelessly answer. Fair value of bond ka meaning 90.91 ka meaning is what? Tell. Actual price is 90.91. Huh? Fair value. Fair value. Fair value ka meaning is what? Good. If you want to earn a return of 10%, sir, required return ka meaning catch correctly. I want that. If you want that, you have to buy the bond only at 90.91. That's the meaning of that. Am I clear? Fantastic, mind blowing, beautiful. Now, look at this. Tell me, sir, you want happy case or sad case? Sad case. Actual market price of the bond is 86. Tell me, bond is overpriced or underpriced or correctly priced or don't know? Underpriced. Pakka? Okay, if you say so. So bond is underpriced. Tell me, ma, bond is underpriced. Buy or sell? Buy. Okay, if you buy the bond, your actual return will be definitely higher than your required return. What is your required return? 10%. Your actual return definitely will be higher than required return. Sir, how to compute actual return, sir? Array, sir, how to compute actual return? You can easily work out because luckily I gave you a 1 year bond. 86 rupees if you invest today, you will get 100 rupees cash inflow a year later. Can you work out return? Only two cash flows are there. Sir, how to work out? So we forgot. Array sir, how to work out IRR between these two? Two cash flows only. Present value, future value formula. So tell me present value, future value formula. Array, I told you one formula, no? IRR oblique YTM, when only 1 point inflow, 1 point outflow is there. Open your time value of money concept book, last page. See and do. Nth root of inflow by outflow minus 1. Why to trouble you with formulas? Leave it. I'll keep it very easy. $86 का future value sir is equal to 100. R is equal to how much? 100 by 86 minus 1. .1628 or 16.28%. This 16.28% is your actual return. Actually, I could have worked out like this. %, same answer will come. Why I did not work out like that is, if I do like that, you will ask me that it is simple return. That's why it did not work. Simple return, compound return, both will be same because the life of the bond is only 1 year. Reinvestment time may not there, no. That's the reason both will be same. But I did not wanted to use that formula, leave it. Now my point here is this. Your required return is 10, but your actual return is 16.28. Now, what will happen? What will happen if I take the bond future cash flow of rupees 100 and discount it to today at 16.28%? What will happen? Sir, what will we know, sir? Try 100 rupees divided by 1 plus 0.1628. $85.99999. What is 86? That I know. What is 86? That is your actual market price of the bond. So 86 is your actual market price of the bond. Suppose ide cash inflow you take and discount with 10%, which is your required return. We already did know, of course. If you want again, I'll do 100 divided by 1 plus 0.10. 90.91. This one is called as fair value of the bond. From this, what you have to conclude is, if discounting rate is actual return, which is also called as YTM, price represents actual market price of the bond. If your discounting rate is required return, it will give you the fair value of the bond. So you should be careful with all the simple concepts, but very small concepts, very powerful observations. Who is your discounting rate? Sir, my discounting rate is RR. Your present value is called as a fair value. Discounting rate is YTM, actual return, actual price. Sir, how to remember? Simple. Actual return, actual price. Required return, fair value. Just have one small thought in your mind. Actual return, somebody would have computed actual return. Tell me, sir, actual return computation law, market price of the bond is considered or not considered? Considered. If 16.28, how did you get, sir? Did you consider 86? No. So, a 16.28 calculation, market price is already there, actual market price. So, when you discount 100 with 16.28, automatically you will get the market price of the bond, not the fair value of the bond. I told you why that question is flawed is for the same reason. That fellow discounted with YTM. YTM is actual return. Actual return, though, if you discount, you will get market price only. But if you see in that question, when you discounted with 10%, that fellow did not get market price. He got 943. Are you understanding, sir? If that was correct to YTM, then answer should have been how much? 954.74. But we got 943.17. That is a proof that that is not YTM. That is required return. Are you understanding, ma'am? What discounting rate you use, depending on that, a price ki one tag I will give, either fair value or actual price. Clear? All good? Sure, pakka. Okay. The coupon rate, coupon amount, par premium discount, that we will talk in the next session. One small, another case you do. Do case number 3. If you do this, then you are okay, on par with me. You are understanding. And I will understand. Please read. ACFA Industries is planning to issue a debenture series on the following terms. So, there is a company is issuing bonds, sir. Face value 100. Term of maturity is 10 years. Yearly coupon rate. Year 1 to 4, 9% they will pay coupon. 5, 6, 7, 8. Next 4 years they will pay at the rate of 10% coupon. Last 2 years they will pay 14%. What is not same every year? Coupon rate is not same. Every year they are having a different coupon rate. The current market rate on similar debentures is 15% per annum. Tell me, sir, what is the meaning of this? Current market rate on similar debentures is 15% per annum. Ka meaning is, sir, in the see, you are stupid. You are planning like this, but ordinarily people issue bonds at the rate of 15%. Indirectly is hinting that this is present required return in the market. Present required return in the market is how much? 15%. Sir, if you discount with 15%, what will happen? All the bond cash flows, if you discount with 15%, you will get the fair value of the bond. If you issue the bond at that price only, that only will become the actual price of the bond also. And investor also will get how much return? 15%, correct? But you see this generous company. The company proposes to price the issue in such a manner that it can yield 16% rate of return to the investors. What is the meaning of that? What is the meaning of that? I know, I did my research. I observed that public are expecting a return of 15. Tomorrow if I offer the bond with a coupon rate of 10% or 12%, public may not buy the bond. Issue fails, I will not get my money. Okay, sir, let us price the bond in such a way that they will get 15% return. Who knows? If 15 is my research. Ultimately, on the issue date, if the public expects more than that, still my issue will be failure. I don't want to take risk. I want to issue the bonds in such a way that whoever buys a bond, they will get a return of 16%. Okay, fine. The company also proposes to redeem the debentures at 5% premium on maturity. Okay. Question is this. Determine the issue price. You tell me, sir, issue price is theoretical fair value, real price? Issue price is market price or theoretical number? Issue price means if I quote something as issue price, what will investor do? He will pay me that money, no? So that is going to become the market price. So indirectly what is he asking? Tell me the market price. If you want market price as your answer, your discounting rate should be actual return, required return, actual return. So ఈ sum లో both the returns are given to confuse you. You should pick up the correct return. 15% is recovered return. If you discount to 15%, you will get fair value. Investor is willing to pay that much, but you want to tempt him more by giving him more return. And how much return do you want to give him? 16%. So what will you do? You will discount all the bond cash flows with 16%. You will get one actual price. Issue the bond at that rate. Investor point of view, what he will do? He will discount all the cash flows with 15%. And then he compares fair value versus actual price. He will observe that the bond is underpriced. If I buy this bond, I will get 16%. He will tempt and buy the bond. My bonds will be sold. I will receive the money. This is the company ka plan. Are you getting it, sir? Now if you watch this story, question is from company's point of view only, but entire analysis is from investor's point of view. Because whether investor will buy the bond or not, company will not know. Company can only issue the bond. But how to make the investor buy the bond? To give him more return. Give him more return, he will buy. He wants 15 only, but I will give him 16. If I use a higher discounting rate, present value will fall. Price, actual price will be lower. That fellow will get tempted and buy the bond. Clear? Now he is asking that. So let's try to work out this. Question number 3 ka answer please write, ma'am. To compute the actual issue price of the bond, discount the bond future cash flows at actual return oblique YTM of 16%. What will happen if you use 15%? You won't get issue price. You will get theoretical fair price. Fair price is theory. Reality is actual market price. If they both are same, no problem. They are not same, then you will take a decision based on underpricing, overpricing. So let's come here. Year, cash inflows, PVIFA oblique PVIF at the rate of 16%. Last column, PV of cash inflows. First 4 years, this fellow has got one coupon amount. Next 4 years, another coupon amount. Next 2 years, another coupon amount. And 10th year ending is having a maturity value. Now, first 2 years, what's the coupon? 9%. Face value is how much? 100. 100 into 9%. So that's 9 rupees, sir. Okay. After that, 10 and 14. And towards the end of 10th year, that fellow says he'll redeem the bonds at premium on maturity 5%. So how much will he pay, sir? 105 he will pay. Now you will tell me annuity factors correctly. $2.7982. Okay. You told me 4 years annuity factor. Now what I want? 5 to 8 annuity factor. That is called as mid annuity factor. Correct, no sir? Mid annuity factor. How to work out mid annuity factor? 1 divided by 1.16. First year, second year, third year, fourth year. I don't want these 4. Is equal to 5th year M plus, 6th year M plus, 7th year M plus, 8th year M plus MRC. 1.5454. Next. I want 9 to 10 का annuity factor అంటే 9th year and 10th year का PV factors का summation 1 divided by 1.16 first year, second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year I don't want. Now next year I want 9th year is equal to M plus one more is equal to M plus MRC 0.56 8 no 56797 so that's 568. You're writing different answer, huh? I'm sorry, sir. Then I might have pressed one thing extra. 1.16. 1, 2, 3, 4, 5, 6, 7. Yo. Correct. You're right. 0.4896. Okay. Sometimes I do testing like that. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Tell me last. Why is this calculator giving me wrong answers? 1, 2, 3, 4, 5, 8, 9, 10. Okay, now it's giving correct answer. 0.2267. Last one is PV factor, sir. First one is annuity factor. Middle two are mid annuity factors. For that you have to use M plus and get it. Multiply all this and tell me the final number. Well, sir, 71.26, sir. 2, 9 you got, huh? Okay, wait. It's okay, don't fight for chiller, leave it. Well. Sir, if you are an investor, what will you do? If the company is thinking, company will do this and they will issue. If you are an investor, how you will think? Underpriced or overpriced, how will you know? You will take the same cash flows, but instead of 16, you will discount it with 15% required return. Since you are using a lower discounting rate, what will happen to present value? It will be higher. So here I got 71, let's say you got some 75. So investor will be thinking, I will pay 75 and buy the bond. Company issues the bond at 71. The bond is underpriced. If you buy an underpriced bond, you will get a return more than your required return. Investor will buy the bond or not? Yes, he will buy the bond. And therefore the company will get the money for whatever purpose they are getting. They are raising the money for. Bonds will be sold. The company ka plan. Are you getting it, sir? Right. Question number 5 you do, and we'll close it for today's session or class. 5. Fourth one is your study material question. Fifth one is also similar question only, but fifth one you do. A bond with 7.5% coupon interest, face value 10,000, maturity is 2 years, presently yielding 6%, means it is YTM. Interest is payable half yearly. Compute market price. See, he is not asking you compute fair value of the bond. Are directly, openly, shamelessly asking work out market price. So discounting rate should be what? YTM. Did they give you YTM? Yes. Actual return is given. Actual return, though, if you discount cash flows, what will you get? Actual price only you will get. That's all. Only twist is, here coupons are payable half yearly. If coupons are payable half yearly, tell me, sir, your each period is how many months? Each period is how many months? 6 months. Every 6 months once you will pay interest. In a span of 2 years, how many 6 months are there? 4. So you will have how many periods now? 4 periods. That's all. Right. Question number 5. each interest period is equal to 6 months. Coupon amount is equal to, what is the par value given this fellow? 10,000 into 7.5%. Okay, 10,000 into 7.5% into 6 by 12. How much? 375. In a maturity period of 2 years, there are how many periods? 4 periods of 6 months each. Next one. YTM is equal to 6% per annum. Periodic YTM is equal to 6% into 6 by 12. So since it's a semi-annual bond, you see where all adjustments came. Adjustment was there in coupon. Adjustment was there in number of periods. Adjustment is there in discounting rate as well. Everything you have to convert into half yearly basis. Life half yearly basis, discounting rate half yearly basis, cash flow half yearly basis. Then you do the sum normal. That's the reason E columns I am putting the heading periods. Coincidentally, maybe year, I don't know, but it is not. So periods, cash inflows, PVIFA oblique PVIF at the rate of 3%. PV of cash inflows. Your next 2 years ki, or next 4 periods ki, your coupon amount is same. I can confidently write 1 to 4. Coupon amount is 375. 4th period ending la par value 10,000. Tell me, sir, 3% annuity factor for 4 years. 1 divided by 1.03. First, let us write this. Otherwise, again you have to do. So guys, this is your market price of the bond. Is clear? Sure, pakka. Well, sir, what you do is revise all this, revise time value of money also, revise this also, and then tomorrow we'll play more. See you guys. Yeah, well guys, so we have given introduction, a pretty heavy one actually for bond valuations. Let's recap quickly what we have covered, and then we will move on further into the core concepts of bonds. So basically, what is a bond? Bond is nothing but normal debenture, sir. It's a debt instrument issued by an entity. It's a form of borrowing only. Instead of borrowing from a single source like a bank, when I borrow from various investors by issuing them securities, we call it as a debt instrument. A debt instrument usually is very popular as debenture, but in academic purposes and all, we call it as bonds. There is no real difference between bond and a debenture. Having said that, generally, when a government or a public sector undertaking issues a debt instrument, we refer that as bonds. When the same private sector entity issues a debt instrument, we refer them as debentures. So as such, there is no technical difference. They both are equally same for us. Next. Just like a share, bond also has a face value, or which is also called as nominal value or par value. Now, what is the purpose of this face value? The purpose of face value is only one thing, sir. That is computation of coupon. the interest whatever the bond has to pay to the investor, that is computed by applying the coupon rate on the face value of the bond or par value of the bond. Now, even though that is interest, as we discussed yesterday, we prefer to call it as what? Coupon amount or coupon rate. So fine, that is one thing. And next, typically redeemable bonds on the maturity date can be redeemed either at par or at premium or at discount. That's a matter of agreement between the investor and the borrower, right? Then we have also discussed that in order to create liquidity for the bonds, most of the entities, what do? They go and list the bonds on a stock exchange. When you list the bonds on stock exchange, what is happening? You are creating a second hand market, that we call it as a secondary market. So in secondary market, the moment things are listed, sir, what will happen? The prices are determined by forces of demand and supply, because in the market there are many buyers, many sellers. If there is more buyer for a particular bond, demand increases automatically, price also goes up. When there are more sellers of a particular bond, supply increases, price will fall down. Basic economics, nothing else. Now, when the price increases or when the price decreases, to what extent it will fall, to what extent it will go, what is the ideal price, that entire thing we are going to cover in this chapter. Now, as discussed yesterday, this chapter is predominantly from investor's point of view, not from company's angle. So, what is the meaning of bond valuation? Bond valuation is nothing but determining the fair value of the bond. Now, what is fair value of the bond? Fair value of the bond basically means identifying how much amount an investor should put in the bond in order to earn his desired required return. So, next question, how to compute fair value? Fair value is nothing but all future cash flows, whatever are there, happily discount it off to today, using which rate? Required return of the investor. Now, in a typical bond, future cash flows are what? Only coupon interest and the maturity value. So, take the coupon amount, take the maturity value, discount everything to today using required rate of return. Now, usually in a redeemable bond, the coupon amount every year will be same. Since it will be same, instead of sitting and discounting individually, we directly apply an annuity factor and discount it off at once. Next, required return. As discussed earlier, required return is based on two things. One is the market interest rate, which is the general risk-free rate. And what is the other thing? The riskiness of the borrower. If I am investing money somewhere, it's like I am giving money to somebody. Depending on how risky that somebody is, how much extra return I want depends. For example, when you give money to government, you are expecting only a return of how much? 6%. When you are giving money to Reliance Industries, you are expecting a return of 10%. When you are giving money to some company which is newly formed, that's even more riskier, you want even more higher return. Higher the risk, higher the return. Lower risk, lower return. No risk, risk-free return. So this is about required return concept. Now, as an investor, how will I know whether a company is riskier or not riskier, how much risk it has? That depends on what? There is something called as credit rating. Credit rating is done by individual and agencies which are appointed, and when at the time of issue of bond, the company will tell the investor, see, we got this rating from the independent authority, so you can trust me to this effect. So accordingly, the return what I am offering is reasonable enough. If you find it, please come and invest. So it's like an opinion expressed by an independent agency about the willingness and the capability of the entity to repay the amounts borrowed from the investors. So that is called as credit rating. Looking at the credit ratings, investor will understand how risky the company is. Now, innocently, you should not think that when so many companies are there, so many companies are issuing bonds, I should go and invest in that bond which is having highest rating, AAA rated bond. No, sir. Because if you go and invest in that kind of bond, no, literally risk is zero and return also will be lower. Risk will be almost negligible, return also will be very small. So, if you want a risk-free return or almost very minor risk only you want to take, you can as well do a fixed deposit also. If you are coming to bonds means, you basically some people wants to take some risk. So, it's not that always you should go for AAA bond and all. Where you will invest, that's a matter of your risk perception. So, there will be one fellow, sir, that fellow feels that I will take more risk, I will take more return, I don't mind in a particular if default happens. So, that kind of fellow will go for a lower credit rated bond which is promising to pay a higher interest rate. Okay. So, don't make any conclusions out of which bond I should invest. No, sir, not like that. So where you will invest, that's a matter of risk return preferences of the investor. You can't say that you should always go and invest only in a AAA rated bond, top category bond, not required. It's investor's choice. Next. Okay, fair value of a coupon paying bond we have discussed. Next, zero coupon bond. Tell me, sir, what is the meaning of zero coupon bond? In a zero coupon bond, the bond does not pay any coupons. It will pay only maturity value. So basically, how will the investor earn his return then? The bonds are issued at discount and redeemed at par. Now, how to work out the fair value of a zero coupon bond? All you have to do is zero coupon bond ka maturity value, single cash flow, whatever is there, discount it to today. Just multiply with PVIF. Got it. Next. Perpetual bond. What is the meaning of perpetual bond? A bond which does not give you your maturity value at all, but forever it keeps on paying you coupons. And coupons it keeps you paying forever fixed amount. This is falling into a level perpetuity cash flow. Therefore, present value is equal to coupon amount divided by RR. That's all. Then we have gone into questions. Now, questions very interesting observations came for us. Now, there was one scenario where we worked out the fair value of the bond. We interpreted the meaning that if I want to earn a return of 12%, I should buy this bond at 891.83. Whether you will be able to buy this bond at 891.83 or not, that is not in your hand. That depends on market price of the bond. Now, market price of the bond, if it is coincidentally 891.83, we'll say that the bond is correctly priced. I want to pay that much, market price is also quoted like that only, bond is correctly priced. When something is correctly priced, definitely you should go and buy the bond. Fine. If you buy the bond, how much return will you get? Your actual return will be equal to your required return when the bond is correctly priced. Suppose to your surprise, you found the bond at a lower rate. If you find the bond at a lower price like that, we call the bond is underpriced. If you buy an underpriced bond, what will happen, sir? You will end up getting a return more than your desired required return. Correct? This actual return, whatever you are going to get, that is referred as what? Yield or yield to maturity in this chapter. Today, we will be learning how to compute that YTM. Next. If actual market price is 910, it is more than 893, which means the bond is overpriced. If you buy this bond, what will happen? You will definitely get a return, there is no doubt, but that return will be less than your required return. Ideal answer is you should not buy. If you already have this bond, sell the bond. Then I have given an example. The example ultimate summary is this. Bond ka cash flows cannot change, sir. Bond ka cash flows are already fixed. So if you discount all that bond cash flows to today using required return, then the result is called as fair value of the bond. That's a paper number. Fair value is not reality. Fair value is your homegrown calculation. If question nothing is given, then we'll assume that fair value and actual price are same. Bond is correctly priced and we'll assume. But as such, when you discount anything with required return, you will not get actual price of the bond. You will get only fair value of the bond. If you want actual price of the bond, then your discounting rate should be what? Yield to maturity. Total take IRR and discount it off. If you discount it with IRR, automatically actual market price will come off to you. Clear, sir? Then last we have done a couple of questions on semi-annual bond and all we have done. So we'll go to another question. Not you, not you, not you. One is over. 2 I have discussed with you. 3 I have done. 4 you handle on your own. 5 I have done. You want to try 6th one? Please do 6th one. A PSU is proposing to sell an 8-year bond of ₹1,000 at 10% coupon rate per annum. Okay, 8-year bond, ₹1,000 face value, 10% is a coupon rate. The bond amount will be amortized equally over its life. What is the meaning of bond amount amortized equally over its life? Normally what is happening, bond face value when will you get back? At the end. But here it is not like that. Every year they will pay. So it's not like ₹1,000 you will get at the end of 8th year, you will get it every year. So 1000 divided by 8, every year 125, 125, 125 you keep on getting. That means along with the coupon, principal amount also is getting repaid over a period of 8 years. If the investor has a minimum required return of 8%, what is the bond's present value? Sir, ee sum ki previous questions ki where is the difference? The difference stands only where maturity value is paid at the end of the period, whereas here it is paid every year. Since it is paid every year, simple, every year cash flows will not be same. Why it will not be same? Your principal repayment 125 is same. Along with that coupon also will come. Coupon plus 125 total will not be same every year because interest will keep on reducing. Since the total cash flow is not same, you cannot apply what? Annuity factor. So you have to do individual discounting of each year ka cash flow. That's all. Please do it. 8 years and 10% coupon rate. Discounting rate is 8%. Fine. Question number 6. Amortizing bond means the principal of the bond, right, face value, more easy, is repaid each year equally, which in this case is 1000 divided by 8 years, which is equal to rupees 125. So every year 125, 125, 125, you keep on paying like that. That fellow's required return is given as 8%. Every year principal cash flow number will be same, but as principal is getting recovered every year, your next year ka coupon amount will not be same. The total cash flow will not be same. The annuity factor you cannot apply. Individual P factors you have to do. There is no choice. So first year ending you will receive principal of 125. Coupon throughout first year, how much is outstanding? 1000. On 1000 they will pay you coupon of 10%, which is 100. So total is 225. Second year, another 125 you will get, but this time interest you won't get 100 because out of 1000 last year ending they paid you 125. Outstanding balance is only 875. On 875 rupees, 10%. So that's 87.5. This will be 212.5. 125. Now out of 875, 125 is paid in the last year ending. So 750 is outstanding, that into 10%. So which is 75. Is 200. Okay, now you can understand a pattern. If you look at the total cash inflow, it's coming every year lower by 12.5, 12.5, 12.5. Why 12.5? 125 rupees is getting paid now. On 125 rupees, 10%, 12.5 interest amount is reducing every year. So hereafter, innocently don't work out all this. Directly, if you don't have time, sort out like this. 187.5, 175. After that, 152.5. Correct all here. Check once. 150, 162.5. Correct. And then 150 here. Finally, 137.5. That's it. If you want to fill up, you can fill up. There's nothing wrong. Well, okay. Now, PV factors 8%. 3 or 4 decimals you take and do it off. Generally, questions only they will give you the PV factor, sir. The question does not give, you sort out on your own. 3 or 4 decimals will be fine. That's it, sir. Total it, please. Don't fill up the last column. Just multiply on your calci and get the final answer. That's it. Don't do unnecessary calculations. Waste your time. One zero seven 0.39 I'll take. It's just similar to previous sums, sir. Conceptually there is no change. Bond ka cash flows lo pattern change is there. Hence we have a bigger table. That's it. We got 1090 here by 20 rupees. 20 rupees is not rounding off error. Check again. If it is my book club printing error, then that's okay. 1070 is kind. Okay, fine. Check the cash flows in the book. Why is it not matching like that? It should match, no? 1070. We'll change it to it. Correct it, sir. Make it 1070. Fine, sir. So this is one question. E-model never came in your exam though till now. Let's try this one and then we'll go to new concept. Calculate market price of 10% Government of India security currently quoted at 110. Now you interpret each number, but interest rate is expected to go up by 1%. What is the meaning of all this? Don't see the answer. On your own independently interpret the question, please. 10% Government of India security means 10% is what here? Good. 10% is correct coupon rate. What is 110? Okay, nice. This is actual market price. But coupon rate has to be applied on market price of face value. Face value. Face value question they did not expressly give you, but it is implied. How much? Good. So the face value of the bond is 100 and that is implied. Okay. Tell me, how will you interpret this one? Interest rate is expected to go up by 1%. How will you interpret that? Coupon rate will increase by 1%? No, sir. Coupon rates are fixed. Coupon rate cannot increase. Coupon rate is 10% and they told no already. How will it increase? It will not increase. Coupon rate is fixed, but market general interest rates can rise. Is it possible? For example, watch this. Sir, market risk free rate was 8%. X Limited and a company is there. This fellow was issuing a bond. Since this fellow is issuing a bond, E.Srinivas is not a risk-free company, no, it's a risky company, so I want more return. This fellow offered a coupon rate of, let's say, 10%. I am investor. In my mind, what is running is my required return is also equal to 10%. My required return, that fellow's coupon rate, both are matching. Will I buy the bond or not? Definitely I will buy. So this fellow bought the bond. After I buy the bond, what happened? Market risk-free rate went up to 9%. Government increased the risk-free rate. If risk-free rate increases, my required return will increase or decrease? Increase. So now my required return is 11%. But I already bought the bond whose coupon rate is only 10%. Are you understanding what I am trying to say? Coupon rate will not change. My feeling will change. At a particular risk-free rate, I added some risk premium and then I was expecting 10. Coincidentally, bond also was offering 10. I purchased the bond. But after I buy the bond, market interest rates can change, you know. It can increase also, decrease also. It increased. My required return also increased. My feeling changed. Bond ka cash flow will not change. Bond ka coupons will not change. Nothing will change. But you tell me, sir, is this fellow happy or sad or no? If you are that investor, will you be happy or sad? Why sad? Today your required return is 11%, but that bond won't give you 11% because you purchased the bond at a 10% coupon rate. Are you understand, sir? You will never get your required return in this bond. You already bought it. Am I clear here? Like that. So what will you do since you are not happy? Not happy boy. What will he do? Since he is not happy with the bond, this fellow will sell the bond. Next question. If he sells the bond, somebody has to buy, no? Who will buy? If he is not happy, nobody is also happy, no? What will happen? Company will buy, no? Company says, don't show me your face in the next 5 years. Since nobody is willing to come forward to buy this bond, what will this fellow do? He will try to sell the bond at a little lower price. Still nobody comes. Even more lower price, nobody comes. Even more, yes, somebody will come. Sir, why is that somebody coming? When the price drops, even though the coupon rate is 10%, since he is purchasing the bond at a lower rate, he will be able to get his 11% return. Are you understanding? So it's all pure economics here. Are you getting it? So I purchased the bond. I was happy on the first day. It's like marriage only, sir. Initially happy. Later on, trouble started. Of course, I can't sell it, but here this bond, this fellow is trying to sell the bond. If he's trying to sell the bond, who will buy? Nobody will buy. So what will since he is unhappy, nobody is happy with this price. So what will happen? He'll try to sell the bond at a lower price. If he tries to sell the bond at lower price, somebody who purchases the bond at lower price, that fellow will get 11% return. You won't get, because you purchased the bond at par value. So this is how economics work. Like that. Come back to the question again. 10% is the coupon rate. Bond ka market price is 110. But what is it trying to tell you is today interest rates are expected to go up by 1%. If interest rate is expected to go up by 1%, the only point you have to catch from that is my required return also is going to increase by 1%. So your required return until now is 1. After increasing by 1%, it is changing. The revised required return you have to work out. So your job is to work out the market price of the bond. Let's compile all the data, sir. This is a very simple question, but lot of concept is required to handle this. Come here. Coupon rate is equal to how much? 10%. What about maturity period? Read the question quickly and tell me what is the maturity period. Not given. Read 100 times, you won't find. Sir, not given means I will assume 3 years. If you assume 3 years, this boy will assume 8 years. His lucky number 8. 16. You will all get different answers, no? The assumption wrong. What should I do? Then there is one assumption which if you make, everyone will get the same answer. Which one? Perpetual bond. If the bond does not, sorry, the question does not give you maturity value, it means there is no expiry date. It will live forever. Tell me now, price of the bond formula. Coupon amount divided by RR. What's the price of the bond given? 110. Coupon amount 100 into 10%. Required return. That I don't know. So, required return from the bond is 10 by 110. 0.0909 or 9.09%. In 9.09% is your existing RR. Now twist. What is the twist? Now interest rates in market gone up by 1%. Therefore, required return from the bond will also go up by 1%. So what is the revised RR now? 9.09 plus 1, 10.09%. He is asking revised price, that's all. Our workouts are 10 divided by 10.09%. The revised price of the bond. Observe the story. Market price of the bond was 110, 110. From 110 it has fallen down to 99 rupees ki padipoyindi sir. Why? Natural. Market interest rate increased. My feeling changed. I don't like you anymore. When I bought it, I would have liked you, because at that time my RR and the yield, everything was matching. Now bond ka yield cannot change because of the fixed, but your feelings can change. Because your feeling changed, the bond is no more likable for you. You try to sell the bond. When you try to sell the bond, nobody will buy the bond at the price at which you have bought. So you have to sell the bond at a lower price. Like that it happens with everybody. So price will fall down. This is that story. Let a small note for clarity. We have to assume that bond is correctly priced. Since the bond is correctly priced, what is the meaning of that? Fair value of the bond is equal to actual market price of the bond. And therefore, required return is equal to YTM. Why a note has to be given to you? Because Somebody told you yesterday that if you discount cash flows with RR, the result is called as fair value of the bond. But look at the requirement of the question. They are asking calculate market price of the bond. How will you compute market price using required return? I can't. You have to assume only one thing. Assume that the bond is perfectly priced. When the bond is perfectly priced, fair value, actual price, RR, YTM, they are all same. Hence it works. Let's take one small concept now. Yeah, take to your concept part, sir. Till now what we have covered is the basic meaning of the bonds, face value, coupon rate, coupon amount, maturity date, redemption. Up to here we have covered. Types of bond we will discuss later on, sir. Broadly few have covered. Discount bonds or zero coupon bonds, we have explained this. Coupon paying bonds we have discussed. Perpetual bonds we have discussed. Amortizing bonds also we have discussed. These things will come later on. Next. Bond valuation ka meaning we have discussed. Bond valuation depends on future cash flows and discounting rate. Future cash flows are these. Discounting rate is your required return. So higher the risk, higher the required return, lower the risk, lower the required return, and it also depends on the market interest rate. You have just now seen a scenario where market interest rate changed, required return changed, bond ka price also will change. Coupon paying bond ka valuation formula, zero coupon bond ka valuation formula, perpetual bond ka valuation formula. Here I want you to read this point once again slowly, sir. Please carefully read, all of you. I know you know, but still you read. The price calculated above is a fair price or theoretical price. It is the price at which the bond should be purchased in order to earn the required return. The actual market price of the bond may or may not be equal to the bond price, or rather write fair price, it's more correct. May or may not be equal to the fair value is more correct instead of bond price. Okay. Therefore, a bond can be correctly priced or underpriced or overpriced. A point is very important for you now. If nothing is mentioned in the question, we have to assume that fair value of the bond is the actual market price of the bond. Underpricing, overpricing kind of questions, anyway the question will tell you what is actual price, you are supposed to work out fair value. So in that case, underpricing, overpricing, some decision making you will take. But if the question is not asking you any decision, they are simply asking you to compute a price. In that case, you do not differentiate between fair value and actual price. They both are same for us. We go with a fundamental assumption that the bond is correctly priced. That is exactly what we did in this question. See, sir, he is asking market price. We used RR. Ideally with RR you will get only fair value, but I have to assume that fair value and actual market price both are same. The bond is correctly priced. That's how we reach the conclusion. Sir, in concept book too, you have to integrate everything. Everything will match, sir. Every point will be there, everything will match also. Sorry. Yeah. When current market price and theoretical market price, that is the price at which we calculate by applying present value concept are not same, we will undertake following decisions. First scenario, if actual market price is greater than the fair value, we call it as overvalued and decision is to sell the bond. If market price is lower than the fair value, undervalued or underpriced, and you will buy the bond. If they both are same, correctly valued, hold the bond or buy the bond. Clean price, dirty price, we'll talk in some time. Come to EBIT. Guys, what we are going to discuss is pretty simple, but just to keep one small check in your mind. I am not talking about decision making. Decision making means whether to buy the bond or sell the bond. A decision when you will do is when bonds are not correctly priced. I mean either it is overpriced or underpriced. Then only you have to apply your mind and think. This is not that case. I am going to show you 3 scenarios. In all the 3 scenarios, you believe very strongly in your mind that the bonds are correctly priced. So don't tell me buy, sell and all. You will anyway buy. Okay, sir? Remember this. This is altogether a different scenario. Read now. A Limited issued a bond with a life of 5 years. Coupon rate is 10%. Par value is 1000. Okay, 5-year bond, coupon rate 10%, par value 1000. The bond is also redeemable at par. Nice. Calculate the price of the bond in the following cases, assuming that the bond is correctly priced. Bond is perfectly priced. There is no issue with that. Case 1. RR is equal to 10%. RR means required return. Second case required return is 12. Third case required return is 7. Now, since my RR is different, prices also will be different, no? Right? So, first scenario, since RR is 10%, I discount all the cash flows with 10% discounting rate, and to my surprise, I find that the bond value is exactly equal to 1000. What is 1000? That's nothing but the par value of the bond itself. That means here one small conclusion is there. What is that conclusion? When RR and coupon rate both are same, when RR and coupon rate both are same, bond will be trading at par value. I am not talking underpriced, overpriced and all. These are all scenarios of correctly priced only. Okay, what I am trying to say is I am giving a comparison between actual price and the face value, par value, not fair. Actual, fair, both are same. Our price is equal to par value, more than par value, less than par value. That discussion we are doing now. Okay, so when required return and coupon rate both are same, bond ka price ideally should be at its par value. So that's the conclusion here. The price of the bond will be equal to its par value. Now come here. RR 12%. Investor wants 12% return. Coupon rate is 10%. The company pays every year annual coupon of only 10%. Work out the price of the bond. How will you work out? Simply discount everything with 12%. How much price did you get now? 928. Now tell me, sir, compared to face value, it is at premium or discount? Discount. Now, should I buy the bond? In a question I am not asking. I will buy the bond anyway. Bond is correctly priced. I don't care whether it is at par, premium or discount. That's not used for decision making purposes. My question here is different. If you buy this bond, which you will do, if you buy the bond at 928, how much return will you get? You have only one choice. Correctly answer. If you buy the bond at 928, how much return will you get? 12%, that's all. 12%. I do understand, sir, bond is fair, sir, fair value. If you buy the bond, your return will be equal to your required return, which is nothing but 12%. Are you getting it, sir? Now, general question which student asks me is, sir, this bond pays 10%. How will the investor get 12% return? That's the question. What is the answer for that? 10% anyway you are getting, no? Not only that, today you are buying the bond at 928, but at the end of 5th year you will get an amount of 1000. There is a capital gain component also, no? Are you getting it, sir? There is a coupon every year cash flow. Then towards the end you will have a capital gain also. Coupon 10, a capital gain worth is around 2%. Overall I will get my desired return of 12%. Sir, remember, when you buy the bond at fair value, you will get what you want. You will definitely get what you want. You want how much? 12. You pakka get 12. Do you understand what I am trying to say? Chalo. Case 3. RR 7%, coupon rate 10%. Required return is 7%. Coupon rate is 10%. When you discount it with 7% now, a bond is now trading at 1123, which is premium to the par value. Don't call it as overpriced. It's premium to the par value. Since it is a premium, if you buy this bond at 1123, how much return will you get? 7 required return. 7 you will get. Sir, company is paying me 10%. No. No, sir. Company pays you 10%. But today you purchase the bond at 1123 and towards the end you will get back only 1000. There is a capital loss waiting for you. So 12%, so 10% coupon, but there is a loss. Both put together, effectively your return is only 7%. Do you understand, sir? This is another observation, sir. So let's compile like this. Coupon rate is equal to required return. Then bond will be at bond trades at par value. If coupon rate is less than required return, then bond trades at discount. Sir, you remember one logic correctly, everything else will fall in place. This logic is easy to remember. I want this. Bond is only giving this. I will get what I want. How will you get? Your every year cash flow is lower, but still you will get what you want. That is only possible when you have a capital gain. Who will get capital gain? Somebody who buys the bond at discount and ultimately gets maturity at par. That fellow will have a capital gain. So bond trades at discount. Okay, next. Coupon rate is more than required return. The bond trades at premium. Here important point is, this is only for observation. Not for decision making. Okay, I have questions, answer this now. You will give me decision here, sir, last concept. Okay, first scenario. Actual market price of the bond is 970. Fair value of the bond is 950. Face value of the bond is 1000. Tell me, will you buy the bond or sell the bond? Or rather answer overpriced or underpriced. General question, sir. There is no overpriced, underpriced. Bond is trading at par premium discount. First case is bouncer. Good. Bond is trading at discount, but the bond is overpriced. So in this case, answer is bond trades at discount to par. Discount means not cheaply available. The face value, if you compare, it is lower than that. But the bond is clearly overpriced. Why the bond is overpriced? Actual market price is greater than the fair value. That's the reason. Answer is what now? Buyer, seller. Don't buy. Answer is don't buy. If you want to buy, if you already have, sell the bond. Okay, next case. Tell me, sir, for discount you have compared what? These two, sorry, face value and actual price. For this one you have to compare face value, sorry, fair value and actual price. You should know which and which you are comparing. Actual market price versus fair value. These two ka comparison will give you pricing, and based on pricing only decision. At discount, par, premium are irrelevant for you. Just observation. Just given in the question to confuse you. Okay, answer this. 1030, 1040, 1000. Answer. Underpriced, overpriced? Okay, first you identified this. Okay. Now that you identified this, happily make the decision first. Something is underpriced, what will you do? Buy. Now let's calmly talk about pricing. Sorry, bond trades at par, premium, discount. Bond trades at premium. Okay, another case. 1050. Fair value also is 1050. Face value is 1000. Good. First pricing you identify. Bond is correctly priced. Since bond is correctly priced, you will definitely go and buy the bond. What about pricing? Oh, sorry, bond trades at premium. Okay, well, last case. Face value is 1000. Actual market price also 1000. Fair value is 1980. Tell. Good. Bond is overpriced. Since bond is overpriced, answer is what? Don't buy or sell. And the bond trades at par value. So just because bond is trading at par value, you should not go and buy it. Just because it is trading at discount, you should not think it is cheap. Whether it is cheap or correctly priced, that is a decision you will identify not by this, but by this. For establishing the example. Okay, do not get confused. But in a scenario where everything is correctly priced, then these both will be same. Since they both will be same, bond is always correctly priced. Since bond is always correctly priced, the answer is buy only. You not even compare with anything. Yep. Okay. Now, the example what we discussed now. Where was it? This one. You tell me the prices, sir, one by one. When required return was 12%. When required return is 10%. Bond price is how much? 1000. Par value. When required return went up to 12%. Bond price 928. What is the meaning of this is? Reliance Industries issued bond. At that time, market risk-free rate was 8%. This fellow investor, in his mind, what he thinks is required return is equal to 8 plus 2, which is equal to 10%. Is it feeling? E bond is issued at par value. Is issued at coupon of 10%. Face value is equal to 1000. Think from investor point of view, sir. Life 5 years. Think from investor's point of view. Whatever return he wants in his mind, which is 10%, that's exactly matching with the coupon rate. Correct? That means my RR and coupon rate both are same. When both are same, bond will be trading at what value? Par value. So what this company did, it could issue at par value. Par value of 1000 only will now become the market price of the bond issue price first day. Now, if the company issues at 1000, people may buy, may not buy. People will pay 1000 only if their required return and the yield, they both are matching. Otherwise, they will not buy. But here they are matching, so this fellow bought. Happy. Next day, risk-free rate increased to 10%. When risk-free rate increases like this to 10%, my required return is 10. Reliance is risky, so I want 2% more. 12%. My feeling changed off, but still the coupon rate will change or will not change? Coupon rate, why will it change? Coupon rate will not change. Life lo 1 day over 5 years lo. Life is still almost equal to 5 years. Face value will not change, still equal to 1000. You ask Ambani, you already know no interest rates will change. Fellow will say all these things are implied. Don't you know that? Fine, he knows that. You only did not know. That fellow knows. So fine, interest rate increased. Now what happens if you compute the price? Market price of the bond fell down to 928. Now why did it fell down to 928? Now this fellow, unhappy boy, he will try to sell the bond. When you try to sell the bond, you purchased yesterday only for 1000. Today if you try to sell it for 1000, nobody buys. 970, nobody is buying. 950, nobody is buying. 930, nobody is buying. 928, one fellow will enter now. One fellow will enter and buy the bond at 928. You tell me, sir, by buying the bond at 928, that new investor, will he be able to earn 12% return or not? He will get. Will our boy get? He will not get. He says offer price at 928. So this fellow managed to sell the bond to her at rupees 928. He is unhappy, but she is always happy. Why? Because she managed to buy bond at 928. By purchasing the bond at 928, she will definitely get his return of 12%. He won't get. Sir, will she be happy forever? That we can't say. After she bought, RR can further increase because risk-free rate may increase. Her Reliance company becomes more riskier, your risk premium may change. For some reason, RR can increase. Of course, it may decrease also. If it decreases, what will happen? Bond price will rise. Let's take that story also. Next day. Risk-free rate fell down by 5%. Hypothetical examples are okay. Therefore, revised required return is equal to 12 yesterday minus 5, which is equal to 7. That's only our last case now. 7%. Now, you have already calculated what is the market price of the bond? 1123. Market price of the bond crazily increased to 1123. Now, she is extremely happy now. Now, one fellow comes up to her, says, yesterday only you bought this bond for 928, no? Take 929, give up my bond. Will she give her? Why will she not give? Don't tell me market price increased. I'm asking you why she is not giving. Market price, why will it increase, sir? Only if she sells at higher price, then only market price will increase. Tell me. I offer 929. I told 1 day 1 rupee. What else you want? Give it off. Yes, no, I won't give. Why? What she tells is, see, E-bond gives a coupon of 10%. 10%. But today your required return is only 7%. When your required return is only 7, E-bond gives a return of 10, coupon of 10. So this bond has got one advantage, that it is offering more than what you want. I will only sit and enjoy. I will not give you. If you want, pay me more. Or how much more? That fellow says, I'll pay you okay, fine 1000. No. 1020. No. 1050. No. 1100. No. Then I said, okay, fine. Pay me 1200. I'll give the bond. That fellow says, get lost. If I pay you 1200, I won't even get 7% also. Because in order to earn a return of 7%, you should buy the bond only at 1123. So the investor will buy the bond only around 1123 range. If she quotes more than 1123, if somebody buys that, that fellow won't even get his 7% return. He won't buy. No fool will pay that. So the deal has to happen only at 1123. Are you understand, sir? There is a fundamental calculation and there is a market analysis also. Both you have to integrate and understand. Clear? See, multiple facets, if you understand, the advantage is you will never get confused. Down the lane, your thinking will be in the right sense. Even if by chance you get confused, some other logic will come and hit you. If you think like this, this is not matching. Again, you will rethink in the correct way. Both you have to learn. Chalo, sir. Let's move on to another question. Question number 7 is over. Come to, sorry, so 7 double printed. Okay, I'll change it to 8. Or else you call it as 7A. Okay, come here. ABC Limited has the following outstanding bond. Okay, what are the outstanding bond? Outstanding bond ka meaning is what? Bond is already issued. It's not currently being issued. It's already issued bond. Two bonds they are having. Series X bond, Series Y bond. Two bonds they are having. Series X bond has a coupon of 8%. Maturity 10 years. Series Y bond coupon is variable. Changes annually. Comparable to prevailing rate. What is the meaning of this is? Series Y bond ka coupon rate is variable. Whatever is your required return, that much coupon rate they will pay every year. Initially, these bonds were issued at their face value of 10,000 with a YTM of 8%. YTM is RR only and actual return only. Both are same. Unless there is a pricing error. Okay. So tell me this one line simple point. First day bonds are issued at face value. And a bond ka coupon rate is how much? 8%. YTM is also. YTM is actual return. Actual return and required return, everything is correctly priced. So when RR and coupon rate both are same, bond is issued at face value, par value. Your first case ka observation. That he is not asking, the question ka interpretation, all these things should be running in your mind. Then only further points of clarity will come. Clear, sir? Tell me, bond ka life is how much? 10 years. Continue, sir. Assuming that after 2 years from the date of issue, 10 years or 2 years is over. Interest on comparable bonds is 10%. Today, similar bond, if it is newly issued, they are putting a coupon rate of 10%. What's the meaning of this? Indirectly, this is your RR. Then what should be the price of each bond? So he is asking, I issued a bond with 10-year maturity. Out of 10 years, 2 years is over. Today, what is the price of the bond? Assuming that today's required return is 10% in the market. First day required return was how much? 8%. But in a span of 2 years, required return changed. Why did it change? Either the company became more riskier, therefore investor is expecting a higher return, or risk-free rates in the market have gone up and therefore investor is expecting a higher return. For what reason it increased, we do not know. But these are the only two reasons that are possible. So work out, sir. 7A. Now you tell me one small thing. Don't write anything. Just watch. Answer this. Series X bond ka coupon amount is how much? 8%. So nothing is given. Bonds are redeemable at par value only. Now, sir, he is asking you price of the bond on which date? after 2 years, not on first day. First day he only told the bond is issued at face value only. So you are standing here, sir. Second year ending lo you are standing. Now, what is the price of the bond on this date? Tell. Price of the bond on any date is what? Present value of future cash inflows. Future cash inflows means which cash inflows? Starting from? You are standing at the end of second year now. Third year, future cash flow, not past cash flows. What is already received, for that why will anybody pay money, sir? Future receivables today you can invest. So which cash flows have to discount? From third year to 10th year ka cash flows. Discounted it. Required return of today. How much required return? 10%. Now, my question only in this is only one thing, sir. Annuity factor, how will you take? That's all is the question. Okay, tell me. Annuity factor, how will you take? Okay, look at this. Is equal to. I will write two things. You tell me which one is right. 10%, 3 to 10 years, plus 10,000 into PVIF, 10%, 10th year. This is right, huh? Or which one is right? First one, second one. How many of you say first one? 1, 2, only 2, 3, 4, 5, 6, 7. Remaining all balancing figure. Huh? Second option. Okay, second option answers. Some people who don't raise in both the cases, I will get another answer. Wait for you. 1, 2, 3, 4, 5. Papa, no idea. Okay, look at this. If you are using this answer, if you are saying this answer, you know what is the meaning of this? You are saying that from today, the first cash flow starts from third year. And it comes third year, fourth year, fifth year, sixth year, up to 10th year. And I am standing at 0. Tell me, I am standing at 0 time, huh? Means in the above timeline. I am already standing at second year ending. My first cash flow starts when now? Third year ending. Third year ending is how far from me? 1 year. E 10,000 is how far from you? 8 years. So you have to discount 10,000 by how many years? 8 years. So which one is right? Second one is right. Sir, but in, sir, your doubt is only this. You wrote 0, no sir. 1, 2, sir, this is life of the bond. A 0, 1, 2, 3, whatever I wrote, that is life of the bond, term of the bond. Time value of money, they are not the time value points. Time value points are these. Wherever you are standing, that is 0. This particular sum ka objective is to make you differentiate between life of the bond versus your timeline. Life of the bond 10 years, but already 2 years is over. You are standing at the end of second year. Remaining life is 8 years. Wherever you stand, that becomes 0 point. 0 means now. So tell me, sir, 10,000 rupees is how far from you? 8 years far from you. So discounting has to be done with 8 years. This 800 is how far from you? This 800. This is just 1 year far from you. So you have to discount it only by 1 year. So this 1 year, the 2 years, the 3 years, the 4 years, this by 8 years. Now, what are trap in this? These two trap. Don't touch this. Why? These are past cash flows. Therefore, ignore. Chalo, copy this fast. Make lot of mistakes, sir. Lot of mistakes. If you make only, you will learn. Be happily make mistakes. Nothing to worry. These are all time value of money concepts, sir. More mistakes you make, more clarity will come. Wherever you stand, that becomes 0 point for you. Life of the bond different. Your timeline different. As 0, 1, 2, 3, 4 up to 10 whatever I wrote as life of the bond. 0 to 8 what I wrote, that is your timeline. So these are all future cash flows. Okay, answer please, final answer. 800 into final answer 89 32.92. Okay, 33 you make. Chiller, leave it. If it is right decimals also, nothing will happen. You need not pay, no, you just have to write. That's okay. This is series X bond. Series Y bond next. Series Y bond loan beauty is there. What is that? Coupon rate is variable and it will be always equal to required return. Since coupon rate and required return both are same, what will happen to bond price? Bond trades at par value. Bond trades at par value. That's it. Now, do I need not compute? You have to compute, but you should know the answer beforehand because you're smart. Can't help it, no. Price of series Y bond today is equal to, what is the coupon? 10,000 into 10% into PVIFA 10% 8 periods plus 10,000 into PVIF 10% 8th period. 1000 into 5.3349 plus 10,000 into 0.4665. How much are you having, sir? Over, sir. Cool. See, what did I change? You are getting comfortable with table. We change the format. This time I wrote in a line equation. Earlier we were drafting table. You, sir, don't get attached to anything. Learn everything. Whatever you like, you do. You will have options. Chalo, next question, please. Second bit. If after 2 additional years, already 2 years over, now another 2 years are also over. So total how many years are over? 4. The remaining is 6 years. The interest on comparable bonds is 7%. Oh, today RR is 7%. What should be the price of each bond? Hello, sir. Second bit. After 4 years, required return is now 7%. Remaining life of the bonds is equal to 6 years. Sir, bond price ki you have to take future cash flows. Future cash flow means remaining maturity, not original maturity. From wherever you stand, future cash flows discount. Past cash flows, how can you discount into today's value? Future cash flows only you have to discount. Chalo. Series X bond. Is equal to, this fellow's coupon is 800 into PVIFA 7% up to 6 years plus 10,000 into PVIF 7% 6th period, which is 800 into first write PV factor, then GT it 4.7665. Tell me, sir, bond will be trading at par premium discount. Don't solve and tell. Don't solve and tell. Without solving, tell. Bond will be trading at par premium discount. What's the coupon rate? 8. Required return? 7. So coupon rate is more than your required return. Bond will be trading at premium to the par value. What happened now? Okay. 10,447 is what I got. You also should get the same number here. 476 you got. Why did you get differently? I wrote something wrong, huh? 666 6634. Oh, I'm sorry. Then it will be 6663. Okay, sir. Sir, if you spot that kind of mistakes, no, you should tell me spot law immediately. You are not motivated, I'll give you some prize also for that, for identifying errors. Spelling mistakes I will not give. Okay. Series Y bond. What is the coupon rate? Is equal to required return is equal to 7%. Price of the bond is equal to 10,000 face value into 7% coupon rate into PVIFA 7% up to 6 years plus 10,000 into PVIF 7% 6th period 700 into 4.7665 plus 10,000 into 0.6663. See, in case we know the answer, but still naturally whatever comes, write that. Third question he is asking, what is the conclusions you draw from the price of each of the bonds computed above? What conclusion did you draw from this? One conclusion is very clear about series Y bond. What is that conclusion? A series Y bond ka coupon rate always will be equal to required return, and therefore that bond always trades at par value only. So series Y bond ka conclusion is over. What about series X? Series X bond ka coupon rate is fixed. It won't change. Since it won't change, market level when required return changes, e bond price also will change. Either it will be trading at par, premium or discount depending on what is the required return in the market. So, right sir. Conclusion. Series Y bond always trades at par value as its coupon rate is equal to required return or yield always. Series X bond X bonds price fluctuates depending on the required return market. If required return increases, what will happen to bond price? If required return increases, what will happen to bond price? Bond price will rise or fall? Okay. If required return falls, bond price will rise. Sir, you should have multiple comfort zones here. Why bond price will fall when required return rises? For that, when required return increases, existing investor will not like the bond. He will try to sell the bond. Nobody will buy the bond, and therefore he has to sell the bond at a lower price. Somebody who buys the bond at lower price, he will be able to get his revised required return. Therefore, bond price falls. This is bigger logic, small logic. Required return is discounting rate. When you increase the discounting rate, present value will decrease. Any which way, mathematically, conceptually, somehow we remember this. So this only is actually my next concept. Relation between bond price and discounting rate. Bond price and discounting rate are inversely proportional. Required return, yield, discounting rate, whatever name you want to give, you give. If it increases, discounting rate, if you increase, present value will decrease. Discounting means deducting, and a meaning I told you while doing time value of money concept. So if you decrease more, obviously price of the bond will fall down today. If required return decreases, then bond price will increase. Inverse relationship they will enjoy. Next. Key point, yesterday I told you this. If the future cash flows of the bond are discounted with the required return, then the result is called as fair price of the bond or fair value of the bond. If the future cash flows of the bond are discounted with actual return, which is called as yield to maturity, then the result also will represent the actual market price of the bond. It is already concluded discussion only yesterday. Okay, let's see what other questions are there. If nothing is there, we'll move on to next concept. Okay. This is all. Come to ninth question. Ninth question also you can do, but that is okay. Go through it. Not do it. We'll go through and finish it off. IBA Bank had issued a tax-saving bond carrying an interest rate of 8% on face value of rupees 10,000 rupees per bond with 6 years to maturity and interest payable each year. Well, 10,000 rupees face value, coupon rate is 8%, 6 years life. So who is VV Finance? Change the name. IBA Bank. Okay, wait, no. It's a different company. I'm sorry. VV Finance had also issued a tax-saving bond of 10,000 rupees each with 8 years to maturity, carrying a coupon rate of 6%. Okay, fine. So two different companies issued two different bonds. Okay, but maturity periods are different. Here it is 6 years. Here it is 8 years. Here coupon is 8. Here coupon is 6. Face value alone is same. Today, that is after 2 years from the issue date. Okay. When a new bond with 6 years to maturity carries a coupon rate of 7%, this is your required return today, and a bond with 8 years maturity carries a coupon rate of 5%, means is required return today for the second bond, and both these bonds are priced correctly. Okay, which is cheaper to buy and how many bonds can be bought for 5 lakh rupees? Assume part of a bond also can be bought. First of all, sir, if you think too much, you will get confused. Focus only on first bond first. First bond ka life was how much originally? 6 years. 6 years to maturity. And second bond has a life of 8 years. And out of the maturity period, few years are already completed. How many years are over? 2 years are already over. Today, what is the latest required return given? 7 and 5 for each of the bond respectively. He is asking, the bonds are priced correctly. So there is no overpricing, underpricing kind of scenarios. Both the bonds are equally good. You can buy any bond. But between these two, which bond should I buy is what he is asking, based on which one is cheaper. Cheaper means what? Whose price is lower, a bond you have to buy. That's the answer. Between these two, which bond is costing me cheap? How will I know? Have to compute the bond price, no? So compute what is there. Tell me, sir. Come to first bond. First bond ka remaining maturity is how much? 6 years original. Now 2 years is over, no? So remaining maturity here is 4 years. Second bond. Original maturity was 8. Out of the 2 is over. Remaining maturity is 6. You have to always consider only the remaining maturity period, not the original maturity period. Original maturity period is computed when you are standing on first day issue date price. If you are computing, then original maturity date. If you are standing in the middle of the bond life, then remaining maturity life. Clear? Future cash flows means from today, whatever is going to come that. Okay, what you have to do now? Here 4 years ka coupons, here 6 years ka coupons, discount it. Maturity value also discount it. With discounting rates given already to you. For the first bond you will apply 7%, second bond you will apply 5%. Revised required returns. Chalo, work out the price of the bond. When you work out, you are getting 10,340, 10,506. Between these two, which one is cheaper is what he is asking. Between two companies' bonds, which one is cheaper? First one, 10,340. So go and buy that bond. This is not decision making question. This is not whether bond is correctly priced, underpriced, overpriced. It is not that kind of question. Bond is correctly priced in question only they are telling. So that is never your problem. Between these two companies, which bond is available at a cheaper price? First company ka bond. So he is asking how many bonds can you buy with an amount of 5 lakh rupees. Take 5 lakh rupees on your calculator ma and divide with 10,340. 48.351. That's all. Cheap question only, but exam range question only. Sir, our exam cheap questions are coming. Yes, sir. What can I do for that? Sir, you learn so much. But just because you know so much, high level question need not come. Exam, sir, do you guess how many marks this question can come? Yes. Yeah. 7 marks minimum it will come. All you have to do is this. One line, one bond ka price, another line, another bond ka price. Whichever is cheaper. Take that bond ka price, 5 lakhs, divide it, get the answer. Over 7 marks. You understand, sir? Concept clarity should be there. Nice. Move on. Next. Yield came off. Nice. Okay. Next concept, sir. Sir, till now you are working out price of the bond. From here after you will see in almost all the questions price they will only give you. Sir, price they only gives us what will we compute? Yield. You have to compute the return. So here onwards the concept is yield calculation. Now what is the meaning of the word, plain meaning of the word yield? Now the word yield means it is a return expressed in percentage terms. Return expressed in percentage terms is called as yield. Now, if there is only one kind of yield, life would have been simple. But you have multiple yields in a bond. First one is called as current yield. Second one is called as holding period return. Third one is called as yield to maturity. Fourth one is called as yield to call. Fifth one is called as yield to put. One by one we have to cover. And among all this fellow is a hero. It means, sir, these are all side characters. You have to learn everything. Questions will come on this cheap sum also. Anyway, before we go further, write one small thing here. Simple. Is it difficult, sir? Simple means not that simple. This simple return. This is simple and it can be compounded also. Current yield is a simple return, sir. Holding period both are possible. Last 3 are definitely compounded returns. Compounded return means time value of money you have to consider and play. Reinvestment, return on income, everything is there in this. Let's start with the first one, easiest one. Current yield is equal to coupon amount in next 12 months divided by market price of the bond into 100. Coupon amount in the next 12 months divided by price of the bond into 100. This technique computes yield earned only in the form of coupons, and it ignores time value of money. It is very important to know that current yield is a simple return and it considers only a span of 1 year. We consider a time frame of only 1 year. Sir, there is a 4-year-old bond, 4-year maturity bond. The bond cash flows are like this. You will get 100 here, 100 here, 100 here, and here. And here you will get 1000 maturity value also. Today, price of the bond is 980. One year is over. After 1 year, price of the bond is 1020. My question is very simple to you. In the first 1 year, how much return did you earn? On your calculator. How much return did you earn in the first 1 year? I will not give you any formula and all. Just try on your own and tell me the return. Only 1 year. 100 rupees is definitely your return. Plus 980 you purchase the bond, it became how much? 1020. There is an increase of how much? 40. That is also return only, no? So 100 plus 40 divided by your initial investment is how much? 980 into 100. 14 to 8. Ideally this should be the return. Okay, ma'am? But current yield ignores capital gains. It considers only coupon rate, coupon amount only. So what I should remove now? The answer is 100 by 980 into 100. That is the current yield. So current yield technique is 100 divided by 980 into 100. $10.20. Because this is that. Next. In this only another example. Watch this. Zero. Bond market price today, let's say, is 100. At 6 months time, it pays a coupon of let's say 8 rupees. At 12 months time, it pays again a coupon of 8 rupees. And life is, it goes on. Current yield is equal to, denominator is fine, market price 100. Percentage I want, so answer is again multiply with 100. Numerator what I should take? 8 plus 8 or 8 plus present value of 8 or present value of 2 8s. First and foremost, forget about discounting. There is no time value of money concept here. The next question is, should I this is semi-annual bond apparently, so you will still have to consider full 1 year. So numerator will be 8 plus 8. Answer is, sir, what each technique is trying to tell you that you should have clarity. Current yield technique considers return earned only in the form of coupons for the next 1 year only. So answer is how much? 16%. That's all. This is the current yield story. On these questions are there, we will do a cheap question. This I will not make you do immediately and insult you. We'll go to the next concept. Who's this next technique, sir, in the order? Holding period return. Okay. Holding period return. It computes return from date of purchase of bond till the date of sale of the bond. HPR can be computed in simple return terms or in compounded terms. The question will tell you which one you have to do, sir. Nothing is given. Generally, we prefer simple terms. Now, so there is a bond which is paying a coupons of 80 every year, like that for a period of 5 years. What our investor did is, here he bought the bond at rupees 950, and here sold the bond at rupees 1000. So even though the maturity period is 5 years, this fellow held the bond only for a period of 3 years. So if you compute return from first year, second year, third year combined, that is called as holding period return, from the date of purchase to date of sale. Now, holding period return, simple terms, the time value of money we ignore, is total coupons received plus sale value minus purchase price, you can say, initial investment, you can say, whatever you want. Divided by initial investment into 100. So total coupon received in 3 years is how much? 80 plus 80 plus 80. You observe first 80 first year, second 80 second year, third 80 third year. They are standing at different points of time, but we ignore time value of money under simple return, so I directly add them. Plus sale value 1000. Initial investment 950. 50 rupees capital gain is also there. Divided by my initial investment is 950 into 100. This is your holding period return ka answer. Tell me one small thing. This 30.53% is for all 3 years put together, only for 1 year, ante each year. 3 years combined or per annum అది? Combined or per annum? Combined. How do you know that? Look at the numerator. You clubbed 1 year ka interest or 3 years ka interest? 3 years ka interest. Capital gain you earned in 1 year over a period of 3 years? Over a period of 3 years. So numerator of whatever return amount you wrote, a return amount is for 3 years ka return. Combined return. Therefore the percentage also is combined return. So this is your HPR for 3 years. HPR per annum. Nobody will ask you, sir, but as such, if somebody asks you, then you just proportionately calculate it. How to compute proportionately? 30.53% is for how many years? 3 years. Divide by 3, multiply with 1. 17 or 18? 18. Well, this is how you do holding period return. Now, holding period return compounded is similar to YTM. So similar to YTM means how will we know now? You will not know, simple. We'll work out YTM. Once you understand how to compute YTM, holding period return, compounded terms, automatically you will know. If I discuss of holding period and compounded terms now only, then YTM there won't be anything left to discuss. The small cute concept, sir. YTM we cover, then we'll come back and discuss again if you want. Okay. Now, on this some small cheap questions are there. Finish it off fast. Respect your study material. Question number 11. Do first one. Face value of the bond is 1000. Fantastic. Coupon rate is 6%. Okay. Current market price is 900. Current yield he is asking. Current yield formula is what? Coupon amount divided by market price. Coupon amount is how much? 60. Market price is how much? 900 into 100. 6.67. Come here. A 13% bond, interest payable annually, is issued at 100. Okay. Issue price irrelevant for you. Its market price is 112. Issued at the 100, and why he is telling you is indirectly, generally bonds are issued at par value only, no. So he is indirectly telling you that this is the par value. Market price today is 112. Bond yield ki we don't want par value, we want only price, because investment will happen at price of the bond. Calculate the current yield if it matures in 5 years. Let it mature in 55 years also. Current yield will consider only a time frame of next 1 year from wherever you are standing. Formula is what? Coupon amount. Coupon amount is how much? 100 into 13%. 13 rupees divided by 112 into 100. That's 11.60. Well, next one. Also calculate current yield if it is semi-annual bond. If it is semi-annual bond, you won't get 13 rupees. You will get 6.5, 6.5. But still, I ignore time value of money. So still I will go and club 6.5 plus 6.5. Again my answer will be same. Clear, sir? Next, come here. Are a question solve in your notes? Something you should have, no? Otherwise it look like I'm solving everything in air. Read. A had purchased a bond at a price of 800 rupees with a coupon payment of 150 rupees and sold for 1000 rupees. Oh, 800 you bought, 1000 you sold. E gap la 150 rupees coupon you got. He is asking what is your holding period return. In your notes, sir, please write the answer. Formula not required. Directly answer you write. Holding period return is equal to, tell me sir, what is the coupon you received? 150 rupees plus sale price 1000 minus 800, the capital gain. it abides capital gain. Whole divided by, what is your initial investment? 800 into 100. Well. How much? 43.75%. Well, next one. If the bond is sold for 750 rupees, after receiving 150 rupees as coupon payment, what is the holding period return? So he's now changing the sale price. Instead of you selling it for 1000, you sold it only for 750. So it will be 150 plus 750 minus 800. What is happening? 150 rupees coupons you received, or 50 rupees capital loss you suffered. Net return is only 100 rupees for you on your investment of 800. 100 by 800 into 100, 12.5%. This is study mat question, cheap one. You insult yourself. Kanna purchased 1000 rupees par value bond for 950. Coupon payment is 90 rupees. 1 year later, he sells the bond for 900. Find out his rate of return. Can we handle this? Okay. Hereafter, the story of YTMs. Okay, guys. Now that we are done with current yield and holding period return, now coming to the main technique, which is called as yield to maturity. Now first understand the characteristics of yield to maturity, then we will do the question. Sir, in a very simple terms, if I should explain yield to maturity, this is nothing but IRR. Okay, now formal definition is, it is a return earned by investor if he holds the bond till maturity date. If you hold the bond till the maturity date, overall return earned by the investor is called as YTM. It's measured in compounded terms. So broadly what will happen is, let's say there is a 5 years bond. This is your initial investment. Your initial investment is price of the bond. Future cash flows are coupons. Plus also maturity value. So these are all your future cash inflows. Now, what is IRR is, what is IRR discussion, sir? What did we learn? IRR is that discounting rate which equates the present value of future cash inflows to present value of future cash outflows. Here, what is the future cash outflow? Sorry, present value of outflow is what? Price of the bond. Future cash inflows are what? Coupons and maturity value. So your job here is to work out a discounting rate at what discounting rate this present value will be equal to price of the bond. That discounting rate, if you identify, that we call it as yield to maturity. This discounting rate at which PV of cash inflows will be equal to PV of cash outflows. The discounting rate which equates coupon payments and maturity value to the price of the bond today, that rate is called as YTM. Now how will we work out this rate? How did we learn this? When, see, if there is a single point inflow, single point outflow, we have a shortcut formula. This is not that, because there are multiple cash flows in future. So you can't apply square root of inflow by outflow minus 1. Our formula will not work. So you have only one option, trial and error. So to be computed using trial and error approach. What is the meaning of trial and error approach? First, randomly we try at some rate. We will see whether it is matching or not. If it is matching, luckily, that's all. That is your YTM. If it doesn't match, try at some other rate. Try at some other rate. Go to that kind of iterations where one present value will be higher than the price of the bond, one will be lower than the price of the bond. Then you sit and interpolate that. Just like how you computed IRR, same style you got to do this one also. But having said that, there is a small shortcut for you. Approximate YTM can be calculated using following formula. A trial rate where to start with. For that there is one small technique. It's called as approximate YTM. Now approximate YTM formula is this. Take the coupon amount, to that coupon amount add maturity value minus spot price of the bond divided by life of the bond, whole divided by spot price plus maturity value divided by 2 into 100. This is one model of working out approximate YTM answer. There is one more formula that also you can use. Slightly different answer you will get. In fact, the second formula is more appropriate than the first one. But most of the books the first one is used. But CMA study matter they have used both the formulas. Second formula is more convenient actually. Maturity value minus spot price divided by life of the bond, whole divided by 0.6 into spot price plus 0.4 into maturity value into 100. So between these two, which formula to be used? Remember, both the formulas will not give you same answer. There will be different answers, but remember both are approximate YTMs. They are not correct YTMs. Correct YTM, if you want, you take clue from this and do 1 or 2 trials and then go and interpolate it. Work out proper IRR. That's how you work out correct YTM. But I checked all your study material. 99.99% of the questions, wherever they ask you to compute YTM, they are leaving the solution just by doing this. Nobody is computing entire full trial and error YTM. So you take a call looking at the how many marks it's awarded for. If it's a 4 marks, 2 marks kind of question, this would suffice. If it's 6 marks or something like that, then you work out trials and all. I will do both for you. In few questions we'll solve everything and then after we'll settle down with this. Right? So this is how we handle it, sir. E formula is important. Now E formula ka logic is what? No big logic, sir. Watch this. This is coupon amount. Every year cash inflow. What is this numerator here? This double numerator. Maturity value minus spot price ka meaning is what? I purchase the bond, let's say 950 rupees. Maturity value is 1000 rupees. How much capital gain? 50 rupees over a period of 5 years. And the per annum capital gain is how much? 10 rupees. So this is per annum capital gain. This is per annum coupon amount. Numerator is what? Per annum written in amount terms divided by your initial investment. Actually invested what? Spot price. But instead of taking spot price, we take an average of spot price and maturity value. This is simple average. This is weighted average. By taking divided by 2 means what, sir? You are multiplying this also with 0.5, this also you are multiplying with 0.5. If you multiply this with 0.6 and 0.4, this is second formula. That's all. There is no difference between first formula and second formula except the denominator. Let me tell you, both are wrong answers only. They are not 100% accurate YTMs. But a second answer will be very near to your actual YTM. That we will prove and I'll show it to you. Let's pick up a question for that. Question number 11 you take. If the market price of the bond is 95, years to maturity is 6 years, coupon rate is 13% per annum paid annually, and issued price is 100. Issued price and a word ke earlier also I told you the meaning. This is nothing but face value. Because generally bonds are issued at face value, that's why he is calling it as issued price. Issued in past tense, once upon a time issued. Today market price is 95. He is asking what is the yield to maturity. So let's solve this, sir. Question number 11. All this is not required. Approximate YTM is equal to coupon amount. Coupon amount 100 rupees into 13%. Just 13 plus maturity, nothing is given, par value, minus market price today 95 divided by life of the bond 6 years, whole divided by. In the first formula take simple average, second formula take weighted average. Both will give you nearly correct answers only. I am taking simple average first. 0.5 into 95 plus 0.5 into 100 into 100. Carefully solve this. So that is 5 divided by 6 plus 13. How much are having? 14.188. 88%. Sir, this per annum, let's say entire 5 years ka, or entire 6 years ka, per annum. How do you know it's per annum? Because numerator we took return of only 1 year. Earlier holding period return when we did, entire 3 years ka returns we took. Therefore, it's a cumulative return. This is per annum return. Okay. So this is first formula. Do the other version also. $13 plus 100 minus 95 by 6. 0.6 into 95 plus 0.4 into 100 into 100. That's 13.833 divided by 97 into 100. Okay, 14.26%. Observe this. This and this is not same, but that is near only, no? One is 14.19%, the other one is 14.26%, 0.07% difference. Both are approximate answers only. So if you want the correct answer, what I will do, I will have to do trial and error. So correct accurate YTM. Trial 1. Let me check what I wrote in the notes. Okay. Fine. Trial 1. Discount bond cash flows at the rate of 14.26%. What's the life of the bond given? 6 years. Every year 13 rupees cash flow, last 100 will come. 1 divided by 1.1426. 1, 2, 3, 4, 5, 6. 0.4494. $8611, sorry. Sir, I got PV of cash inflows is equal to 95.13. What is the actual market price of the bond? This is the question. 95. How much did I get? 95.13. Almost it is 95 only, no? You can say that this is almost equal to current market price of the bond, and therefore this is your final IRR. You can close like that, but I don't want to close. I want accurate answer. So this is not equal to current market price of rupees 95. You tell me, sir, even after discounting with 14.26% also, the number is not coming to 95. It's still standing at 95.13. Tell me, the IRR is higher than 14.26, lower? Higher or lower? Higher. You want the present value to reduce. So discounting rate has to increase. So let's try at some other rate. Bond cash flows at 14.5%. I'm trying. If you try with 14.5%, how much is this? 1 divided by 1.1450. 0.4438. If you check this, I am having 94.25. So here this is lower than current market price of rupees 95. What it means is, from previous trial we concluded that the bond gives a return more than 14.25%. Now I know that it is giving a return less than 14.5%. So your actual return is lying between what and what? Between 14.26 and 14.5. You have to just interpolate and get the answer. That's it. Over. Tell me, sir, at 14.26%, PV of cash inflows was 95.13. You can be happy with that only, actually. That's very small error, but that's okay. We'll do it. 14.50%. PV of cash inflows is 94.25. So what you have to observe is, when I increased the discounting rate by 0.24%, PV of cash inflows will definitely decrease, of course. Decreased by 95.13 minus 94.25, 0.88 rupees. How much decrease do I want? For a decrease of 0.13 rupees, this should increase by how much? Cross multiply. Careful while doing this. Don't apply the percentage symbol. This symbol, just write like that. Don't apply. 0.24 into 0.13 divided by 0.88. 0.03545 percentage. Sir, this percentage. My final answer should be in percentage. So don't apply this on this. If you apply it again, it will become double decimal. Sir, you have to again convert. Don't apply. Directly simply multiply and leave it. So tell me, sir, what is your YTM now? What is the meaning of this? This much increase you want. So YTM is equal to 14.26 plus 0.03545. Yeah, 14.2955 or 35. Roughly 14.30. What is that? This is your accurate, correct YTM, sir. The perfect answer, this one is. From this, what is the proof is, both the approximate YTMs are wrong. But the second one is almost near. First one answer is how much, ma? 14.18. This is 14.26. Actually is how much? 14.30. Which one is near? Second formula. So if the question asks you YTM for a 3 marks or a 4 marks, don't solve all this. Just write the second formula and you stop your answer here. Over. Clear, sir? Sir, anyway, when we are going to stop here only, why to discuss this entire thing? Some questions now they have asked specifically that you have to do the entire YTM. So we need to know, but see, sir, in any question, if you solve this part, you will invest extra 5 minutes and solve. That is not wrong. No, this is still okay. This is 100% right, in fact. The question expects only this much. Do only this much and leave. Chalo, move on to the next question. Tax effect. Tax effect we will do in some time. 1 second. Please come here. Question number 16, please. Question number 16. A AAA rated bond of face value 1000 is currently quoting in the market at 1062. Market price is given to you. The coupon rate of the bond is 14%, but it is payable semi-annually. Okay, nice. The remaining maturity of the bond is 5 years. Fine. 5 years means how many coupon payments are there? Semi-annual bond, 10. And the principal is repayable in 2 equal installments at the end of 4th year and 5th year from now. That means your maturity value, maturity amount is not given at the end. It is given in 4th year and 5th year. Continue. Find out the YTM of the bond. Now, is one small problem we are facing now. What is that problem? Maturity value is not coming at the end of the 5th year. It is coming partly in 4th year and partly in 5th year. Because of that, what problem I will face now is, it is difficult to at the end of 4th year and 5th year from now. Correct. So with this, what is the problem we will face is, since your cash flows are not falling in this kind of pattern, E formula will not work. E formula will work only when the cash flows pattern is like this. Maturity is payable at the end. Then only this will work. If maturity is coming in between only, then that will not work. So then how to do? How to do? You don't have a choice now. You have to do literal pure trial and error. That's the reason interpolation you have to learn. Okay. So start, sir. What is the question number, sir? 16. Okay. Right, sir. Bond life is 5 years. Semi-annual bond. Therefore, 10 periods of 6 months each. 10 periods of 6 months each. Now, let's do one thing. Period. Cash inflows. Sir, since 5-year bond, so total 10 periods are there. Your coupon rate is given as how much more? 14%. 14%. So since it's a half yearly bond, you have to consider only 7%. On your face value of how much? 1000. Now, carefully observe. First year, you will pay, first year, second year, third year, fourth year, fifth year. In this, up to 4 years, there is no problem. But fourth year ending, sir, a portion of principal is getting repaid. Now that a portion of principal is getting repaid, in the fifth year, the 2 interests, whatever you are going to receive, the 2 interests will be computed only on the remaining principal amount. What is the face value of the bond? 1000 lesser 500 you will get at the end of fourth year. Another 500 you will get at the end of fifth year. So throughout first year, second year, third year, fourth year, you will get coupon calculations on 1000. But in the last 1 year, coupon calculations will be made only on 500 rupees because 500 is already paid. Are you able to spot this? If you spot this, half of the job done now. Now what you have to do is, watch this first, at once you can write. I am writing 1 to 8. 1 to 8 means end of which year? Good. Up to end of year 4. Your coupon amounts are 1000 into 7%, which is equal to 770. Next, 8th year ending, you are having a principal payment 500. This is how much? 1000 half 50%. Then (9) and 10, you will have payments of 500 into 7%, which is how much, sir? 35. Correct. 10th period you will get another 500. Sir, all of you, did you understand the calculation of cash flows there? Cash flows, if you get discounting rate, if not 2 trails, 5 trails, I will do, somehow I will get it. Cash flows, a mistake is there, the entire effort is wasted. Okay, first is the semi-annual bond and principal payment is happening twice, not at the end. That's the reason shortcut formula cannot be applied. A note I will make you write later on. Now, a question about data is given. Fine. So this fellow, look at the price. Market price he gave you. What is the market price given? 1062. Tell me, sir, bond trading at 1062 means it is trading at par, premium, discount. Face value is how much? Market bond price is how much? 1062. So I am not asking for decision making. Ignore decision making. Nobody is asking you to make a decision. Simply compare with face value. Tell me bond is trading at par, premium, discount. Premium. Now carefully answer my question. When will bond trade at premium? Actual price is more than face value, that is visible there. Okay, that's okay. But which scenario it will trade at premium? Required return is less than the coupon rate. Correct? What is the coupon rate? So per period it is 7%. So your required return or your yield rate is less than that. Since it is less than that, only bond will be trading at premium. You understand, sir, why we discussed that concept? A concept is not for decision making, it's for catching where the YTM is standing. Bond is trading at premium. Bond trades at premium only in the third case. Third case is which case? Your required return is less and coupon rate is higher. So coupon rate is 7. So required return should be something less than 7. Otherwise a bond will never trade at premium. Sir, less than 7 how much? I do not know. What will I do? Trial. So do one try. 6% give try. A study mat answer, sir, that fellow directly took 6% iteration and tried off. 6% logic is what? Illogic. Illogic, if you have to learn, a entire knowledge you should have. Bond trading at premium means the coupon rate is higher than the required return. And therefore, if you want to catch your required return or the YTM, you have to go below the coupon rate. Coupon rate is 7% effectively now. So go below 7%. That's the reason. Okay, ma? So try. So PV factors at 6%. PV of cash flows. Definitely I will fail here. Then PV factors at 7%. Here also I will fail. And then I will interpolate. Carefully write the table till now and slowly work out the annuity factors, PV factors, mid annuity factors, all this work out. All the investment in time value of money, full paisa vasool ee chapter. Can you tell me this one? 9 and 10 ka annuity factor. 9 and 10 ka annuity factor, how to work out? Work out 9th year PV factor, M plus it. Work out 10th year PV factor, M plus it and MRC. That is coming down to 1 point. You are making me doubt my calculator. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1.1503. Slowly work out this. Don't fill up individual numbers. Directly do it. Trial anyway. That's not correct answer also. 70 into 6.2098. 500 into 0.6274. 35 into 1.1503. How much are you having? 10? 84585 I am taking. What is the actual market price given? Question. 1062. YTM is greater than 6%. Your return is more than 6%. Because if you work out the NPV now, the PV of cash inflow, PV of cash outflow, NPV is positive. If NPV is positive, what does it indicate? Your IRR is more than your discounting rate. So you have to try something more than 6%. You can do it 6.5% also actually. There is no need for you to go up to 7% also. You can try it 6.5 for a more accurate answer. So I'm changing it. Sorry, I wrote 7 originally. I'm changing it to 6.5%. One divided by 1.065. 1, 2, 3, 4, 5, 6, 7, 8. But these are half yearly payments. No one I'm getting doubt. That's okay. It is 6.08875 is 8 only. Okay. Then 1 divided by 1.065. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 0.5327. 1.10. Perfect. Total it up. And pray to God that this should go below 1062. It went 1033.17. So your PV of cash inflows now went lower than actual market price of 1062. What is the proof? What is the conclusion of this? Therefore, YTM is less than 7%. So from this, not 7, 6.5. So from this, the conclusion is your YTM lies between what and what? 6 and 6.5. You just have to interpolate and get the answer. That's it. At 6%, PV of cash inflows was 1067.85. At 6.5%, PV of cash inflows is 1033.17. For an increase of 0.5%, we observed a decrease in PV of cash inflows. $34.68. 34.68 rupees fallen down. How much do I want? Desired decrease in PV of cash inflows is 1067.85. Should come down to 1062. So all I want is only a change of 5.85 rupees. So here how much should I increase? Is equal to cross multiply 0.5 into 5.85 divided by 34.68. 0.084%. Cross multiplication simply. Don't apply the percentage directly there. Percentage treat it as a symbol and write there. Therefore, finally, your YTM is equal to 6 plus 0.084. 6.084%. This is your final answer. The answer printed there will be slightly different because they interpolated 6 and 7. What did I tell you? If the gap is large, the answer will be less accurate. For interpolations, gap should be as small as possible. We took a gap of 0.5. That fellow took a gap of 1%. His answer will be slightly different, but our answer is obviously more right. Of course, you should not forget that this is YTM for 6 months period. Annualize it. Annualized YTM is equal to 6.084 is for 6 months. How much is it for 12 months? 12.168. That's it. You see here, this is a proper accurate YTM. In this, there is no approximate formula and all. It's all in the time value of money, sir. How detailedly, properly you learn there, things will become so smooth. If you understand now, it's as good as you know it. Only thing is you have to practice it. But understanding ki blood is time value of money. Okay. Now, a couple of note points you write here. It will be safe for you. Later on, it will be easy for you to understand. Note point 1. Coupons up to 8th period is equal to 1000 into 14% into 6 by 12, which is equal to 70. At end of 8th period, which is nothing but 4th year, repayment of rupees 500. Therefore, coupons in 9th and 10th period will be, out of the total face value 1000, 500 is repaid. On the remainder 500, 14% 6 by 12. That is equal to rupees 35. Note point 2. Since the maturity value is not repaid in lump sum at the end of year 5, but partly in year 4 and partly in year 5, we did not apply approximate YTM formula. Guess what? If you apply approximate YTM formula also, you will almost get the same answer. It won't cheat you here. Only thing is, it won't be as accurate as you got previously. But you will get confused because there is no one coupon. Out of 10 periods, 8 periods ke coupon is 70 rupees, 2 periods ke coupon is 35. You have to mix everything and take average coupon there instead of coupon per annum. So why to create a new formula and all? Anyway, that's an approximate answer. So I worked out the entire thing, which is how they have also worked out. The major note point what I want to make you write is this one. For each 6 months, the bond pays a coupon of 7%. The bond is trading at premium. The bond is trading at premium. It means that the required return oblique YTM, they both are same now. When bond is correctly priced, everything is same, is less than the coupon rate. Therefore, our first trial was at 6%. Sir, in this note point 2 and note point 3 are not for exam purposes. That's for inside. For your understanding, I made you write. Don't write all these in exam. Nobody wants to know your feelings. Answer is enough. Sir, these are all looking good now, but after you become more comfortable with all these concepts, they look very silly. I wrote this also and a feeling will come. It has to come ideally. Okay, so it's time value of money, sir. Just you are still learning. Nothing wrong. Slowly accumulate. Next question. Peeps wrote, all of you? 16th one is sorted. Now, I'll show you, see, this is heights, your study material went one notch up higher. Read this. ABC has provided following information. What information? Annual interest payment is 60. Par value of the bond is 995. Okay, what is that stupid number? We don't know. Current market price is 700. Years to maturity, 5 years. Find out YTM. Now the question asks you YTM, you have to work out YTM and give no. What that fellow did you see? Excel sheet la formula he applied, it seems. Not my answer. Study mat answer. I just simply copied from there. 14.68. Excel sheet exam nobody will give you no. So shortcut formula. I plus F minus P divided by N divided by 0.4 plus 0.6. What is this? Approximate YTM formula 2. If you apply that, you got 14.54. This is not accurate, but this is almost near to the correct YTM. Are you understanding, sir, what is happening there? Till now in the questions, 2 questions what we solved, we worked out approximate also, full also. This fellow worked out full using Excel sheet. We don't need Excel sheet. We can also work out with calculator and normal pen. That fellow, he does not know. Well, you can handle this one. I'm leaving it. Simply saying. Come to 11th question again. 11th question, when we sorted, we ultimately decided that the YTM is something around 14.29% or 14.3%. Next question continuation is there. Read this. Considering the information from the above question, calculate the after tax YTM to the investor if the tax rate is 30% on the coupon payments and capital gains. Look at this, sir. Suppose an investor who buys this bond will end up getting a return of 14.295% return he will get. But on the return, our auntie will take tax also, no? But tax you have to pay. After paying tax, he will not have 14.295%. No. Out of the 30%, she will eat off. Now, in our entire calculations here, did I anywhere consider tax? No. But now the question is, please give me after tax YTM. Sir, it is like this, sir. Forget about this sum. Normally you think you are earning a return of 20%. That lady wants 30% out of whatever you earn. So how much are you earning net? 20 I am earning, sir. 30 if I pay off, minus 10. Your 20% you are earning on your investment. 30% she will take on what you are earning. Correct? So 20 as a whole number minus 30%. How much is that? 14. So 14 is your after tax return. Correct? Like that only. If 14.295%, if it is your gross return, on that if you pay a tax of 30%, take your calculator 14.295 minus 30% directly. 10.0065%. This is after tax return. Clear here? Now, my point is this. If 14.295%, this return, whatever is there, are the coupons ka return, capital gain ka return, both are? Both. Proof. You see here. This is coupon, this is capital gain. Both are included as a part of your YTM calculation, isn't it? But luckily, in this question, that fellow told that normal coupons and capital gains both are charged at 30%. Therefore, what we can do, take the overall YTM without tax and straight minus 30%. But you are all pro in tax. In tax, what did you learn? Capital gains tax rate is different. Income from other sources, interest income ka rate is normal tax rate, adi different. They both are not same. If some simply assumed they are same. Next sum, reality hit. Come. There is a 9% 5-year bond issue in the market. The issue price is 90 and the redemption price is 105. Okay, bond is now only just now issued. E bond ka price is 90 now. Redemption price maturity value is 105. For investor with a marginal income tax rate of 30% and a capital gains tax rate of 10%, assuming no indexation. That is also there. You have to do tax chapter now. What is the post-tax yield to maturity? Requirement is same. I want after-tax YTM. But twist is, your tax rates are not same. On interest income it is 30%, on capital gains it is something else. Tell me sir, can I do this kind of adjustment now? Directly work, first forget tax, work out one YTM, from that YTM directly remove tax rate. Can I do like that? I can't. Em chedamantavu? Sir. Good. What you do is, since you directly cannot disturb the rate, YTM rate with the tax effect, what you do, disturb the cash flows itself. Disturb the cash flow ka meaning is, this YTM formula is there no? Instead of taking coupon amount gross, take coupon amount net of tax. Then your cash flow automatically reduced no? Similarly, instead of taking maturity value, take maturity value net of capital gains tax. That way what is happening? You are reducing your cash flows that are going into computation of YTM. Thereby directly after tax YTM you will get. Sir, directly rate I cannot disturb with tax rate because my YTM rate includes coupon amount also, capital gains also. If both are taxed at the same rate, then I can disturb like this. But when they both are taxed differently, I can't disturb the rate directly. Since you can't disturb the YTM rate, go and disturb the ingredients of YTM. Who are the ingredients of YTM? Cash flows. Cash flows disturb chesandi sir. And work out YTM and leave it. That's all. So let's start. Question number 13. Coupons and capital gains are taxed differently. Therefore, we cannot adjust YTM rate directly with tax rate. So, we adjust the cash flows for tax effects. Coupon amount each year. Check once the annual bond or semi-annual bond, sir? Annual bond only. So what is the face value? Face value not given, sir. Not given means you assume. Tell me, sir, bond ka market price is 90. Face value will be 1000. 10 rupees, sir. No, it will be around 100 rupees only. Okay, so question sometimes will not give like that. Is equal to 100 rupees into what's the coupon rate? 9 is equal to rupees 9 minus tax at the rate of 30%. That is rupees 6.30. Coupon amount net of tax. Next. Tell me, sir, what is your maturity value of the bond? Towards the end, they will redeem the bond at 105 less. Initial purchase price, which is 90 or 95? 90, okay. Which means the capital gain is rupees 15. Capital gain tax at the rate of 10% is rupees 1.50. Now tell me, what is the net amount? Okay. Look at this. If 105 rupees is inflow at year 5, if 1.5 is tax payment, outflow at year 5. Therefore, maturity value net of tax 103.5. 15 minus 1.5, we get tempted, all of us. That is wrong. What will I do with net capital gain? Useful or useless? Useless. Net inflow I want. That's all. You have what you want. Just work out approximate YTM formula and leave it. Coupon amount 6.3. Maturity value 103.5 minus spot price 90. Life 5 years or 6 years? 5 years divided by 0.6 into 90 plus 0.4 into 103.5. Entire thing into 100. Sort out this. If possible, sort out in single go. Direct answer. Everything should be on your calci. I got this check once. Solve this, put it in denominator. This one you solve. 9 into 0.654, that much we know. Adi m plus adjacent. So this will be in m plus. Solve this, add this, divided by MRC into 100. 9.43%. Well, okay. Next question. So tell me, whatever you computed is accurate YTM, approximate YTM? Approximate, and that is sufficient actually. You have seen just now ICMA question also where they left it there. He did Excel sheet lo this one, on paper this one, and he says it's okay. This later, this is also similar one, sir. Look at this again. Company is offering a bond with a price of 100. Coupon rate is 12%. Maturity period 5 years. Bond will be redeemed at par, and the investor faces a 30% tax on income and 10% capital gains tax. Find out the effective yield to maturity for the investor. Okay. Carefully observe. This sum is similar to previous sum only. Okay. Now, 30% tax on income and 10% capital gains tax. Carefully observe, sir. A bond is today issued at what price? And bond is also redeemed at par, which means what? 100, which means capital gain is? So capital gain tax is 0. Capital gain tax is 0. The only your YTM now totally comprises only of coupons, and coupons are taxable at 30%. So normally work out YTM minus 30% you do. Katam answer will be ready. So if you work out that, it will come to something like this. 12 rupees coupon sir plus 100 minus 100 divided by 5. The entire dabba will burn to 0 divided by 0.6 into 100 plus 0.4 into 100 into 100. So that's exactly 12%. But it's before tax. If you want after tax YTM, so straight away take 12% minus 30%, or directly do like this, minus 1 minus 0.3. 8.4%. Sir, that fellow got 8.41 now, sir. Are sir, the accurate YTM. At Excel sheet he did. Solving, how did you solve? You have to explain, no. Study mat question, no. They have to teach, no student. Next sum they taught using Excel. Excel, what is there, sir? All the cash flows, put it in one line. Put a formula like this, is equal to IRR, open bracket, select all the cash flows, enter. Tada, answer will be ready. But 5 marks will not be given for that. You need to know how to sort out. Okay. Achieve some. Okay. This we will solve later on. Come here, 19th one you solve. An investor is considering the purchase of the following bond. Considering purchase means he did not buy, he is thinking. Face value is 100, coupon rate is 11%, maturity is 3 years. If he wants a yield of 13%, what is the maximum price he should be ready to pay for? Tell me what is the question requirement? What is he asking? If he wants a yield, meaning what? What is the meaning of this? Good, very good. This is required return. If the question gives you a required return and asking how much I should pay, means what is he asking? Fair value. Do all of you do. Table, formula, line, copy and write somehow. Do. Get the fair value of the bond. What is the coupon amount? 11. What is the desired return? 13%. Sir, coupon rate 11%. What I want is 13%. Tell me, bond will trade it? Par premium discount. I want 11. Sorry, I want 13, but the bond gives only 11. My required return is higher than the coupon rate. So bond will be trading at discount to the par value. Adi, you should already know inside. You don't know how much price, but you should know that the answer will be less than par. Okay, 13%, how many years? 3 years. 100 into PVIF, 13%, third period. 11 into How much did you get? 90? 27 you got, I got 28, that's okay. Will not fight for chiller. 95.28 is the fair value of the bond. What is the meaning of this? If I want to earn a return of 13%, I should buy the bond at 95.28. Now read the question, tell me what is the actual price of the bond. Actual market price of the bond is given, see. Second case lo given, sorry. If the bond is selling for 97.60. First of all, he did not ask, but you tell me. Fair value is 95.28. And I should buy the bond only by spending 95.28. If I am lucky, I will spend less than that. But actual price is 97. Is it overpriced, correctly priced, underpriced? Overpriced bond, we should buy a, we should not buy a? We should not buy. The bond is overpriced. Therefore, do not buy the bond. If you buy the bond, what will happen? You won't get any return, huh? You will get, but that return will be less than your required return. He is asking that, I want that, YTM. He is not asking decision, he is asking YTM. Okay. YTM of bond is equal to, approximate YTM formula is enough. Coupon amount, what is the coupon amount? 11 plus maturity value 100 minus 97.6 divided by how many years, ma? 3 years divided by 0.6 into spot price 97.60 plus 0.40 into 100. $11.97%. What is my RR? RR required return 13. But if I buy this bond, how much will I get? 11.97. Should I buy this bond? You should not buy this bond, and I told you here already. If you don't listen, you still go and buy the bond. This is what will happen. Yesterday when we did the first question, what did I tell you? For everything there will be a proof. When we say don't buy, don't buy. If you buy, what will happen? You will get a return, but that will be less than your required return. The proof is what else you want? The full picture, sir. Yesterday's concepts, these concepts, all questions if you mix, you will ultimately stand that whatever fair value you are computing, if you are able to buy the bond at that rate only, then exactly you will earn your desired rate of return. If you pay more, you will earn less. If you pay less, you earn more. That is underpricing, overpricing concept. The bond, whether it trades at par premium discount, that depends on whether coupon rate and required return YTM are same or higher or lower depending on that. You just have to understand all this, practice, and then write everything once on your own. Then only you will get comfort. Sir, this and all will look confusing sometimes too easy. But it should stand the test of the time. After some months if you open also, it should be able to be like, falling into the right place, right logics. Write in your own language, you write. Things will become deeper, sir. These are all just at surface level you are there. But this is the maximum, sir. I mean to say conceptually the maximum. These are all essential. Okay, next. What are we doing? YTM. Okay, fine. Another question we'll try. This is question number 19. Okay, cheap question, leave it. Now, come, 22nd one you come. This fellow is waiting for you. He answer whatever is printed here. No, it gave us 11.94%. That's because I applied the first formula. But in your study material and all, they are using second formula, and by experience also we know that second formula ka answer is more accurate than the first formula ka answer. So second formula you use and carry on. The first formula answer why I wrote is this CA final exam question, sir. Because CMA finals people are using second formula, that fellow did overaction and used first formula. So you see a final question, so the answer is looking like that. Don't mind, you do your own version. Okay. Chalo, come to 22nd one. Based on credit rating of the bonds, Mr. Z has decided to apply the following discounting rates for valuing the bonds. Credit rating, if it is a AAA bond, high quality bond, then the discounting rate what he will expect is 364 days treasury bill rate plus 3% spread. Spread means difference. Spread ane word ki meaning is difference. What is T-bill? Treasury bill. Who issues treasury bill? RBI will issue treasury bills on behalf of Government of India. That is considered to be the most risk-free investment. So, our risk-free rate plus 3% extra I want. Next, if it is a AA bond, then AAA bond ka required return plus 2% extra I want. If it is a single A bond, then AAA bond ka required return plus extra 3% I want. As the rating comes down, risk is increasing. If risk is increasing, required return of the investor also increases. A scale he is giving us. Now, without reading so much, come here towards the end. Assume 364-day T-bill rate is 9%, which means 9 plus 3, here answer should be 12%. Is it 12 plus 2, 14%. Is it 12 plus 3, 15%. Are you understand, sir, how to fix the required returns? Move on. Our fellow investor is considering investing in a AA rated bond. Oh, so what is his required return now? 14%. AA rated 1000 face value bond currently selling at 1025.86. This 1025.86 is the market price. Remember, sir, whenever question gives off the market price, it can ask you only two questions. It will ask you fair value of the bond and ask a decision whether I should buy the bond or not. Or they will ask you to compute YTM. Question la market price is given means definitely they will ask either of these two questions. Work out fair value, tell me decision, or work out YTM. See, somehow they ask both. The bond has 5 years to maturity and the coupon rate on the bond is 15% payable annually. The next interest payment is due 1 year from today and the bond is redeemable at par value. All normal routine data. You are required to calculate the intrinsic value of the bond. What's the meaning of the word intrinsic value? Fair value ke over action. Fair value. Should he invest in the bond? This is decision. Calculate current yield, cheap formula, YTM, approximate YTM, second formula if you do, sufficient. Whatever we learnt in this chapter till now, everything is there in this question. Go on. Start. What are waiting to copy here? Do fast. Right. Required return from AA bond is equal to required return from AAA bond plus 2%. Required return from AAA bond is how much? 9 plus 2, 9 plus 3. 2. So total it is 14%. A question fellow is calling it as discounting rate. It has got a name. It's called as required return. He does not know. We know. No. First one. Intrinsic value or fair value or equilibrium value or theoretical value, all are same. Fair value of the bond is equal to, tell me sir, what are the coupons? 15% I guess. 15% on 1000. How much is that? 150 into PVIFA. 14%. How many years? 5 years. Redeemable at par and somewhere he wrote into PVIF 14% 5th year. $150 into 1, 2, 3, 4, 5. First to fill up this one, easy, 0.5194. Now GT, correct sir, 3.4331. Yes sir, work out this. 150 into 3.4331 and 519.4. 1034.37. 33 you got, how? Second one 0.5194. You multiplied with the entire thing on calculator. Don't do that. Why to write then? You write something, it should match with your own answer, no? అక్కడ కక్కుడు పడకండి 1034.36537. Okay, fine. It is fair value of the bond. What is the question he asked? Should you invest in the bond? No, you decided, huh? How do you decide? Toss is error, sir. Tell. What is the actual price? 1025.86. E calculation tells you that you are mentally ready to prepare to pay how much? 1034. Bond is available at 1025.86. What will you do? Buy up? Will not buy up? Overpriced or correctly priced? Underpriced. You should not do overaction like, hey, cheap bond I will not buy. Not like that. You will get higher return. Akadigo bogodu, sir. Decision. Actual market price of the bond 1025.86. Lower than fair value. Therefore, bond is underpriced. Therefore, investor should buy the bond. Okay. So tell me, if you buy an underpriced bond, how much return will you get? More than your required return. Actual return is YTM. He is asking that also. Please work out. YTM is equal to approximate enough. Coupon amount 150. Maturity value 1000. Spot price 1025.86. Life 5 years. Whole divided by 0.6 into spot price. 0.4 into maturity value. Definitely it will be more than 14%. No doubt. RR 14, it will be more than that because it's the underpriced bond. Conclusions, if you remember, life will be very easy for you. .26%. Marginally only higher, but still it's higher. That fellow wanted 14. E bond is giving him 14.26. That's good enough actually. Next, poor fellow asked one more calculation. Guess how many marks ki question can come? 8. Current yield. Current yield formula is what you forgot? Coupon rate kaadu. Amount divided by Coupon amount in next 1 year. We'll simply write coupon amount per annum divided by market price of the bond into 100. Coupon amount is how much? 150 divided by 1025.86 into 100. Sort out this, sort out this, sort out this. 150 divided by 1025.86 percentage, 14.62%. This is your current yield formula. Some going to come in the exam, did not come yet. Sir, your ICMS final examination paper key, there are very limited sources, sir. A couple of foreign books are there, old exam questions are there, study material is there, CA final questions are there. For CA final people also same, they have a couple of foreign books, past examination questions, CMA final questions also they copy. So these people have some exchange program questions. So we have everything. If you practice well, ideally you will not face any surprises in the exam. Okay, this is done, this is done, this is done. This one is homework, sir, you have to solve on your own. 23 you do on your own. Listen to a small, easy concept. Now you tell me this one, sir, I have forgotten. So you answer me now. I thought you will only remind me. This is holding period return, compounded terms. Earlier what did we say? It is similar to YTM and we said and we left it over there. Okay, now I will give you some numbers. You help me how to work out that. You need not actually work out, but if you tell me how to work out, that's more than sufficient. 1, 2, 3, 4, 5. This is a 5-year bond. Our boy, what he did, he sold the bond here. Sold the bond at 1050. Initially purchased at rupees 1000. The outflow. Coupons are 150, 150, 150. 150, 150. Plus last maturity value also is 1000. But our boy stood in the bond only for a period of 3 years. So I want return only for a period of 3 years basically. If you work out for all the 5 years, that is called as what? YTM. I don't want YTM. I want return for the period from the date of purchase till the date of sale, which is how many years here? 3 years. Now, HPR, simple return if you want. Simple. Simple is very easy. What you will do? 150 plus 150 plus 150 plus 1050 minus 1000 whole divided by 1000 into 100. Total coupon plus capital gain divided by initial investment into 100. That's the easy answer. I don't want that. I want compounded terms. How will you work out compounded terms? Simple. IRRA. So means what, sir? You should now fetch me one discounting rate. What is the sale value given? 1050. So you should fetch me a discounting rate which will equate the present value of all this to initial investment. So if you get me that rate, this rate is your holding period return, compounded terms. Sir, how to work out, sir? Array, sir, how did you work out YTM? Same model. YTM, how are you working out trial and error? But at trial key, who is giving you the first rate? Approximate YTM formula. Look at that approximate YTM formula and code a formula for this. So you will now tell me approximate holding period return formula. Tell. Correct answer I want. I don't want answer, I'm not interested in the final answer. I want formula. I want you to feel. Don't solve, feel. YTM lo whatever you are doing, do the same thing. It is as good as you are computing YTM for 3-year bonds, sir. Ignore these two are not there for you. Instead of maturity value, you received sale value because you sold the bond. So it is as good as there is a 3-year bond with 3-year maturity bond. That's all. Work out YTM. Call it as HPR. That's all. Name change. Tell me formula. Coupon amount. Okay. Then. No, I'm asking formula, sir. Approximate formula. How to compute is that is okay. That trial and error we can do originally, but approximate answer I want. Coupon amount plus. At that time we wrote maturity value. This is maturity value 1050. Say sale value. See, you are following now. Minus. At that time we wrote spot price of the bond. This is purchase price, initial investment. Divided by, at that time you wrote life. Is life forever? No. Holding period. See, now you are coding formulas. Hold divided by 0.6 into purchase price plus 0.4 into sale price or sale value. You want answer in percentage terms? Multiply with 100. That's it. Whatever rate you get, are the approximate holding period return compounded terms. You try. You want accurate one? Trials. Trial 1, trial 2. Somewhere you will get it. Usually holding period return, they do not ask in compounded terms. They don't ask. If they ask, you should be prepared so that we are learning it. Is it similar to YTM or not ultimately? It's YTMA. Only thing is I can't use the word YTM because YTM and a word I can use only when I stay till maturity. I'm leaving in between only, no. So up period, holding period, and compounded term. Same story. Names change. Last concept, sir. It's called as call of the bond. Very small concept. With that we are done for today. Call of the bond. First of all, what is the meaning of call? Exact meaning of the word call you will understand after doing a chapter called as derivatives, which will come much later for us. Okay. Before that, what is the meaning of call is? Right to buy back bonds before maturity. Basically that is nothing but inka simplify cheyalante it means early redemption. Company has a right to cancel the bonds before the maturity date and repay the money to the investor. A right they will keep with them. This is called as call of the bond. I'll tell you a small story. Listen to this. Guys, my company needs money for a project. The project period is 25 years. So if I invest money now, I keep on getting inflows for a period of 25 years. And I also issued a bond to raise money for this project with a maturity period of 25 years. So what I did at 0 time, bond issued with maturity of 25 years. Now, when I issue such a long gestation period bond, if I have to convince people to buy this bond, I have to offer a coupon rate which is matching with their expectation. So, today RR in the market, let's say, is 16%. Therefore, coupon rate is also fixed as 16%. If you don't offer 16%, no fool will buy the bond unless you offer the bond at discounted price. Park, if you have to sell the bond, you have to offer coupon rate equal to required return. Otherwise, bond cannot be sold at par. No fool will pay you 1000 rupees for the bond. Of course, if you put coupon as 14%, issue the bond at 980, maybe people will buy. Because then also they will get their return of 16%. That's the reason. Okay, now, a company faces one huge risk. What is the risk is? He recorded in 16%, not the second 16, first 16%. That is dependent on two things. One, marketly interest rate. Number two, risk of my company only. I am the borrower there. Today maybe marketly interest rate is high. Therefore people are expecting more. Therefore I have to offer a higher coupon. I committed. But what if after some 6-7 years I found that marketly interest rates dropped? If interest rate drop, what will happen to required return? Required return also will fall. So people are willing to give me money at a lower interest rate only. But on this bond, I already committed a rate of 16%. Like a fool, I have to pay 16% for remaining 25 years. That is risky, no sir. I am not borrowing 100 rupees. I am borrowing 100 billion. A 1%, 2% will upset your entire company ka profits. Or understand, sir, company does see long period bonds law. Company does not want to take risk. Today I will offer. Today I will offer. If I don't offer, you will not buy the bond. So I will not get my money. I will definitely offer the bond at your required return only. Coupon at a fix. But there is a risk that in future, if market returns fall, market interest rate falls, RR falls, like a stupid, I will be paying interest rate at 16% to you for another 20 years. A risk why will I take? I will not take that risk. So what I tell the investor is, investor, I will pay you 16% for a period of 25 years. But any time after 5 years, example, any time after 5 years, the company retains a right to call the bond. Call the bond means, you watch cricket like test match? You don't watch? Test match, sir, if your batsmen are playing too much, what will the captain say? Come back, declared. Come and sit in the pavilion, let's field now. Enough of your batting, come off. Like that, company says, bonds are cancelled. Bonds are cancelled, you take your money and get lost. I can't pay you 16%. Why is the company saying so? Company feels like this. If after 5 years, market interest rates drop, and therefore today required return is 12% only. Company can raise the money in the market at 12%, but unnecessarily on the current bond they are paying 16%. And if you don't do anything for another 20 years, you have to do that. He will pay unnecessarily 4% extra on 100 billion. I will not pay. So what I will do, I want to cancel the bonds. I will tell that point before only. Company has right to cancel bonds or cancel bonds. Let's call it as refund bonds. Now tell me this. If you are an investor, you saw a company offering a 16% interest on a 25 years investment. What you thought is, just now I am starting my career. Whatever money I have, I'll dump into it. Nice 16% return. Forever I will get for a period of 25 years. Happy income. But you read in the document that that fellow says I'll cancel the bond at the end of 5th year if I want to. That will be a kind of hindrance for me. I want to invest because it's a 25-year bond. But you are saying that you will cancel the bond after 5 years if it is suitable for you. Then why will I buy the bond? I will not buy the bond. So company says, don't worry. In case I cancel the bond, I will cancel the bond at premium. I mean, if you stay for 25 years, last I will pay you 1000. If I cancel it, I will pay you 1100. So investor, how he thinks is, if the company does not cancel, then I will get 16% per annum return for 25 years. I am happy that way. If the company cancels the bond, then I will anyway get premium on redemption 1100 instead of 1000. That way also I am happy only. So investor will eat off this biscuit, sir. Premium on redemption is there. So bonds are early redeemed at premium. Let us say example. Okay? Bond is originally issued at 1000. Now let's say redeemed at 1150. What is the meaning of the word yield to call? Means from the date of purchase till the date of call, what is the compounded return earned by the investor? What is YTM? Yield to maturity. Yield to maturity means what? From the date of purchase till the date of maturity. Our period ka compounded return is called as yield to maturity. Suppose this fellow sold the bond at 8th year. Date of purchase to date of sale, that is called as holding period return. Date of purchase to date of call, that is called as yield to call. Date of purchase to 1 year is called as current yield. Whatever 4 returns we learnt, all returns ka time frames are different. Current yield will see only for 1 year. Yield to maturity will see for maturity date. Holding period return, date of purchase to date of sale. Yield to call will see from date of purchase to date of call. Call means early cancellations. Now you will tell me, apply your mind correctly and answer this. Cutely answer. Yield to call formula. YTM formula you know. Coupon amount. Next. Maturity value is a word which you use in YTM. Holding period return lo use the word sale value. Redemption value or call price, both are correct. Very good. Redemption value is correct. Call price is also correct. Minus SP spot price or initial investment, anything, divided by life, not life. Holding period, no. Or redemption from the date of purchase to date of call. To date of call. Whole divided by 0.6 into your spot price today plus 0.4 into redemption value outside into 100. YTM, if you understand, all compound returns are same to same. YTC is done for you. Tell me, sir, is accurate YTC? Almost accurate. Almost accurate. Accurate you want, you have to do trial and error. E rate to discount all the cash flows. It won't match. Slightly increase it. Still it won't match. Interpolate it and get it. The accurate YTC. Nobody will ask you accurate YTCs usually. So this is the maximum. This is call of a bond. Tell me, sir, who is exercising this right here? Company is exercising the right. The reverse is also there. This is called as put of bond or putable bonds. This time the investor has a right to surrender the bond. Surrender, or you can say sell the bond to the company before maturity date. This is called as put of the bond. Call ki put ki, what is the difference? Call, the company is having the right to buy. Here investor is having the right to sell. Company point of view, if you talk the second one, I have an obligation to buy this one. Whereas here I have a right to buy. Here I have a obligation to buy. Now you tell me, sir, what is the meaning of yield to put? Meaning, formula will work out. Yield to put ka meaning. It is return from date of purchase date of purchase to date of put or date of surrender. The yield to put. The callable bonds are the putable bonds. First page of our concept book, callable, putable bonds, and one introduction is there. If you want, you can check it now. Callable bonds means company reserves the right to cancel the bonds. Putable bonds, investor has a right to cancel the bonds. Whoever cancels it, ultimately company has to buy back the bonds. Now you will tell me, approximate YTP. Tell. Coupon amount divided by, here redeemable value, here also same thing, or you can call it as put price. Redemption value or put price. Excise price, anything is okay. Minus spot price divided by period till put. Till you put it, till then. 0.6 into spot price plus 0.4 into redemption value outside into 100. The approximate yield to put wala formula. On this yield to call, yield to put, there are small questions, sir. Once we do that, one ultimate concept is there which is called as reinvestment rate assumption. That's linked to YTM only. Once we do that, we cross the second level of bond valuation, YTM is done. Then we are left with convertible bonds, forward interest rates. Forward interest rate is like little high notch, but convertible bonds is easy, extremely important also. So tomorrow session, most probably, almost it will be over for us bonds. Tomorrow session, little may be left. Okay, we'll continue on this tomorrow, sir. It will be too much for you. So whatever we have covered till now, kindly revise and come back. See you guys. Thank you so much. Yes, sir. So last we were talking about computation of yield from a bond. The term yield basically is nothing but computation of return, and generally return can be computed in two types. One is simple return, where we ignore time value of money. One is compounded return, where we consider time value of money, reinvestments and all we consider. So there are two types of return calculations broadly. In this chapter specific to bond, there are four types of yields that are possible. The first one is called as current yield. Current yield is a simple return. Now tell me, sir, how to compute current yield? Coupon amount in the next 1 year divided by market price of the bond into 100. Right? So, current yield features you must remember. What are the features? It ignores time value of money. It computes return only by considering coupons. It will ignore capital gains. If in the next 1 year bond price has risen or fallen, that's a capital gain or capital loss, that will be ignored. Current yield computes return only by considering what? Coupons only. That too within the next 12 months from today. Only that much. Current yield formula is simply coupon amount divided by market price of the bond into 100. That's it. Next, coming to holding period return. As the name itself suggests, holding period return computes the return from the date of purchase of investment till the date of sale of investment. And holding period return in simple terms is computed using a simple cute formula like total coupon amounts received plus sale value minus purchase price divided by purchase price into 100. Here if you see this part, whatever is there, this is your capital gain. This is your total coupon. So numerator is representing total return divided by investment. Return by investment is return in percentage terms. That only we are calling it as holding period return. But you must understand that whatever answer you are getting here, that is not for 1 year, that is for the entire holding period. If you want an per annum return, again you have to go and do annualization of that. For example, in this story, it was a return for 3 years. I wanted per annum return. So I just did into 1/3. Like that. Next. The most important fellow is yield to maturity. As the name itself indicates, yield to maturity means the return earned by the investor from the date of purchase of the bond till the date of maturity of the bond. So if an investor holds a bond till its maturity date, how much return he would make? That is called as YTM. Now, YTM, how to compute? This is a compounded return, sir. YTM cannot be worked out in simple terms. And YTM is nothing but IRR. So what you have to ultimately do is identify that discounting rate which equates all the bond cash flows to current present value of the bond. What is the current present value of the bond? Market price of the bond. So, sir, how will I know that rate? Simple, you will not know. You have to go and do trial and error method. So try at one rate, fail there. Try at another rate, fail there also. Ultimately, go and interpolate these two results and identify YTM or IRR. That's the original technique. But we have a small shortcut technique. What is that shortcut technique? You can apply approximate YTM formula. Approximate YTM formula is coupon amount per annum plus maturity value minus spot price divided by life. This is capital gains per annum. Denominator, sir, you have to take a maturity value and spot price ka average number. That average can be a simple average or it can be a weighted average where we give 60% weight to spot price, 40% weight to maturity value. Both are approximate answers only, but the second formula will give you a more better answer compared to the first bit answer. And in fact, your study material also uses approximate weighting, the second formula only. Then why I wrote the first formula is here and there in suggested answers, scanners and all, old exams they have given this. So you should understand that whether you use this or this, they are anyway not accurate YTMs, they are only approximate YTM. But this is a more better approximation than the first one, that's all. But this formula, when can you apply? When the cash flows are like this. Initial investment, every year coupon, last la maturity value. Then the formula will perfectly work wonders. But we have done one more case yesterday, if you remember, where the bond life was 5 years. Not only it was 5 years, it was a semi-annual bond. And then the bond maturity value is not repaid at once, but it is repaid partly at the end of 4th year and partly at the end of 5th year. So this is not this kind of cash flows what we have analyzed here. This is a different kind of cash flow. So instead of applying that formula, we have to do little real trial and error. So randomly take one rate, try, fail there, take another rate, fail there also, go and do interpolation and you will get your correct absolute YTM. Are you understanding, sir? Then after tax YTM we have seen. This is also a simple question. Then we have, I've asked you how to compute compounded holding period return. Compounded holding period return means from the date of purchase till date of sale, you have to work out yield in compounded terms. That's nothing but approximate YTM formula is there. Convert that into approximate HPR formula. So what will change? Instead of maturity value, you have to include the sale value in the formula. Rest of the story is same to same. Then we discuss the two small concepts. One is call of the bond, the other one is put of the bond. What is the meaning of call of the bond? The company reserves a right to buy back the bond before the maturity date. That right to buy back is called as what? Call. And whenever the company calls the bond, all the bonds will be cancelled and the company pays a lump sum amount or agreed amount to the investors. That amount is called as redeemable value or a call value. So what is the meaning of yield to call then? Yield to call is a return earned by the investor on per annum basis compounded from the date of investment to the date of call or date of early redemption. Now, how to work out this? Again, same. If formula, we change it. Instead of sale value, put it redeemable value or a call value divided by life till call of the bond. Rest of the formula same. After call, next we discuss to put. What is putable bond? This time who is having a right to surrender the bond? Investor is having a right to surrender the bond. Who has to buy the bond? Company has to buy and cancel the bond. Yield to put means the return earned by the investor from the date of investment till the date of surrendering the bond or date of putting the bond. So YTP means yield to put. Yield to put, how to compute is again same formula. Here redeemable value, here life till the put. That's all you have to take. Now, few small questions are there. Quickly we'll try to finish up them. I gave you 23rd question as homework. Could you solve? You also just now remembering, huh? You solved. How much did you get? Same answer you got, huh? If you see and write, same answer you'll get obviously. Good. That's because I used 50% weight here. If you use 60-40, you'll get a slightly different answer. That's okay. The question requirement was state whether an investor will invest in this bond. Should I buy the bond or not is the question. Should you buy the bond or not? You can answer by two ways. One, work out fair value of the bond. Compare that with the market price. You will know whether it is underpriced, overpriced, correctly priced. Based on that, you can take a decision. What's the other way? Work out YTM of the bond. Compare that YTM with your required return. Directly compare. If you are getting more return or equal return like your required return, then it's okay. If you are getting less than what you want, then don't buy the bond. Any which way you can conclude. He asked YTM and decision also. Semi-annual, but it's a good question. 24th one we'll solve in a while. There was some question on YTC. Where is that? Stupid question hiding. Come here. This fellow only. Question number 20. Mr. Mehta recently purchased a bond with ₹1,000 face value, 10% coupon rate, and 4 years to maturity. Okay. The bond makes annual interest payment, the first to be received 1 year from today. Mr. Mehta paid 1,032.40 for the bonds. The market price of the bond or initial investment. Calculate the bonds yield to maturity and the bonds yield to call if the bond can be called 2 years from now at a price of 1,100. He is asking YTM also, YTC also. Chalo sir, let's start with YTM first, A bit, second bit later on we'll compute. Question number 20. Formula please. Coupon amount per period you have to take. Normally annual bond, so coupon amount per annum we are taking. If it's a half yearly bond, you have to take coupon amount for 6 months. Careful. Plus, since I'm computing YTM, I'm writing it as maturity value minus spot price of the bond. Divided by life of the bond. Whole divided by 0.6 into spot price plus 0.4 into maturity value. What's the coupon amount? 10% coupon on 1,000. So that is 100. Maturity value. Par only. Nothing is given. Par. Okay, then how much did this fellow pay? 1032.40. Whole divided by what's the life? 4 years. Sort out this. Yes sir, yes sir, yes sir. Fast, 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 fast. 9.01%. Correct, Adi? Looks like correct only because you have a capital loss there apparently. 1032.4. Yeah, 9.015. Correct. Perfect. This is your YTM. Next question in this same thing is they're asking yield to call. Write the formula for that. Coupon amount per annum plus call value or redeemable value. Anything, whatever you want to write, you write. It's not about the formula, sir. It's about the structure of the formula. By spot price divided by life till call. What is the call amount given? And how much years? 2 years. How much? 12.63%. The calculations you should be good. Don't be scared. You have to do it. Next. Look at this, sir. 21st question, which is your CMS study mat. This fellow has heights of imagination. Please read. Suppose 8% coupon, 20-year maturity bond sells for 1120 is the market price and is callable in 10 years at a call price of 1090. The actually maturity is how much? 20 years. But if the company wants, they can early redeem the bond at 10 years time by paying an amount of 1090. So he is asking compute YTM and compute YTC also, yield to call, using the following information. Yield to call ka data, what did he give you? Coupon payment is 40. How did he get 40? Look at the data. What is the market price of the bond again? 1120. From that, can you guess what is the face value of the bond? 1000. So on 1000, 8% if you apply, you should get 80. But he is giving you 40. What does it indicate? A semi-annual bond. Number of semi-annual periods is 20 here, 40 here. Because here, yield to call is 10 years. 10 years, so 20 half periods are there. YTM lo total 20 years, so 40 periods are there, 40 half periods. And then final payment 1090, 1000. Okay, that's we know. Present market price of bond is same. He is asking what YTM and YTC. Just like how you solved the previous case, we can solve here also. See, what did he do? He study mat answer. I did not do anything. With the help of spreadsheet. What is this? Excel. You can easily calculate. Yield to call is 6.95% and YTM is 7%. This is CMA answer, so study mat answer. Exam lo can you write that? No. You need to solve, no? Like exactly like this. Okay? Start now. What are you looking? Half years, careful. That fellow did Excel, no sir, he will have perfect answer. We are doing approximate, so we will have almost near answer. So you will prima facie know whether your answer is right or wrong. Do it fast, correctly. Write the formula. (21) yield to maturity. First, which one you are doing? ATM only you are doing, okay. Then coupon amount for 6 months plus maturity value minus spot price by life whole divided by 0.6 into spot price plus 0.4 into maturity value. Good news is working out that fellow only did and gave us. Coupon amount is how much? 40. Maturity value nothing is given, par. Spot price 1120. Life 40 periods divided by 0.6 into 1120 plus 0.4 into 1000 into 100. I got 3.4515. The 3.4515 is per 6 months. Annualized YTM. $6.9029. Okay, 903. That's also. This is your YTM. How much did he get? YTM. He got 7%. That's because that's an accurate answer. Ours is an approximate answer. Sir, accurate answer we also work out, sir. Work out. How to work out? True and true trials. Start discounting everything for the next 40 periods using 6.903%. Definitely you will fail. Try it some other rate. There also you will fail. Go and interpolate. Ultimately answer will come. But 40 periods is too long to do trial and error. Ignore it. If the question comes, just do it. Leave it here. Next. This is first one. Please work out yield to call. Coupon is still 40, but call value is something else now. How much is the call value? 1090. Life this time is only 20 periods because call will happen at 10 years time, so 20 half periods. 0.6 into 1120 plus 0.4 into 1090. How much are you having? 3.4747475%. Annualized YTC is equal to 3.475% into, if this is for 6 months, how much would it be for 12 months? 6.95%. This we got absolutely correct. Here 7% came, 0.10% difference came. Why should it be like that? Okay, wait a moment. 1 plus. You got. Okay, fine. Sir, I will tell you how he got 7%, but the thing is, that is not something they would do in every question. Okay, so the answer will let it stay, but the annualization put a small star mark. Alternatively, YTM per period of 6 months is given as is arrived at 3.45%. I have to annualize it. Now, watch the story correctly, sir. If you have really understood our time value of money concept, whatever I'm going to tell you will be an absolute cakewalk. Watch this. Sir, if somebody tells you that, they are earning 5% for each 6 months, then in 1 year, how much are they earning? If I tell you that I am earning 5% in a span of 6 months, so in 1 year, how much am I earning? 10%. How did you do that? 5 plus 5 you did. No, what you have done is indirectly, you thought like this. In 6 months, if I am earning 5%, in 12 months, I am earning how much? Cross multiply. 5% into 12 by 6. Answer is 10%. You observe this. Okay, half yearly rate I am converting into an annual rate by multiplying with 12 by 6. That's exactly what we did here also and here as well. Do you understand? So this is the fundamental logic. But do you remember one case where, yeah, if somebody is earning 5% on semi-annual compounding basis, does it mean that he is earning 10% per annum or 10.25%? Do you remember that? Because if you have your 100 rupees here, 100 rupees by the end of 6 months will become 105. On this 105, you will compute interest for another 6 months, it will become 110.25, and effectively you have earned a return of 10.25% and not 10%. Do you remember this case? Our model also you can analyze it. I have simple return types, I have analyzed like this. I ignored the effect of reinvesting. But if you consider the effect of reinvesting, annualized YTM considering time value of money is equal to, now you tell me how to work out effective annual rate formula. Effective annual return, good sir, please tell me, 1 plus PIR whole power n minus 1. Do you remember this? We have done this one, right? Now, I know this, I want this. Okay, let's substitute. That's equal to 1 plus, what's my PIR? 0.0345. In a span of 1 year, how many half periods are there? 2 minus 1. How much are you having now? 0.0702 or 7.02%. The right hand side, whatever you are seeing, that normally we analyze it. Generally we do like that only, sir. All the answers will be like that only. But very rarely they will ask you to compute this. If some answer is 7%, we got 6.9%. 0.1% difference also ideally never came when we applied the second formula, if you observe all our previous questions. So then I thought he might have done this, and he exactly done that. That fellow did not even explain how he got 7%. So he would have done that. If you do like this, only 7% answer will come. Otherwise, it's not possible. Well. So we are starting at 21st question. Nice. 22nd is over. Try some cheap questions. 24 is later on. We'll do. This also same only. Come here. Sir, you are definitely smart than your CMA study material. So what you do? Read this question and solve the answer in any method other than the method given there. You are 100% capable. Read now. A company issues a zero coupon bond of 10 years maturity. What is the meaning of zero coupon? Coupons are not paid, but bond is issued at discount and redeemed at par. The difference is the return to the investor. Annual cash flow will not be there, ma'am. Okay, please read. Issue price is 260. 260K they issued. But climax they will get 1000. Maturity period amount is 1000 rupees. Ignore tax. Fine. What is a YTM? Don't think of formula. Think of timeline. Your mind timeline should come. Draw all of you. 26th. Draw a small line. 0 time. 10 years maturity. What is the price of the bond? 260. Issue price of the bond today is 260. If I hold the bond for a period of 10 years, I will get an amount of 1000. He is asking what is the yield? 740 is amount of return, percentage, compounded terms yield. How will you work out? 260 is present value, 1000 is future value. Future value, present value, both are given. You have to work out R. That's it. How to compute this? Sir, this is nothing but IRR only. 1 point cash flow, 1 point cash outflow, 1 point cash inflow. We have a shortcut formula for this. What is the formula? IRR is equal to square root of inflow divided by outflow minus 1. If you do that, perfect answer will sit in your hand. That fellow did interpolation, trial and error. That way also you can work out. Trial and error you will do when multiple cash flows are there. Their shortcut will not work. If only one cash flow, why should I do trial and error? I'll apply basic common sense. Tell me what is the future value here? 1000. What is present value? 260 into 1 plus R whole power 10. So solve for R over, game over. Directly if you want also formula is there. I gave you that formula also. Nth root of inflow by outflow minus 1. If you remember, formulas will rescue you. Don't remember, no problem. I told you the logic of that. Sort out this carefully. R. If you have to get R, what should you do? 1 plus R whole power 10 is equal to 1000 divided by 260. R is equal to how now? 1000 divided by 260 whole power 1 by 10 minus 1. R is equal to. Do you know how to work out that whole power thing? Enjoy. One, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 and 15 minus 1 into 0.1. Oh yeah, 1.1442. This is perfect answer. E formula, in case you are able to remember, you will directly land here. Time value of money, concept book, last page. We discussed all this in time value of money so that this becomes easier for you in bond valuation subsequent chapters. E formula, if you apply, you are done, sir. Directly answer. What did that fellow do? That fellow went on with trial and error. He computed at 14%, failed, 15% again failed. And then he ultimately did interpolation, got the answer, 14 point. We got the same answer. In fact, this answer is wrong answer. Our answer is correct answer. 100%. The trial and error answer, right approximation error will be there. The perfect. In this, where is approximation, where is rounding off? Nothing. Everything is perfect. That's all. This is your YTM. For example, this is allowed, sir. Why not allowed? The Excel sheet you will take or what? You have to work out like this only. There is no option. Your job is only to understand that you have to apply present value, future value wala formula. That the moment idea comes, khatam over some. Move on, next one. Will you try this one once? 27th one. I'm not doing this. You will do this. I'll just watch. value. 18.06. What's the answer printed there? That fellow got the correct answer, huh? He also got same answer, huh? Fine, fine. He's right then. Calculator లేకపోతే గూగుల్లో చూసి చేసి. Okay. Well, I hope you all have got this. It's a similar thing, sir. Okay, there's nothing great in this. Okay, now let's move on to one small concept of YTM. This concept is called as reinvestment rate assumption in YTM. Rather, this assumption is there even in IRR basically. Now, what assumption is there in YTM? Let's see. YTM assumes that coupons are reinvested again by the investor at the calculated YTM rate. Now, a line carefully you must understand. Tell me, ma, YTM is simple return or compounded return? YTM is simple return or compounded return? Compounded. Simple or compounded means it's not about whether it is easy or difficult. It's about time value of money is considered in computation or not. We have definitely considering YTM is a compounded return. Since YTM is a compounded return, compounding a meaning is what? First year receive some cash flow. That cash flow is again reinvested into the subsequent period. On that interest will be computed. On that again reinvestment will happen. Like that reinvestment assumption is there. And that too, a reinvestment is going to happen at what rate? YTM rate. Whatever YTM you calculated, that only at that rate only again the investor is going and investing. That is the assumption that is there in the YTM. Now, you will not understand this when you read that line, but with an example I can explain it to you. Consider a bond, face value 1000. Market price of the bond is also 1000. Coupon rate is 10%. Maturity 4 years. Sir, from this, can you tell me what is the YTM? You can calculate and tell me. There is nothing wrong. YTM is how much? Calculate and tell me. Why are you worrying? That's all. Good. What is the formula for YTM? Coupon amount. How much is coupon amount? 100 rupees. Good. Then maturity value. Nothing is given. Maturity is also par. 1000. Market price of the bond 1000. Life 4 years divided by 0.6 into 1000 plus 0.4 into 1000 into 100. Use all your calculators. What answer will you get? So your YTM computed or calculated YTM is 10%. But 10% is also what? 10% is what in this case? This is YTM, okay, but 10% is also your coupon rate. You should not have solved it first of all. You should have applied mind. When bond is trading at par value, required return and coupon rate both are same? No. Required return and YTM are also same. Bond is correctly priced only, and therefore coupon rate ni YTM avundu sir. The observation already discussed. Had you applied that, the computation would not have been necessary. Of course, even if you have applied that also, I would have done this, but still some of you have applied it. Nice. When bond is trading at par, coupon rate YTM, coupon rate required return. Fine, clear. Come here. Reinvestment rate assumption is the beauty of IRR. 0, 1, 2, 3 and 4. Tell me ma, what are all the cash flows? 100, 100, 100, one more 100. Of course, plus 1000. Initially, how much you have to invest? Bond investment today is 1000. Now, these are all inflows. Listen, reinvestment rate assumption ka meaning is YTM believes that first year when the company pays you 100 rupees to the investor will not go and spend it off. Investor 100 rupees again he will reinvest for the remaining period. At what rate? At this rate. At not coupon rate, at YTM rate. So how many reinvestments he has to do? First year cash flow, second year cash flow, third year cash flow. Of course, fourth year cash flow is not recorded, it's already standing at the end of fourth year. So YTM believes that all the cash flows are again reinvested at 10% only. If you invest like that, then only your YTM is 10%. That's the meaning of that. 10% when will you earn? You will earn this 10% if and only if all these returns, all these cash flows are again reinvested at the rate of 10%. Then only your YTM is 10%. Proof is this only. Come here, we'll prove it. 1100, first 100 you will reinvest for how many years? 1, 2 and 3. Can you tell me future value of 100? Future value, present value formula you know? 100 into 1 plus 0.10 whole cube. 133.10. Tell me sir, is second 100 is reinvested for 2 years. 100 into 1 plus 0.10 whole square, that is 121. Third 100 is reinvested for 1 year. So that is 100 into 1 plus 0.10 whole power 1, 110. This is not reinvested at all, 1100. Total it. It's okay, leave it. $1464.10. What is 1464.10? That is your future value at the end of fourth year. Clear? Now, if you summarize this entire calculation, it's standing like this. At 0 time, 1000 rupees you have invested. At fourth year, that is becoming 1464.10. Go and check how much return are you earning. Single point cash flow I have converted now. So what is the formula? YTM is equal to cash inflow 1464.10 divided by 1000. Nth root and fourth root. Fourth root is nothing but whole power 1 by 4 minus 1. Whole power 1 by 4 no. Don't do 15 times and all. Double square root it, answer will come off. Square root is 1 by 2. Double square root is 1 by 4. Triple square root is 1 by 8. Okay, so just double square root it. You will land with 1.10. You can try all of you. What is the meaning of this? The meaning of this is your compound rate return is 10%. Your YTM is 10% if and only if you reinvest all intermediate cash flows at YTM rate of 10%. If you reinvest like this at the rate of 10%, 10%, 10% for the remaining periods, then only your actual YTM, then only your YTM will be 10%. This is proof. Investor earns a return of 10% per annum, which is YTM, if and only if he reinvests all the coupon cash flows at the calculated YTM rate. This is the proof, sir. Conclusion. Okay, sir. This is a proof. You concluded something. So what? So what is simple. Now what is going to happen is investor is not fair fellow. No, sir. He'll get all sort of ideas. What this fellow did, first year he received 100 rupees. Spent off. If you spend off that, did you reinvest or you spent off? You spent it. You did not reinvest. Once you violated my assumption, your YTM won't be 10%. YTM 10%, and if I am telling you, that means that your YTM is 10%. If I believed that you are reinvesting everything again at 10%, then only your YTM is 10%. If you spend off that, or rather, I'll put a different case. Okay, watch this. 0, 1, 2, 3, 4. 100 rupees, 100 rupees, again 100, again 100, last 1000. Now, sir, carefully visualize. I first year I received 100 rupees first year ending. What am I supposed to do? I have to go and reinvest now. I want to reinvest at 10% only. But what happened? Unfortunately, in the market, interest rates have fallen down. Market interest rates have fallen down. If interest rates have fallen down, can I invest at 10% now? When I purchased the bond, market rate was 10. So I purchased this bond. But subsequently what happened? Market interest rates have fallen down. Since market interest rates have fallen down, reinvested at the rate of, let's say, 6% per annum. Market interest rates have fallen down. Sir, it's not like my wish is to reinvest at 6%. I'm not a fool to invest at 6%. E bond is giving me 10% return. If I get any money from this bond, again I have to go and invest in some investment which is at least giving me 10%. But market interest rates have fallen down. That is not something which I can control. So I am able to reinvest only at 6%. Tell me the value now. 100 into 1 plus 0.06 whole cube. 119.10. This 100, 0.06 for a period of 2. $112.36. This one is 106. This one is directly 1100. Total it up. How much are you getting, ma? 1437.46. 1000 rupees. Earlier you observe, when you invested 1000 rupees, fourth year ending, how much are we having? 1464. Then your return was 10%. Now are you having how? 1464. You are having 1437. Your future cash flow decreased. Do you think you will earn 10% return now? You won't earn. Sir, how much will I earn? Let's try. Find out. So my 1000 rupee investment became 1437.46. I want YTM. So YTM real return is 1437.46 divided by 1000 whole power 1 by 4 minus 1. Definitely you will not get 10%. It will be less than 10%. $0.0959496. No, I'm calling it as 95. Or how much? 9 point. But when you apply formula, how much did you get? When you applied formula, how much did you get? You got 10%. But actually you did not earn 10%. You earned only 9.5%. Why you could not earn your calculated YTM rate? You violated one assumption. What is that assumption? YTM believes that all the intermediate cash inflows are again reinvested at YTM rate only. If you are unable to reinvest at the YTM rate, then the actual return what you enjoy is not your calculated YTM. You have to compute again by considering your actual rate of reinvestment. E 9.50% is there, Norma. This we call it as modified YTM or realized YTM. Did you ever hear a term called as modified IRR? This is that only. It's exactly that. Interlevel, sir, people don't like IRR only. Modified IRR is out of discussion. IRR cheap, modified IRR even more cheap. For that only glorified version, modified YTM. Concept is small concept. Proof in front of you. We worked out trial and error method la proper YTM I computed. I got 10%. This is YTM, this is actual return. Correct. Provided you reinvest all the coupons again at 10%. But whether you will reinvest it at 10, 6, 5, 20, that is not in your hands. That depends on market interest rates. If I exactly am able to reinvest, no problem. This is any final answer. But if you are unable to reinvest, you reinvested at 6% only, then our 10% is wrong answer for you. Our 10% is not your YTM. So then what is my YTM? This is your YTM. 9.5%. Modified realized YTM. Am I clear here? Sir, what will happen? Just randomly I'm asking. Instead of 6%, they reinvested 16%. What will happen? Then here you will not have 1464, you will have higher than that. Since your future value is increasing, that means your return also will increase. So instead of 10, you will have something around 10.45 or 10.5, something like that. That is your modified YTM. Are we clear here? Very good, very nice. Just random question. Okay, I'll ask you. I'll show you that question, not ask you. Come here, 24th one, please. An investor acquired at par a bond for ₹1,000, acquired at par, that offered a 15% coupon rate. Fantastic. At the time of purchase, the bond had 4 years to maturity. Nice. Assuming annual interest payments, calculate his actual yield to maturity. Please underline that word. He is not asking simple YTM. Actual YTM. It's not offset, it should be if. If all the interest payments were reinvested in an investment earning 18% per annum. What is the coupon rate originally? 15. And bond is trading at par. Bond is trading at par, sir. So coupon rate any YTM also. The prima facie calculated YTM will be how much? 15. So YTM assumes what? You will reinvest all the coupons again at 15. But actually this fellow reinvested at 18. Therefore his calculated YTM won't be his real YTM. His real YTM will be something else. Something else you are supposed to work out. Then there is a second continuation question that we will see later on. Okay, first let's handle this. Chalo sir, do off. 24th. Calculated YTM. This nobody asked you, but still work out. Coupon amount plus maturity value minus spot price divided by life of the bond till now. What did we reach? YTM is the biggest hero of all the yields. You have to apply one big formula and all, but ultimately you see a YTM one flaw is there. The YTM also is wrong answer. There is next level correct answer, modified YTM. What is the coupon amount? Coupon amount 15, 150, yeah, 150. Maturity value nothing is gone, par value, spot price par value, life of 4 years divided by 0.6 into 1000 plus 0.4 into 1000 into 100, 15%. Okay, this is calculated YTM. This is the final answer. Huh? This will be your final answer if you reinvest all your coupons again at 15%. If you try to play anything there, the answer will be wrong answer. And he played. Continue. Reinvestment of coupons correct, coupons at the rate of 18% per annum. Since coupons are reinvested at 18% and not at 15%, the above computed YTM is not the correct YTM to investor. It's just like your income tax. There is a rule, there is an exception. Like that, the original rule. You violate that, no problem. I can still work out your actual yield, provided you tell me at what rate you have reinvested it. And that fellow told 18%. How to do this? Again, draw timeline, work out everything. All of you will do on this on your own, please. Please do. I'll tell you shortcut also, but first do the original. These are all your coupons with the maturity value. Initial investment also happened only at par value. What we are assuming is all these are not assuming, in fact, all these are reinvested at the rate of 18%. So this would be 150 into 1 plus 0.18 whole cube, because 3 more years. So 1.18 square cube into 150. How much is that? 246.45. 150 into plus 0.18 whole square. 208.86. Is 150 into 18% or 150 plus 18%? 27. Huh? Very good. Fantastic. This cannot be reinvested at the last take. Yes, sir. Answer. What are you looking? 1782.31. So if you invest 1000 rupees today, 1000 became 1782.31 after 4 years. What is the return you are earning? Anyway, that we can work out, we know how to handle. But my point is, instead of doing so much, see why I'm making you draw all this is, this will develop your thinking in this way. For that purpose, you can do happily like this also in the exam. If you want a shortcut, I am there. That shortcut is, what are you trying to work out? You are trying to work out the future value of all this here, correct? What are all these? 150, 150, 150, 150. 4 150s is an annuity. Work out future value of annuity. 1000 is already standing at the end of 4th year only. Directly add. The diagram and all you can avoid. One line you can get it. Are you understanding what I am trying to say? E 150, 150, 150, 150 ka future value of annuity workout. 4th year ending ka combined amount will come. To the directly add 1000. 100% same answer will come. It has to come. There is no option. I'll work out and show you what is there. 150 rupees into FVIFA. How much percentage? 18%. 4 annuities. Plus 1000. 150 into FAFA formula 1 plus PIR whole power 4 whole power n minus 1 divided by PIR. $782.31 plus. Sir, we discussed everything in time value of money to apply only. You should not shy away from applying. It is easy for thinking and I am making you write this. But if you execute like this, you are pro. The alternative version like this also you can present. Same answer will come. Well, now coming to YTM. Rupees 1000 invested today is becoming rupees 1782.31 at year 4. Your yield is equal to 1782.31 divided by 1000 whole power 1 by 4 minus 1. Whole power 1 by 4 is again double square root you can do. You will have 1.155 minus 1. 0.1554 or 15.54%. What is this? This is your modified or realized or actual, whatever name you want to call. That's all. Sir, any doubt in this? In terms of the concept, in terms of computation, ideally it should be clear. If you have any doubt, you should ask me. Guys, any doubt? Each year. Okay. We'll change it. No. What is there? See, his question is, what if this year investing at 18%? This year investing at 16%. This year investing at 14%. Invest, what is there? Here number will change, you know. Nothing will happen. If you give me different rates, what will I do? Here 18 I will write. Here 16 I will write. Here 8 I will write. 8%. In number will be different. Model is same only, no? Question they give you one reinvestment rate. What I have to assume for all the next 4 years, other reinvestment rate is applicable. If you change, if you give me different rates, I'll change it. What is there? In that case, E shortcut will not work. That is correct. Every year different rates. So if you are reinvesting, then this will not work. The original is there with us already. Ee samla annuity is working because your rate is same. But every year different rates, so you are investing. E shortcut will not work. This will work. Are you understanding, sir? Don't worry, that question is there. Case 2. Continue. What is he saying? What would be his yield to maturity be if all the interest payments were spent immediately? Our stupid boy, what he did, the moment he received inflow, he purchased something with that, he spent off, he ate ice cream. The reinvestment happened or did not happen? Did not happen. So reinvestment when it did not happen, will he get his YTM rate now? No. So how to compute that realized YTM now? No sir, you are getting coupons now. You mean to say you will project everything into future directly? Good. Very nice. Look at this. In the first example, what we just now solved, we reinvested everything at what rate? 18% rate. So we are reinvesting everything, correct? Now, if you are reinvesting everything at the rate of 18%, we got our answers, whatever we got. But if you tell me, sir, I did not reinvest at all, I spent it off. Fantastic. You spend off, no problem. But for the purpose of computation, how I will assume is all the reinvestments are happening at 0%. So reinvestment is happening? Not happening. I will say that reinvestment is happening at 0%. Do you have any problem with that? No. So if I project everything at 0%, what will happen? E 150 ka value here also will be 150. This also will be 150. This also will be 150. Sir, why to do over actions? Sir, directly only you can add? No. Yes. If I am directly adding, you will ask me, sir, you ignored time value of money. You added everything. I did not ignore. That stupid investor ignored. By not reinvesting, by spending of that money, you violated the assumption of compounding. So who ignored time value of money? Me, not me, investor. Since he does not care about time value of money, why should I care? I will add directly. So the answer in a simple terms is very easy. Literally club everything, do 1600 ka total at the end of 4th year and work out IRR. Over game answer. But for your logic purpose, I am telling you, if somebody does not reinvest at all, you assume that they are doing reinvestment at 0%. Same model answer will come. Only thing is all these numbers will be same. 150 only will be there every year. Hello, let's do off. That's very fast. But still you have to write. Sir, some people are thinking that answers are anyway printed. Why to write? Sir, those answers are you saw no your CMA study mat answers, RTP answers and all. It will be like that. Answer every time you will not understand. That's the reason I am making you solve. So please write. Don't shy away. Unless you work hard, how sir? Hello. Coupons are spent immediately. That is no reinvestment. Our fellow happily spent off. But for computation, I am asking you to assume that all these are reinvested at 0%. If you reinvest at 0%, answer will be 0. Good. That much clarity if you have life flow. 150, 150, 150, and this is also same. Sir, if my investor does not reinvest the money and is spending off casually, what it means is he ignored time value of money, not me. Therefore, I can club here itself directly. I'll get the same answer, no? But just to make your thought process aligned with the previous case, I'm doing like this. Smart work, literally merge everything. Hello now. Answer. Rupees 1000 invested today is becoming rupees 1600 at year 4. R is equal to how much? Present value, future value formula, nothing else. But if you remember the IRR formula also, 1 point inflow, 1 point outflow, directly happily you can do inflow is 1600 divided by outflow 1000 whole power 1 by 4 minus 1. .1247. This is your modified YTM. If you apply the formula, how much are you getting? 15 we got. But actually his return is only 12.47. In the concept I have given one small example. I think I have given, no, you received the concept book also, no? In this, I think I gave an example. No, I didn't give an example, but I gave you some steps here. Please read this. YTM calculation is based on an inherent assumption that intermediate cash flows from the bond are again reinvested at the YTM rate. When we say a bond has a YTM of 10%, it means that investor would get a return of 10% only if the intermediate cash flows from the bond are again reinvested at 10% rate. If the intermediate cash flows of the bond are reinvested at some other rate other than the calculated YTM, then such calculated YTM is not the actual return earned by the investor. We must compute a modified YTM or a realized YTM. Steps. All the cash flows are brought to the maturity date using an appropriate reinvestment interest rate. The question lo he should tell you at what rate investor is reinvesting. How will I know? I will not know. Question they have to tell me that. If the intermediate cash flows are not reinvested at all, then assume that they are invested at 0%. To cover that question, E point I have added. This results in a single cash inflow in the terminal year. Correct? Actual timeline was what? 0 time lo one cash outflow. First year, second year, third year, fourth year, cash inflows are there. I converted them into single inflow at the end of fourth year now. The discount rate which equates the present value of terminal cash flow to the price of the bond at 0th year is the realized YTM for that shortcut. Total cash inflow divided by cash outflow whole power 1 by n minus 1. Clear, sir? This is exactly what we have done. Our last one small dabba is there. See there. That's one general observation. If your reinvestment rate is more than YTM rate, for example, calculated YTM is 15, but this fellow managed to reinvest at 18%. How much is his realized YTM in our answer? How much did we get? First case, 15.54. This is higher than the calculated YTM of 15%. No, that's a conclusion. Modified or realized YTM will be greater than your calculated YTM. Where these concepts are relevant is, sir, MCQs. MCQs are relevant. If you observe this, out of 4 options, one option will be higher than calculated YTM. You need to sit and do the entire thing there. Are you understanding what I am trying to say? Sir, the same question they will give you, sir. They will say that I am reinvesting at 18%. What is my realized YTM? A, B, C, D. D, none of the above. A, B, C, lo only one number will be greater than 15%. Remaining 2 will be less than 15%. One is 15%. You not even solve. You know that he will earn a 15% YTM if he reinvested 15%. But that fellow managed to reinvest at 18%. So he will get more than 15%. Khatam, you did not even solve. See and just ticket. For that purpose, conclusions are given. Sir, everything should be literally in your hands like this. For that, how will all this come to you? Learn, understand, practice. Seeing and ticking, calculator का ऊपर ऊपर calculations नहीं चलेगा. To literally put pen on paper, fail, make ultimate. So many mistakes you make. How many mistakes you make? That much you can learn. If you shy away from failing while doing practice, finally that result will happen. Fail here, you will pass there. You will not try it out at all, then it will be very difficult for you. Don't think that this subject is all about by hearting formula or a format and going to exam. It won't work like that. Papers always won't be easy for you. And you have to get the total also, no, not only passing a particular paper. So we need to make, when you're learning something at this level, final level, you should literally absorb everything. If you're unable to do, practice it. I'm accessible. You ask anything, I'll tell you. 2 plus 2 is equal to 4. You ask me to prove, I will prove. 2 chocolates you hand. Count. So just don't see. I understand compared to your CMA inter level, this is obviously slightly on a top notch level. It's higher level. I understand that. But at the same time, this is reality, sir. I can't hide it. I can only make it sound easier by diluting the concepts, removing some questions, ignoring something, hiding something, cracking some jokes and doing time pass. Then you will presently be happy, but later on you will know the reality. So learn only once, but perfectly you have to learn. Lot of practice is required. Don't see when SFM or SFM one basic flaw is when somebody is teaching. I'm not talking about myself, anybody. If somebody is teaching and you are listening, understanding will be very nice. But when you're asked to solve on your own, a pen won't move, idea won't come. Why it will not come is, first thing, fear of making mistake. Remove that. Royally make mistakes. I will pakka mess up this an angle to start. Don't start with the angle that I will somehow do it. No. I will somehow manage to mess it up, but I will try. Mess up multiple times, but ultimately you will get the correct answer. If processly you will understand what all kind of thoughts you will get, what all wrong ideas your mind will tell you. Slowly you will come to the correct way. Like that, once you do first initial 2-3 questions, later on mistakes will not come. The practice, sir, you have to reach up to this bar. See, I'm not giving you any extra questions and all. No, these are all your past exam questions and all. Anyway, so this is about question number 24. Or please read question number 25. Consider a 8% coupon bond selling at 953.10 with 3 years until maturity, making annual coupon payments. Fantastic. The interest rates in the coming year would be, with certainty, R1 is equal to 8%, R2 is equal to 10%, R3 is equal to 12%. Okay. Calculate YTM and realized compounded yield of the bond. Underline this and put arrow mark, call it as modified YTM. See, our intelligent student has asked one doubt, no? That became question. He has magical powers. So he asked, what if you are reinvesting each year at different interest rate? Go, you are here. Correct, no sir? We can easily work out. That's not a big deal. But first thing he's asking, compute YTM. See, what did he do? Excel sheet use sir. You can't do that, no. You have to sort out in your own way. So enjoy. First YTM, sir. Mod YTM later on we'll see. That is the question that is directly there. A question directly you can't handle. So first one, starter question, this one, and now your study mat question. YTM of the bond. Coupon amount plus maturity value minus spot price by life divided by 0.6 into spot price plus 0.4 into maturity value. Guys, how much is the coupon amount? Amount, not rate. 80. How do you know? Face value 1000 rupees is assumed. Questions will not tell you the implied. Market price is 953 means bond will be around, bond ka face value will be around 1000. So 1000 into what's the coupon rate? 8%. Plus maturity value, nothing is given, par. Spot price, some ugly number is there, 953.1. Life of the bond is 3 years. Stupid fellow gave 3 years. Sir, while framing question, they should have some sense, no ma. 3 years, how can they give? They expect student to carry financial calculator or Excel sheet in the exam. Whole cube, how will you work out whole power 1 by 3 later? Anyway. Slowly solve this. Oh, that's very fast. That means you are not writing out. That's okay. Right. Yeah, 9.8402. Okay, 84% is enough. Since that fellow used Excel sheet and worked out, his answer will be a little more accurate if you apply the correct formula, of course. How much did you get? 9.88. That's okay, leave it. Modified YTM. Interest rate in year 1, year 2, year 3. Yes, sir. What are the interest rates given in the question, ma? 8, 10, 12. Okay. Carefully visualize the timeline and tell me. If I draw, you will tell off. I'll not draw. You visualize in your mind and tell me, out of these 3 rates, one rate is useless for us. Last is useless. %8 is useless. Why? Your answer is right, but reason is 12%. Why is it irrelevant? Ma, tell me. First year ka coupon, you have to reinvest for another 2 years. On the second year, you have to invest at 12% only. 12% is not fake. That is required. 3-year bond, ma. First year coupon will be reinvested for 2 years. Second year, third year. Second year ki 10%. Third year ki 12%. Second coupon will be reinvested in the third year. So 12% is relevant. Who is waste? 8%. Now why it's waste? The interest rate of which year? First year. When are you reinvesting? First year ending la. First year ending la, if you invest interest income, that means you are investing for which period? Second year and third year. First year la reinvestment will not happen. 8% trap. You getting it, sir? Draw the timeline. Coupon, sir, how much? 80, yeah? 80, 80 again, 80 again, and 1000. What you do is write R here. Now, according to our original concept, the first 80 should be reinvested for 2 years. Tell me, ma, how will you work out this? Listen carefully here. 80 into 1 plus 0.10. Where am I reaching now? From first year ending, I am now coming to second year ending. I would have put in whole square if third year interest rate is also 10%. But that is not. Third year interest rate is how much? 12%. So this cash flow again I will have to reinvest it. Are you getting it, sir? Chalo, here, ma'am. 1268.16. What is the investment today spot price? 953 point. Sir, did you all understand how we computed future value here? Normally we write future value is equal to present value into 1 plus r whole power n. Whole power n we can write when every year same rate is there. But here second year one rate, third year another rate. I am reinvesting for 2 years. E rate is different, the rate is different. So what is this calculation is, first 80 rupees project up to here. One number will come. A number again projected to here using 12% rate. Hello now. Rupees 1000, sorry, 953. Invested today would become 1268.16 at year 3. So you want modified YTM. What is your workout? Formula 1268.16 divided by 953.10. You understand why I am scolding him for giving 3 years? If it was 4 years, I would have double square rooted it. Now it is whole power 1 by 3. I have to know my 15 times square root wala model and then only I can solve it. Otherwise I can't solve it. How can study math expect you to know that? Of course, since you know you will solve, but I am just telling. Hello, start out by 953.10. 1, 2, 3, 4, 5. Power into 1 by 3 means divided by 3. $1.09988. $9 actually. That's all, sir. This is your accurate answer. This can't be wrong. This is right. Let's see what did he get. Oh, how did he get? He won't tell you. He simply wrote this and he told this is your answer. How did he solve 1 by 3? That fellow won't explain. Neither do we. Inside 15 times square root model should not write there. No, you should execute. Write the final answer. That's nearly 10%, of course. Sir, with that we are done with all our YTM questions, sir. Check once again. Have left anything out? That is that, sir. Okay, guys. Sir, we have completed all the questions that are there on yield calculations. Let it be current yield, holding period return, YTM very detailed, yield to call. On yield to put, question is not there till now, so we could not see any application, but it's just similar to yield to call. Okay, now if you see, there are a couple of theoretical concepts I've kept here, small. On that, till now, detailed questions haven't come, but still on a safe side, we'll cover that conceptually, and then we'll move on to the most important part, which is called as convertible bonds. An absolute high value item from an examination angle. But before we go there, a couple of small concepts. Okay. Now, what are the risks that an investor will face by purchasing a bond? There are two types of risks that are identified. Number one is called as price risk. Number two is called as reinvestment risk. Now, price risk ka meaning is, after I purchase the bond at a particular price, a bond price can change. That is a risk I have. For example, you bought a bond at 1050, maturity 4 years. After 1 year, what happened? Market interest rates changed off. If market interest rates change off, required return also will change. If required return changes, bond price will also change. Bond price, if it is increases, you are happy only. But if it falls, you are sad. That means bond price fluctuates. Bond price fluctuates because if market interest rates change. Tell me, sir, if market interest rate change, bond interest rate is, okay, this is wrongly printed, sir. Correct it. I'll update it again. Here, please update it. Market interest rates fall, the bond price will rise. And market interest rate increases, bond price will fall. So this is called as price risk. The bond price and the interest rates are inversely proportional. When I say interest rate is increasing or decreasing, I'm talking about market risk-free rate. I'm not talking about your coupon rate. Your coupon rate, why will it change? That is fixed coupon rate. If market interest rates increases or decreases, investor ka required return also increases or decreases. If my required return increases, what will happen to bond price? Bond price will fall. If my RR decreases, discounting rate decreases, what will happen to present value? Present value will increase, bond price increases, inversely proportional. This is the first risk. Second type of risk exclusive to the bond is reinvestment risk. Now, what is the meaning of reinvestment risk? Come here. I will show you this with an example which we have already solved. Listen here. Let's say I computed YTM. Where is that 6% whole example? Not you. This one. This one, sir. Chalo. I purchased a bond, sir. In that bond, YTM was 10%. I purchased the bond because my required return was 10%. YTM is also 10%. I happily purchased the bond. This is the bond which exactly gives me what I want. But after I purchased, I know that YTM 10% when will I earn? Only when all the coupons are again reinvested at the rate of 10%. At what rate I will be able to reinvest? That is not in my hands. That depends on market interest rates. After 1 year, when I went to reinvest, unfortunately market interest rate dropped to 6%. So I can reinvest now, but at 6% only. But my original plan was to invest at 10%. Can I execute my plan now? I can't. So I have to reinvest only at 6%. If you reinvest only at 6%, what happened ultimately? Your realized YTM or modified YTM came to only 9.5%. But when you purchased the bond, you entered into the bond imagining a return of 10. But you did not get 10, you got only 9.5. That is my mistake. That's not my mistake. That happened because of you reinvesting at a lower rate. And I reinvested at lower rate because market interest rates dropped. That's something beyond my control. E kind of risk is that. That means even though you purchase a bond which is giving you what you want, ultimately you will not be able to earn that also if you are unable to reinvest it again. This is called as reinvestment rate risk. It is negative. It is positive is also there. What is positive? Suppose instead of 60, if you are able to reinvest at 16%, then you will end up getting more than 10% also. A chance is also there. Risk means a possibility of loss, but a possibility of loss also has a possibility of gain also. Okay, risk basically means fluctuation, sir. What I expected, what is actual fluctuation. A fluctuation may hurt you, may make you happy also. Fine. These are the risks of the bond. Two risks. Then coming to properties of the bond. Properties of the bond means two properties have covered, sir. Important only conceptually. Bonds with higher maturity are more price sensitive than bonds with lower maturity, and therefore bonds with high maturity are considered riskier. What is the meaning of this? Look at this example. Carefully follow, sir. Easy only. In the first scenario, I took a bond whose maturity is 3 years. Face value 1000, coupon rate 10%, redeemable at par, required return 10%. The coupon rate, required return, both are same. When both are same, what will happen? Bond will trade at par value. That's why market price of the bond is also equal to 1000. This is a 3-year bond. Same to same story. 10-year bond I took. That's all same. ఈ 10-year bond లో also coupon rate RR both are same. So coupon rate and YTM if both are same, bond will be trading at what value? Par value. So I have two bonds, left hand, right hand. One bond I have having. First bond 3 years maturity, second bond 10 years maturity. Both the bonds are trading at par value. Now what happened? Market interest rates increased. If market interest rate increased, required return also will increase. Let's say it increased by 2%, ultimately it became 12%. Increased by 2% is appropriate, sir. Please make it 2%. Increased by 2%. So what is your revised RR now? Yes, sir. What is the revised required return? 10 plus 2. How much is that? 12%. So now that RR increased, bond price will fall down, no? So work out the revised price of the bond. First bond, how will you work out price of the bond? It's a 3-year bond. So 3-year ka interest rate discount it. Maturity value once. Whereas this is a 10-year bond, 10-year ka cash flows you have to discount. But if you see, bond price fallen down. Here also it fall down. Here also it fall down. It proves our logic that when RR increases, bond price will fall. Logic is clear? Now observe. Both the bonds have got same price today, 1,000. Both the bonds RR increased only by 2% only. But the fall is not same. If first bond from 1,000, it has fallen down by 48 rupees. 1,000 became 952, 48 rupees fallen down. Second bond you see, from 1,000 it has fallen down to 887. That means how much decrease is that? 113. What does this prove? Both the bonds RR increased by 2% only. Both the bonds ka prices have fallen down only. But which bond ka price has fallen down more? Second bond. Correct? From this, what is the proof you have to get is bonds with higher maturity will fluctuate more compared to bonds with lower maturity. Read first point again, please. Bonds with higher maturity are more price sensitive than bonds with low maturity. And therefore, bonds with high maturity are considered riskier. They will fall also more, they will rise also more compared to a low maturity bond. So if I give you a low maturity bond and a high maturity bond, I ask you between these two which one is riskier? High maturity bond is riskier. Price movements amount will not be same, direction will be same. This also falls, that also falls. It will fall more or it will rise more compared to a shorter maturity bond. This is a conclusion. So just remember it. MCQs and all, it may be relevant for you. Okay, next, second conclusion. Second point you read, see if you can understand that. Though the relation between bond price and the interest rate oblique yield is inversely proportional. Do you agree with that point? Bond price and yield is RR. They are inversely proportional. The relation is not symmetrical. What is this? Read further. The increase in a bond price for a decrease in yield will be higher than decrease in the price of the bond for an increase in the yield. It all sounds like a paradox there, but it's easy only. This is called as bond convexity. Now what exactly this means is, come here. Next example you watch. There is a 10% coupon rate bond, face value 1,000, life 5 years, RR 10%, price of the bond in the market is 1,000. So the present price of the bond. What I did is, I have done two scenarios now. In the first scenario, what I have done, I increased RR by 2%. If I increase RR by 2%, what will happen to bond price? It will definitely fall. Second scenario, I assumed RR decreased by 2%. If RR decreases, RR is your YTM discounting rate. If it decreases, what will happen? Bond price will increase. But increase, decrease, both I did with what? 2% only. Now watch the first scenario. From 1,000, the bond price fallen down to 928. So how much is the decrease? 72 rupees price has fallen down when RR has increased. But where RR decreased by 2%, price risen not by 72, 80 rupees. What's the meaning of this? For the same fluctuation up and down, in return, price fluctuation is not same. I decreased it by 2%, I increased it by 2%. Scale is same. but fluctuation in price is not same. Decrease is by 72 rupees, whereas rise is by 80 rupees. That means the amount of increase is higher than the amount of decrease for the same change in the yield up and down. Again, read this now. Though the relation between bond price and the interest rate or yield is inversely proportional, the relation is not symmetrical. Symmetrical means it won't be same. Movement will be opposite, that's fine. But amount fluctuation will not be same. Conclusion, the increase in the bond price for a decrease in the yield, the 80 rupees, will be higher than decrease in the price of the bond for an increase in the yield, which is 72 rupees. 80 is higher than 72 is what he is telling. Correct? Now, the YTM here. Here if I write price of the bond, presently let's say is it 10% yield. At 10% yield, the price of the bond is 1000. So I'm standing at this point. Graphical presentation, sir. Okay. Now, what I did, I increased the yield by 2%. So it went to 12%. When yield is increasing, what will happen to bond price? Bond price will fall. And bond price fallen down to which price now? You see and tell me, you have computed now. 970, how much? 928, 928 fallen down. So E point is getting plotted somewhere over here. Okay, now I join these 2 points. This is not real graph paper, but just understand what I'm trying to say. Then what I did, I further reduced the bond yield to 8%. When you reduce it to 8%, what happened to bond price? Increased to how much? 1080. So my point is, scale is not there, no. So what I'm trying to do is, here 2 lines gap I took for 72 rupees. Rise should be 80. It should be little higher than two lines, no. So I'm plotting it somewhere over here. So E particular point will get plotted over here. Now, if you try to join these 3 points, sir, it won't actually form a straight line. It will be kind of a convex shape. Convex shape means like a curve. It will give you a kind of curve wala feeling. It won't be convex. Sorry, it won't be linear. I mean to say, sir, is it looking like straight line for you? If it is looking, then I will change it. It's not real graph paper. If you take a real graph paper, you will understand. Anyway, it's easy to change always. Now, okay, definitely that's not straight line. If it is looking like straight line, then you also have to wear. Yeah. So the point what I'm trying to say is, if the relation was linear, what would have happened, ma'am? From here to here, I can draw a straight line. Same movement should come here also, means here also straight line should come. But actual price is not something less than 180 or 1072. It is 1080. Okay, 8 rupees extra on, sir. 8 rupees extra creates a convex shape here. So that's exactly the reason why there is no straight line, means this is the reason. If the relationship was linear, what would have happened? Fall by 72, rise by 72. It is not happening. Fall by 72, rise by 80. So the link is not straight line, the link is slightly curve. A curve shape, whatever yield is happening, sorry, to your bond price is happening, this is referred conceptually as bond convexity. Nobody will ask you this, sir. This I am telling you for a reason which you will understand later on. The rise in the price will be higher than a fall in the price for the same change in the yield. Am I clear here? Now, E point, sir, what you understood is at 10% discount, forget about bond now. At 10% discounting rate, present value of future cash flows is 1000. At 12% discounting rate, present value of cash flow is 928. At 8% discounting rate, present value became 1080. From this, what we can prove is here to here change 2%, 2%. But here change is 80 rupees, whereas here change is rupees 72. That's the conclusion of what we have discussed. Okay, sir. From this, you understand that discounting rate ki present value ki link is not a straight line, it is a curve. That is the reason when you do interpolation for computing IRR, why did I ask you to take gaps as small as possible is there will be an error. In interpolation, how are you doing, sir? What are you doing, sir? What you do in interpolation is for 2% change, price la change or present value la change is 80 rupees. So, if I want to get a change of 40 rupees, how much this should move? Like that you are comparing. IRR, that's exactly what we do. If you are doing like this, you know what you are assuming? You are assuming that it is a straight line and you are assuming. Then only you can do this linear relationship. A linear calculation prima facie believes that proportionately it will change, but it will not change proportionately. So the answers what we get here, that is not accurate. That is IRR interpolation answer also is a flawed answer. A flawed answer, how are we making it right is by taking gap as small as possible. Small gap if you take, error also will be small and therefore our answers are okay for us. So in the IRR calculation, whatever you compute using interpolation method or the formula method, that also is not accurate. INPV at low rate, high rate, that is also not accurate. Or the interpolation. Interpolation you are doing, you are assuming a linear relationship between discounting rate and present value. Discounting rate and present value are not linearly related. They are convex related. Because of that, the calculation is wrong. But I don't have a choice. Error will be definitely there. Our error how to rectify is we can't rectify, we can minimize it by taking as less gap as possible. That's why we told while doing interpolation, take trial rates as close as possible. 1 at 2, 1 at 40%, definitely if you try, pakka wrong answer will come. So, this is the background of all that. Move on. Come on, sir. Now, convertible bond story. Sir, this is high value item for your exam. The most easiest part of the bonds is convertible bonds. What is the meaning of a convertible bond is? The bond pays you coupons for a stated period of maturity, 4 years or 5 years or 10 years or something. At the end of the maturity period, a bond will be converted into fixed number of equity shares. So ultimately the company will not pay you cash, the company will give you some fixed number of shares. This is called as compulsory convertible bond. Compulsory. Then there is another one called as optionally convertible bond. Optionally convertible bond means bond will pay you coupons for 5 years, let's say. At the end of 5th year, as an investor, you will have a choice. If you want cash, company gives you cash. If you ask shares, company will give you shares. Ultimately, if you want, you can take shares. If you don't want shares, company will pay you cash. This is called as optionally convertible bond. Am I clear till here? Now, compulsory convertible bonds and optionally convertible bonds. At maturity date, bonds are converted into fixed number of equity shares. So the convertible bonds ka concept is little high, but sums are extremely cheap. Our 7 marks whatever comes is like the moment you see the question, our 7 is already there in your pocket. It is that kind of easy. provided concept you should be good. Come. Optionally convertible bond. The investor has the option to choose on maturity either shares or cash. That means they will directly give you maturity value. Now, value of compulsory convertible bond is equal to, tell me ma, what is the value of bond formula? Present value of future cash inflows, correct? Now let's say bond life is 5 years. So if bond life is 5 years, next 5 years of what all cash flows will you get? Coupons you will get at the end of 5th year. Maturity amount is for redeemable bond. Ours is not redeemable bond now. It is compulsory convertible bond. So what you should do is, sir, look at this. You take the coupon payments and multiply that with PVIFA for n periods. This is present value of coupon cash flows. To that add conversion value at maturity date into PVIF RR nth period. Conversion value at maturity date is equal to number of shares per bond into expected market price of the share at maturity. If you want, you can by heart the formula, but once visualize the timeline, see if you really need to by heart this. Suppose bond maturity date is 4 years. So I tell you that one bond is convertible into 50 shares. So let's say every year I get a coupon of 100. Plus 4th year ending, what will you get? You won't get maturity value. You will directly get shares. How many shares will you get? 50 shares. So you have to take value of shares at the end of 4th year. You are standing today only. The value of shares, how will I get, sir? You tell me one bond is equal to how many shares? 50 shares. Into what is the price of the share? See, today's price of the share, you know, you can see in the market, it will be listed on stock exchange. After 4 years ka price, how will you know today? You will not know. But this chapter ka name is what? Bond valuation. Next chapter is what? Share valuation. So there you will learn how to fix price of a share. Okay, so you will be able, you will exactly will not know, but you will be able to estimate the price of the share at the end of 4th year. P4 you have to multiply. Price of share at year 4 multiply. So let's say that is some 25 rupees. So what is the worth of this? 1250? Correct only. 1250. So what is the value of the bond? Now what will be the value of the bond? I have to discount this also, this also, this also, this also. 4 coupons I'll discount. Plus I can't discount maturity value now. the compulsory convertible bond. Conversion value you have to discount. Whatever discounting rate is given in the question, discounted it, your required return or YTM something the question will give you, discount it, you will have your bond value today. Sir, while doing the main questions, how we will solve is one calculation for this. Next directly one line, answer is over. In your mind this should be there. If you lose this, you can't get it back. A diagram, timeline, what point of which cash flow is there, from where you are dragging what, everything you should know. This is thinking, this is execution. Sir, any doubt in this? Pretty simple, no? Instead of maturity value, you have to take conversion value. Conversion value is on which date? Today's conversion value or future conversion value or future conversion value. Very nice, fantastic, mind blowing. Next one. This one you should tell me. Optionally convertible bond ka value. Zero, 1, 2, 3, 4. Sir, I will give you coupon, some amount I will give you. 4 coupons are fixed amounts you will get. Last flow, sir, what will be your cash inflow? Since it is optionally convertible bond, you have a choice now. What choice do you have? Either you can take maturity value if you want, just like normal bond, or you can take shares. If you take shares, the worth of the shares you have to consider here, which is called as what? Conversion value. Now between these two, which one will the investor choose? He will put TASA, no, whichever is lower, whichever is beneficial for him. Ade, which one? Higher or lower, tell. Sir, if you take maturity value, I will give you 1000. If you take shares, you will get 50 shares. Which one will you take? Depends on what? What is the market price of the share? If I tell you market price of the share is 22 rupees. 50 shares into 22, 50 into 20, all calculator will give you 1100 only. Maturity value is 1000. Which one is better? Shares. If share price is expected to become only 18 rupees, then maturity value is better. So the answer how you should do is either maturity value or conversion value, whichever is higher. You will compute both. You only make a judgment between these two, which one is higher. Take that number, drag everything to today now. So all these numbers, and between these two, whichever number is higher, drag it to today. That's all. This will be your price of optionally convertible bond. How will you execute this while writing? You will write like this. Price of the bond is equal to, take one coupon, multiply that with PVIFA, RR, E example of 4 years, or else I'll put N, plus higher of number 1, maturity value or conversion value. This is one number, that multiplied with PVIF RR 4th year or nth year. That's it. Sir, is the compulsory convertible bond, is the optionally convertible bond. So tell me, what is extra now here? Only one player came extra. Who is that? In place of maturity value, you have to use conversion value. Sometimes maturity value, conversion value, both will be there. You have to select whichever is higher, because you are valuing from investor's angle. Who is having the choice? Investor is having the choice. So investor, what is beneficial, that you have to include there. Any doubt till here? Fantastic. Now, up to here, the concepts are on this directly, questions are there, we will solve that. Now, I'll take a fresh example. I'll see whether I have given this example here. If I haven't given, then I'll write all the numbers. Okay, I've given here. Okay, if I do this, it'll be confusing. So fine, leave it. Market price 10%, face value 1000, trading at 900 rupees. Okay, fine. Watch this example, sir. Here some 7-8 formulas are there. A 7-8 formulas you have to ultimately remember, but if you understand the soul of it, it will be easy for you. Okay, one small example. So take a bond with a face value of 1000. Coupon rate 10%. Market price of the bond. Market price of the bond. How much did they take, mother? 900. And then each bond is convertible into 40 equity shares at how many years did we take? 4 years, 5 years. Market price of the share today is rupees 20. Expected dividend per share is equal to rupees 1 per annum. Sir, this formula, sir, this particular concept example will give you almost clue for 6 or 7 new formulas. Sir, in this prima facie, do you have any doubt in the data? There is a bond. Bond ka face value is how much? 1000. Coupon rate 10%. Life 5 years. Price you did not work out, already given to you 900 rupees. This bond is convertible into how many shares? 40 shares. And as on today, the share price is 20. And our share each year is expected to give you a dividend of 1 rupee if you are a shareholder. You are not a shareholder and all now. Now, one by one. First one. Conversion ratio. The first formula for you. Conversion ratio ka meaning is number of shares per bond. One bond is convertible into 40. So this is nothing but number of shares per bond, which is equal to 40 shares. This is a formula. This directly they will ask you, please get me conversion ratio. You have to do like this. Next. Conversion value on date of investment. Conversion value ka formula already you learnt. Sir, when sir? Here sir. Conversion value ka formula is what? Number of shares per bond into market price of the share. Broadly that is the formula. But earlier when we computed, we were trying to find out conversion value on which date? On the date of maturity. Here I am asking you conversion value as on today. But bond is not convertible today, no. Bond is not convertible today. What is the significance of that? I will explain. First, right. This is nothing but conversion ratio into price of share today. Tell me, sir, one bond is convertible into how many shares? 40 shares. What is the price of each share today? 20. 40 into 20 is how much? 800 rupees. What is 800 rupees? This is called as conversion value as on today. Now, what is the meaning of this? Adi important. Okay, listen carefully. Sir, if you are a bond, if you are an investor, if you buy this bond, the bond ultimately after 5 years will be converted into how many shares? 40 shares. That means even though today you become a bond holder, ultimately you become a shareholder only, no? And you will get how many shares in your hand? 40 shares. That means you purchasing a bond today is indirectly equal to you purchasing 40 shares only. Correct? My point is, instead of purchasing a bond, directly if you buy all the 40 shares, how much will it cost you? How much will it cost you? The conversion value ka meaning. Instead of purchasing a convertible bond, if I directly buy the shares itself, how much will it cost me? That is called as conversion value. Write the meaning. Meaning is important. Formula, whatever is there, booklet is there. If a direct investment is made in shares, it would cost rupees 800 today. Guys, that is the meaning of conversion value today. Earlier you worked out conversion value on the maturity date. That's for a different purpose. You are trying to value the bond. Here nobody is asking you to value the bond. Value of the bond is given to you already in the question, 900 rupees. Nobody is asking you to work out the value of the bond. These are other ratios. Sir, up to conversion value, it's clear now? Next. Conversion premium. Sir, what is the meaning of the word conversion premium? Conversion premium ka meaning is anywhere, sir. Remember it for life. The word premium means extra. The word premium means extra. Securities premium is what? Amount collected over and above the face value. Extra amount collected. Like that, conversion premium ka meaning is, first write the formula, which is equal to market price of the bond minus conversion value. What's the price of the bond? 900. What's the conversion value we worked out? 800. Which is equal to 100. If you tell me interpretation of this 100, you are ultra pro. Become ultra pro. What is the meaning of 100? Yes, sir. Yes, sir. Listen. If you directly buy the shares, it will cost you how much? 800. But what did you say? And you purchased bond only. And bond costed you how much? 900. How much did you pay extra? 100. Extra only we are calling it as what? Conversion premium. Conversion premium and a word ka meaning is extra. And so like that. Okay. So, by purchasing a convertible bond instead of shares, the investor made additional investment of rupees 100. You made extra investment of 100 rupees. So whenever you listen to the word conversion premium, understand that conversion premium means extra amount invested. Premium is not a good news there. You paid extra. The extra investment you made in the bond. Sometimes what they will ask is, the conversion premium only percentage terms where they will ask you to express. What you worked out above is amount, absolute terms. Percentage terms you have to work out. Sir, how to do, sir? How to do? Market price of the bond minus conversion value, the same, whatever we did above, whole divided by, yes. You have to express it as a percentage of market price, conversion value. Why? Simple guess, Market price of what? Bond or share? Wait a moment. You paid extra? You paid extra. How do you know you paid extra? You paid more than conversion value. Correct? Premium should always be expressed as a percentage of lower value. Premium is always to be expressed as a percentage of lower value, not of higher value. You take any case. Shares having a face value of 100 are issued at a premium of 20%. What is the issue price now? 100 plus 20%. So 100 means express 20%. Are you understanding, sir? So always denominator should be lower base whenever you are computing premium. Discount if you are computing higher base you have to take. Premium means what, sir? Increasing. If I am talking about increase, I am already standing at a lower base and I am visualizing the increase. If I am talking about decrease, I am standing on the top base, I am going to fall down. So since I am talking about premium, you have to take the lower base. So the formula will be conversion value into 100. Next, fourth one. Sorry, substitute this and work out. How much is this? 900 minus 800 divided by 800 into 100. How much is this? 12.5. Well. Conversion premium. Now you asked the bondholder, "Arey bondholder, come here. Why the hell did you spend 100 rupees extra? Are you mad or what? Directly shares if you buy, you will happily get. It will cost you only 800. By purchasing a bond, you spent how much? 900. You spent 100 rupees extra. Where did you keep your brain and come?" And you showed at him. He said, "Wait, bro. If I buy shares, what will I get? Dividend income I will get. But by purchasing bond, I will get interest income, coupons. So a coupon it will be more than my dividend. So that is the reason I spent more." Logic correct. So I want to know how much more he is earning. That is called as favorable income differential. Favorable income differential. This is nothing but annual coupon amount from the bond minus coupon from the bond minus expected dividend if investment was made in shares. The bond is giving how much coupon for this fellow? 1000 into 10%. Okay. So that is 1000 into 10% minus, had he purchased shares, how many shares he would have bought? 40 shares. And each share will give you a dividend of how much it seems? 1 rupee. So because you bought a bond, you are getting 100 coupon. Had you purchased a share, you would have gotten only 40 rupees dividend. So by purchasing bond, you are getting extra income of 60 rupees per annum. Favorable income differential meaning is extra income per annum from bond. Formula you have to remember, meaning also if you remember, it will be easy for you to ultimately consolidate and retain everything. Now you tell me, this fellow invested how much extra? Invested how much extra? 100 rupees. Extra income, how much is he deriving? 60 rupees. Next question, I will only tell the question, formula you will tell me. Premium payback period, or also in some areas called as break-even period. Tell me the formula. Meaning also you only have to decide, obviously. I can give you a hint. I spent 100 extra, but every year I am getting 60 rupees extra income. What is the meaning of payback period? How much time it will take to recover your investment? How much extra investment did I make? 100 rupees. But what's the good news? Every year 60 rupees will come back extra to me. That means how much time will it take for me to recover my additional investment of 100? 100 divided by 60. Please do and tell me. 1.67. That's all. Everything is correct only here. It's sounding a little bad here. Somewhere. How many shares? 40 shares. 5 years. Correct only, no? Let me check the example once if I copied all the data correctly. Correct only, fine, no problem. Fine. So the answer here is conversion premium divided by favorable income differential. What is the conversion premium? 100 divided by 60 per annum. Answer is 1.67. What is the meaning of this? The meaning of this is time taken to recover the additional investment made. How much time will it take for you to recover the additional investment made? That is called as premium payback period or simply break-even period. Sir, how many formulas are over till now? 5. Sixth one. Parity price of share or conversion price of share is equal to parity price of the share or conversion price of the share. Now you tell me, sir, today what is the market price of the bond? Market price of the bond 900. You purchase it the bond at 900. Ultimately bond will be converted into shares. How many shares? 40 shares. And indirectly for getting 40 shares you spent how much? 900 rupees. And per share how much did you spend? 22.5. That is called as parity price of the share. Actual market price is how much? Share ki 20A. But by purchasing the bond you paid more. What is the effective cost of buying a share by indirectly buying a bond? That is called as parity price of a share. The parity price of the share formula is take the market price of the bond, which is 900 in our example, divided by conversion ratio, which is equal to 900 divided by 40 shares. Answer is how much? 22.5. Now what is the meaning of this parity price of the share? What it means is this is the effective cost of buying the share under convertible bond. Emma, over? You understood? From the beginning, tell me how many formulas are there. First we learned how to do pricing of a compulsory convertible bond. Coupons you discount. Since it's compulsory convertible bond, maturity value will not be there. Take the conversion value on the maturity date, discount it to today. Fine. Conversion value how to get number of shares into price of the share. But this time you have to take price of the share on the maturity date. That you will not know, so obviously you have to expect it, estimate it. If it is an optionally convertible bond, then you will have a choice. So since you have a choice, any investor with sane mind, rational mind will select whichever is beneficial for him. Which one is beneficial? Whichever is higher. So either maturity value or conversion value, whichever is higher. So this is one set of concept. Next concept. Conversion ratio. Conversion ratio means what? Number of shares per each bond. That is called as conversion ratio. conversion value. Conversion value ka meaning is number of shares per bond ante conversion ratio into market price of the share today, not on the maturity date. On the maturity date also we will work out when you are working out value of the bond. I am not working out value of the bond. This is for some other purpose altogether. Conversion value ka meaning is what? If an investor, instead of purchasing a bond, if he directly invests in shares, how much will it cost him? That is called as conversion value. Now you tell me what is the meaning of conversion premium? By purchasing the bond, how much extra did I pay? That is called as conversion premium. What is the formula for that? Market price of the bond minus conversion value. Next, conversion premium, you can also express it in percentage terms. Denominator you have to take conversion value. Remember this for life, sir. Premium, lower base. Discount, higher base. Okay, just for explaining this, answer this. I tell you two prices, sir. One is 80, one is 100. Okay, what is the fluctuation now? Gap. Now, I want you to express this 20 rupees as a percentage terms. Now, if you watch from this angle, until you are standing here and you tell me that, sir, price from 80 it went up to 100. Fine. Is the premium or discount? Price is increasing, so premium. So, if you want to express this as a percentage, as a premium percentage, then take 20, the gap, divided by 80 into 100. 25%. If you tell me, no, sir, I am standing here, price was 100 today morning, by today evening price fell off to 80. So where are you standing now? 100 low you are standing. So your base point is what? 100, and you are talking about a fall. So if you want to express this as a discount percentage, then also numerator will not change, denominator will change. Do you observe this, sir? Premium will be on lower base, discount will be expressed on higher base. So if you are thinking from premium point of view, lower base. If you are thinking from discount point of view, higher base. In general, with basic maths, this has got nothing to do with bond valuation. Any case it will work. So the concept I applied here also. Okay, denominator conversion value. Next, fourth one, meaning Japan, sir. What's the meaning of favorable income differential? Story you have to remember. Favorable income differential means what? Our stupid boy, instead of purchasing shares, he went and purchased bond. But because he bought bond, one good news is there for him. What is that good news? He will be able to earn certain extra income. Extra income is called as favorable income differential. Extra income, how nicely it is sounding. But you have to charge more to your client. You have to sound posh. So they are calling it as favorable income differential. That's nothing but extra income. Conversion premium, as extra investment. Next formula is what? Premium payback period. Extra investment divided by extra income. Extra investment is conversion premium, extra income is favorable income differential. If you divide it, you will get the number of years in which you can recover your additional investment made in the bond. Clear? Finally, parity price of the share. Parity price of the share ka meaning is, by purchasing a convertible bond, indirectly per share, how much did you pay? How will you get that? Price of the bond divided by number of shares. That's it, over. Sir, our formulas are formulas only, you have to remember. But if you understand the meaning, it will become, the job becomes easier for you. Somewhere a story you have to catch. Am I clear, sir? Last level one concept is there. With that, our convertible bond ka story is over. Questions only will be left. All questions are jujubi, sir. Last concept. Carefully listen. This is interesting also, easy also, but you have to apply mind. Straight value of the bond, also called as floor value of the bond. Straight value or floor value of the bond. What is the meaning of this is? This is value of the bond ignoring the conversion option. It's convertible bond, but ignore the conversion and take only the maturity value for discounting. That is, we consider only the maturity value This is called as straight value or floor value of the bond. Sir, why this name is sounding like this? What is the significance of this? I'll tell you. Come here. Let's take a simple bond, 3-year bond. Coupons are 100, here also 100, here also 100. Plus, here actually you will get a choice of maturity value. You have a choice of conversion value. Maturity value if you select, you will get 1000 rupees. Conversion value if you select, you will get 50 shares into whatever is the value of the share. You are standing here. I ask you to work out the value of the bond. If I ask you to work out value of the bond, what will you do? This you will discount. Here you have two numbers. Both will not come now. Between these two, which one will you select? Whichever is higher, you should select. That is bond value. I am not now asking bond value. I am asking you straight value of the bond. Straight value of the bond, what we will do is, you will discount this, this and this, and you will directly discount this. This is ignored. When I ask you price of the bond, whichever is higher. If I ask you straight value of the bond, only maturity value. Don't take conversion into your calculations. Clear? Now, meaning, sir, why are we computing this? In reality, option is there. In reality, I will select whichever is higher. Why should I work out this? You will understand. Come here. Sir, you all wrote this one, right? Come here. Let me take a small easy bond, sir. 0, 1, a 2, a 3. This is fixed, sir. My required return is 10%. Our discounting rate is ready. Now my coupons are 100, 100, 100. Maturity value is equal to 1000, or one bond is convertible into 50 shares. Whatever the investor wants, he can select. Now case 1. Expected price of the share at year 3 is equal to 25. Sir, you tell me now what is the value of the bond today? This is common, ma. Understand this. 100 into PVIFA 10% 3 years. This is common. Lastly, you have a choice. What choice you have? Either maturity value or conversion value, whichever is higher. What is the maturity value? 1000. What is your conversion value? How many shares? 50 shares. Expected price is 25. So that is how much, ma? 1250. Between these two, whichever is higher. That into PVIF 10% third year. So 100 into 2.4868 plus whichever is higher 1250. 1250 into 0.7513. Annuity factor, PV factor. 100 into 2, what am I working? 1250 into 0.7513 plus 248.6. 1187.81. Okay. This is value of the bond today. Sir, in this any doubt is there for you? This is very, very normal, very basic stuff what we have already discussed. Only thing is whichever is higher and a choice I have applied. Clear, clear. Now what happened? Watch this. Within next one day only, expected price of the share at year 3, instead of 25, it became 22. What will happen now? If expected price of share is 22, what is the conversion value? 50 shares into 1100, sorry 22, which is equal to 1100. Maturity value is how much? 1000. Which one is beneficial for you? Conversion value. So you will work out the bond value considering conversion value now. So if I sort out that directly now, once we have done now, PV factors, annuity factors I can use of now. 100 into 2.48685 or 2.4868 is fine, plus I'm not doing all that formula and all. Directly I'm picking up which one? 1100 into 0.7513. 75 rupees you have to reduce, sir. Anyway, I'll work out again. 1100 into 0.7513 plus 248.6. 1075. Sir, what did you observe from this? Did the bond price reduce or not? Your bond price from 1187 has fallen down to 1075.11. Why did bond price fall? Normally bond price should fall when RR increases, required return. Required return did not increase, but still bond price has fallen down. Why? Expected share price has fallen down. Therefore bond price also falls down. Let's do another case. Expected price of the share at year 3 is 19 rupees. 19. Okay. 19 means what will be the conversion value? 50 shares into 19. 950. Maturity value will be still at 1000. Which one will you select, ma? Obviously, whichever is higher you will select, therefore 1000. So if I work out the value of the bond, 100 into 2.4868 plus 1000 into 0.7513. That's 1000. Okay. Of course, price definitely has fallen down from here to here, from here to here again it has fallen down. If somebody asks you why did price fall down, the answer is simple. Share price has fallen down. Expected share price also will fall down. Therefore, bond price also has fallen down. In case without solving, if you tell me, I will be very, very happy. How much? Do you need to solve the entire thing again? 19 rupees ke share option was not selected. 14 rupees it will be selected. Do you need to compare again? No. Answer anyway will be what? Maturity value. The moment I take maturity value, above answer only again gets repeated. Correct? Right. So here I need not solve. So from this example, what we can conclude is If share price increases crazily, bond price also increases. Share price falls, bond price also will fall up to a particular point. Beyond that, even if share price falls also, bond price will not fall below a particular point. Why? Who is protecting you there? Maturity value, like insurance policy. Are you understanding, sir? If share price increases, for example, first case I gave you share price of 25. Next case, instead of 25, make it 35. What will happen? Bond price will be increasing further. I made it to 22. Price fallen down, bond price fallen down. I made it to 19. Bond price further fallen down. But once it goes below that, whether bond price becomes, share price becomes 15, 3, 6, 7, for all that cases, bond price will not fluctuate. Are you observing, sir? Share price will have an impact on the bond price. But because it's an optionally convertible bond, impact is only limited. Which limited? Downside protection is there. Bond price will fall, but will never go below 1000 rupees. What is 1000 rupees? 1000 rupees is called as 1000, whatever answer you have, no. 1000 rupees, which one did you include here? That's why E price is called as the floor value of the bond. Below this, bond price will not fall down. Why it's called as floor? Sir, a bottle, if I throw it down, where will it fall? That's all. It's a downward limit. Are you getting it, sir? Originally, first calculation of your price was how much? 1187. Later on, it fell down to 1075. But later on, it fell down to 1000. Below this, it will not fall. Share price cannot drag the bond price below 1000. That's the meaning of that. Sir, if RR increases, it will fall. Of course, it will fall. Required return dances, then everything will change. I am talking the impact of share on impact on bond price. Share price increases, bond price increases. Share price falls, bond price also fall, but only at a particular level. Beyond that, bond says, I don't care, bro. I have maturity value. So that's why is street value of the bond ki another name is floor value of the bond. So as an investor, I want to know, okay, presently I am enjoying a good price. Let's say this one. $1187 point, first one, how much? 81. What is the floor value? 1000. Tell me this, sir. Do you know how to compute this? Yes, we only computed that. You know how to compute floor value also? Here, whichever is higher you will apply. Here you will not apply. You will directly take maturity value. Now, there are two types of perspectives now. Number one, I am a very pessimistic approach. I am always scared. How I will think is, my bond price today is 1187.81. Worst case, what will happen? Worst case, it will fall down to 1000. So there is a risk now. There is a risk of falling. Falling by how much? 187.81. Now, what you will do is, I will ask a question. You will frame a formula for me. Okay, formula ka name is percentage of downside risk. Tell me. Percentage of, you don't tell me formula, tell me number, that's enough for me. Fall ka chance is how much? 187.81. 187.81 divided by, I am talking about fall or rise? Fall. Fall you have to take which base? Higher base. From where are you falling? That's all. 1187.81 into 100. Some number will come. I'm least interested with the number. Convert this into formula now. How did you get 187.81? Market price of the bond minus straight value, or also called as floor value, divided by market price of floor value. Market price of the bond into 100. This is a formula of percentage of downside risk. What's the answer, by the way? Yeah, 15 point. Many people will have confusion about which base to take. This hopefully should clear it. Okay, now suddenly my perspective changed. Now I am feeling positive about myself. So there are two things, sir, always. Some people will always be happy, some people always will be sulking. This fellow feels that I may fall down to 187.81. Angle, if you are thinking, is the formula. Positively, how can you think? Worst scenario, my price should have been 1000. But actually, I am enjoying how much now? 1187.81. How much better I am? How much better I am by 187.81? You tell me the formula now. If I ask you premium over floor value of the bond, tell me, sir. Premium means how much better I am compared to floor value. 187.81. You express this in percentage. That's all I want. 187.81 divided by, tell me, sir. Very nice. Divided by 1000 into 100. So answer is 18.78%. Formula now. Numerator same formula. Market price of the bond minus floor value. Denominator, what will you take? Floor value you will take. People who try to by heart the formulas will definitely mess up. They ask this, you write here floor value. They ask this, you write here market price. Gone sum. Don't by heart. Common sense. If you are talking about fall, take the higher base. If you are talking about rise, take the lower base. Easy, over. Numerator anyway CMA. Clear, sir? Floor value ka meaning you understood? What is the meaning of floor value? This is the minimum price at which the bond can reach. Below that, bond price cannot fall. Share cannot drag the bond price below the floor value. That's the entire actual meaning of it. Of course, assuming RR constant. If RR dances, then bond price also will dance. With this, all the concepts relating to your convertible bonds are sorted, sir. You just have to do few questions. Sir, this entire worth is 7 marks. Time taken 5 minutes. Freely 7 marks you will get. Chalo, we'll get some 7 marks. Not all, everything they will not ask. Simple questions. This is why to wait? Directly do big question only. 34. Carefully read, sir. By the end of it, you will become pro. The following data is related to 8.5% fully convertible into equity shares, debentures issued by JSC Limited at rupees 1000. Okay, par value is 1000. Coupon rate is 8.5%. Market price of debenture 900. Market price. Conversion ratio 30. What is the meaning of 30? Good. One bond is convertible into 30 shares. Street value of the debenture, meaning floor value. Nice. Next, market price per share as on today. The expected dividend per share also is given to you. Sir, as you read, go on solving. First one, you are required to calculate. First one, conversion value of debenture. Work out, sir. Do. Solve. You are pro, but you have to prove it, no. Conversion value is equal to conversion ratio into market price of share today. 30 into 25 rupees. 750. Meaning of this you should not forget. Sir, as long as you remember meanings, this chapter level will increase. We'll try to enjoy this basically. Conversion value means instead of buying a bond, if I buy shares, it should cost me how much? 750. That's the meaning of conversion value. Next question, ma. Market conversion price. Here brackets on rate. This is nothing but parity price. Market conversion price means parity price. Because in our entire formulas, we learnt only one price formula. What's the meaning of this is, by purchasing a bond, effectively what is the cost per share? 30. Good. Formula, market price of the bond divided by conversion ratio. I'm happy if you are giving first answer and later on thinking about formula. The ideal zone. This is possible when you understand the meaning of the formula. Next one, sir. Next one. What's he asking, ma? Conversion premium per share he is asking. So first to work out conversion premium, divide by number of shares, we'll get conversion premium per share. First conversion premium will work out. Conversion premium ka formula is what? Market price of the bond minus conversion value. Market price of the bond is 900. 900. Conversion value first bit calculated 750. 150. Tell me, what is the meaning of 150? Meaning, good. This is the extra amount what I am paying for purchasing the bond. Requirement is not this, no. He is asking conversion premium per share. How to get this? 150 divided by 30 shares. So if you divide, you will get off, which is equal to 5 per share. Once again, sir, without getting irritated, tell me conversion premium meaning is what? Extra investment. Extra investment. Conversion premium per share ka meaning is what? Extra investment per share. Now look at the question once and tell me what is the market price of the share? What is the market price of the share? 25. Come to second bit. Did you work out parity price? What is the effective cost of you purchasing the share? 30. And the market low share price is 25. Indirectly you paid 30. And the per share extra you paid how much? So alternatively how you could have worked it? 30 minus 25 also you could have worked it. That also is conversion premium per share. Are you understand, sir? Write that also so that your thinking will be enhanced. He asked conversion premium per share. First we worked out conversion premium, then we divided by number of shares. Smart work. Conversion premium per share means extra investment per share. So effective cost I know, actual price I know, difference I. That also you can do. Next. He's asking conversion premium ratio. Conversion premium ratio and conversion premium percentage. Nice. Divided by conversion value into 100. And the extra investment ka proportion is asking. How much extra did you pay? 150 I paid extra, whereas I could have purchased all the shares only at 750. So I paid extra cost of 20%. In alternatively, how you can work out is share point of view also you can work out. Share ka price is how much? 25. How much extra did you pay per share? 5 into 100. Formula free SFM. Pure logic. Next. Oh, you're asking that premium over street value of the debenture, premium over floor value of the debenture formula. Write the formula, sir. You are all pro. Premium over street value or floor value, both are same only. Formula. Positive version, this one. How much better I am than the floor value. So market price of the bond minus floor value of the bond divided by floor value of the bond. Sir, floor straight both are same, okay? So no confusion there. Into 100. Price of the bond question given as 900. Floor value also given in the question, please check. 700. Denominator confusion come. Telling premium lower base, discount higher base. %28.57%. Well, next sir. Who is on the line next? Favorable income differential per share he is asking. Okay, no problem. First favorable income differential will work out. Coupon from bond minus expected dividend on shares. Bond ka coupon face value is 1000, coupon is 8.5, 8.5%. Presently, by purchasing a bond, I will get annually 85 rupees. That fellow will say, if you buy shares also, then also you will get dividend. No, yes. But how much dividend will I get? 30 shares into 1 rupee per share I will get. So by purchasing the bond, I am earning extra income of how much? 85 minus 30, which is equal to 55. 55 rupees extra income I am having. This is called as favorable income differential or difference. But a requirement of that fellow is favorable income differential per share. Okay, nice. Which is equal to rupees 55 divided by how many shares are there for us? 30 shares are there underlying the bond. So 1.83 or 55. Oh, nice. Nice memory. 1.833 per share. Well. Cool. This is about 6th point. Finally, what is he asking you? Premium payback period asking. Okay. Premium payback period. Yes, sir. Premium payback period. How to work out? I forgot. How much time will it take for you to recover the additional investment made through additional income? Extra investment by extra income. Extra investment ka name is what? Conversion premium. Extra income ki name is what? Favorable income differential. Conversion premium 150. Denominator of 55 rupees per annum. 727, huh? Okay, it's okay. Alternatively, you can work out like this also. I paid extra 150. Every year I am getting 55. So this is the answer. Share model also you can think. Share model how you can think is, per share how much extra did I pay? Per share how much is the extra income? We already computed that. Favorable income differential per share and divide this. Same answer. You have to get, you don't have a choice. 7 questions, 7 marks. Sir, are you understanding this? Logic, formula, practice. One more. Not hungry, huh? Angry also. 1 second. This one you solve on your own. Question number 33. This came in very recent examination. June 2024. Lo 7 marks it came. Once read the question. 8%. 1000 rupees face value. Market price given. Conversion ratio given. Street value given. Market price of equity shares on the date of conversion is given. Okay. Expected dividend per share is given. He is asking conversion value, market conversion price, conversion premium per share, ratio of conversion premium, premium over straight value of debenture, favorable income differential. Same requirements are same question. Can you handle this, sir? This came just last year only, 7 marks. This one also you can solve. Okay, fine. Solve this one. The MQP model question paper, June 23, 8 marks. Yeah. Read. Face value given. Oh, sorry. GHI Limited company issued fully convertible bonds on the following terms a year ago. Face value of the bond 1000. Coupon 8.5%. Time to maturity is 3 years. Brackets, so you see what is written? Remaining. That is exactly what I want. Bond price in some question we did know. Bond price is present value of future cash inflow. So which maturity is relevant for you? Original maturity or remaining maturity? Remaining maturity relevant, not the original maturity. So the bond is issued 1 year ago. Remaining maturity is 3 years. So overall maturity period is 4 years. 4 is waste for you. Already 1 year is over. No, hereafter only you should bother. Ee samlo, sir, twist is not there. Directly remaining only he gave. Had he given original and then given 3 years, and now he'll ask you bond price, you have to discount it only by 2 years because already bond is issued 1 year back. Remaining maturity is only 2 years in that case. Be watchful, sir, watchful. All points you know, you just have to apply correctly. Interest payment every year ending, principal payment maturity date, okay. Conversion ratio given, market price per share given, market price of the bond is given 1175. Oh, market price is given, nice. AAA rated company can issue plain vanilla bonds without conversion option at 9.5%. If it is a AAA rated bond, market required return for a non-convertible bond is 9.5%. Our company is which bond? Our bond is which bond? We do not know. That fellow gave only one RR, sir. We have to assume that our bond is a AAA rated bond only. You have to discount it with 9.5%. You don't have a choice. Calculate as on today. Number 1, straight value of the bond, you know how to do that. Conversion value of the bond, you know how to do that. Conversion premium, you know. Percentage of downside risk, you know. Conversion parity price, you know. Enjoy, sir. Start doing now fast. Luckily, PV factors are given to you. $32. First question is what? Straight value. Straight value of debenture or floor value, both are same only. Is equal to, what is the coupon amount every year? 8.5% on 1000. 1000 into 8.5%. 85 rupees into PVIFA. What is the discounting rate given? 9.5% up to 3 years. Next, 1000 into PVIF, 9.5% third year. This is maturity value. Sir, our bond is convertible bond only. I have to take whichever is higher only. But when I'm computing price of the bond, nobody is asking you to compute price of the bond now. They're asking straight value, floor value, minimum price. Worst case, this will happen. Worst case, I want to know. So that will be 85 into. Now, sir, remember this. We write this. But if the question gives you annuity factors or PV factors, you have to use that only. Why they give is so that answers valuation will be easy for them. Otherwise, each student will do different kinds of approximation. No. So what you do now, annuity factor key, a question of PV factors are given, no, total them. 0.9132 plus 0.8340 plus 0.7617. $2.5089 plus 1000 into 7617. Yes, sir. 974.96 is okay. Straight value is over, sir. Next, what is he requesting you? Oh, conversion value, how cheap. Conversion value formula, sir. Take conversion ratio, the number of shares per bond, into market price of share today. Tell me the numbers. What is the conversion ratio, ma? Each bond is convertible into 25 shares. Price per share is 45 rupees. $11.25. Well, who next? Conversion premium. Oh, formula. Nice. Market price of the bond minus conversion value. Price of the bond is how much? Question only they gave somewhere. See. 1175. How much is that? 50. This is conversion premium. Sir, conversion premium, whenever they ask you, you better work out in percentage terms also. If that fellow's expectation is that you solve this and leave, that fellow thinks that you don't know how to solve and you lose marks. Why to take risk? Work out this also. 50 divided by 125 into 100. 4.44%. Tell me, what does he want next? Or downside risk. You will tell me formula first. Downside risk is by how much you can fall down. So what's the formula? Market price of the bond minus floor value or straight value divided by market price of floor value. You are trying to fall down. No, falling down means you are already standing on the upper point. So market price. Straight value you only computed somewhere. 974.96 first bit. $17.024%. Okay, finally, what does he want? Parity price of share. What is the parity price of the share? If you buy the bond, effectively, what is the cost per share? So that's market price of the bond by conversion ratio. Market price of the bond is how much now? 1175 divided by conversion ratio is 30 or 25. 25. 47 rupees. You buying a bond is indirectly you purchasing each share by spending an amount of 47 rupees. Actually, share is available for only 45 rupees. So you spent how much extra for buying one share? 2 rupees. Take your calculator once. 2 by 45 you do and tell me how much are you having into 100. Conversion premium percentage. Extra investment ka percentage. Conversion premium 4.44%. Same answer will get. Anyway, that nobody asked you. Okay, sir, that's enough for today. You do this one also as homework. 31. 33 also homework I gave. 33 also homework I gave. I will solve one good question. This one. These two questions tomorrow we'll solve. 28, 29. Okay, so that's end of today's session. See you tomorrow. So yes, guys. So yesterday, after finishing off our discussion on yields, YTM, yield to call, yield to put, modified YTM, after covering all that, we have started the concept of convertible bonds. Convertible bonds meaning is instead of maturity value, the bond will give either an option or sometimes compulsorily the bond will be converted into some fixed number of shares at the end of maturity period. So convertible bond provide investor a facility to become the shareholder of the company at a later date. If he wants to become shareholder right now, then he'll get shares, but there is no fixed guaranteed income. So if you want to stay as a outsider for some period and later on become the owner of the company, convertible debentures provide that kind of feature. Okay, now how to compute the value of a compulsory convertible bond is just like normal bond only, sir. Only thing is, in place of maturity value, you have to take the conversion value. Conversion value means each bond is convertible into how many shares into expected market price of the share at the end of the maturity date. So in normal sums, we take maturity value here. Instead of maturity value, you will take conversion value. Conversion value is number of shares into market price of the share. Only thing is, this is not market price of the share today. This is market price of the share on the date of conversion, which is after some 3 years or 5 years, whenever it is. It is compulsory convertible bond. If it is an optionally convertible bond, then the investor has a choice either to take conversion value or to take maturity value. So he has a choice to choose both. Since he has a choice to choose both, he will obviously choose whichever is beneficial to him. Which one will be beneficial to him? Whichever is higher. So all the coupons you will discount. Along with the coupons, you will discount either the maturity value or the conversion value, whichever is higher. Since there is a single period cash flow, if you multiply with PVIF, that should be sufficient. Clear, man? Next. Then we went into another set of formulas. Before we recap that, let me tell you this. Then we discussed something called as straight value of the bond or floor value of the bond. What is the meaning of straight value or floor value? It is the value of the bond ignoring the conversion feature. Only maturity value you discount, conversion value even though it is there, you ignore it. That is called as straight value or floor value of the bond. What is the significance of this formula? The significance of this formula is, definitely in case of convertible bonds, the price of the bond definitely depends on the expected price of the share also. If the share price increases or decreases, bond price also will increase or decrease. But if share price falls beyond a point, bond price will not fall. Why? There is a maturity value which the investor will choose. So straight value and whatever you have computed, that is the lowest price bond can touch. That's why it is also called as what? Floor value of the bond. In connection to that, two formulas we have developed. One is what? Percentage of downside risk. By how much percentage I might fall down. So what is the formula for that? Market price of the bond minus floor value of the bond divided by market price of the bond into 100. Since you are talking about fall, you have to take the higher base. Either positively, if you see how much I am higher compared to the lowest value. I am not standing at lowest value. I am at market price only, but I want to work out the premium percentage over and above my lowest value. So since the base is taken from floor, then that is called as premium over floor value of the bond. So formula will be market price minus floor value divided by floor value of the bond into 100. So these are two formulas. And now apart from these, there is another set of 6 formula. What is that? First one, conversion ratio. Conversion ratio means each bond is convertible into how many shares. That is called as conversion ratio. Next there is something called as conversion value. Conversion value means number of shares per bond, that is conversion ratio, into market price of the share today, as on today. What is the significance or meaning of this? Instead of purchasing a bond, had you directly invested in shares, how much would it cost you? That is what conversion value gives you. Next, but we are not buying shares, we are buying bond. Since you are buying bond, you are paying extra. Extra amount paid is called as conversion premium. A conversion premium can also be expressed as a percentage of conversion value. So in that case, formula will be conversion premium divided by conversion value into 100. Then we have discussed something called as favorable income differential. By investing in a convertible bond, how much extra income are you enjoying? Extra investment is conversion premium. Extra income is coupon from the bond minus expected dividend if shares were purchased. This is extra income. Next one is what? Payback period. Premium payback period, also called as break-even period. How to work out this? Extra investment divided by extra income. Extra investment is what? Conversion premium. Extra income is what? Favorable income differential. And finally we learned parity price of the share, or also called as conversion price of the share. What is parity price? By purchasing a bond Indirectly, what is the cost per share? By purchasing a bond, it's costing you how much? 900. Effectively, that will convert into 40 shares, and therefore, effectively per share, you are paying an amount of 22.5. So this is called as parity price of the share. So E6 formulas, and then percentage of downside risk, premium over floor value of the bond. 8 formulas, so sir, questions are very popular in the exam. 7 marks straight answers are very simple stuff. So we have done some questions yesterday already. Then we'll see more. I have given you certain questions to solve on your own. I hope you have solved them. 31 and all. Let's do a good question. Come to question number 28. This is a foreign author book question, so it's a good one actually. It fits our purpose also. Phototech PLC. PLC is public limited company, sir. Generally in India we call it as limited. ABC Limited, Reliance Industries Limited, like that. Limited. UK it is PLC. US it is INC, Incorporation. In UK it is PLC. Anyway, Phototech company has in issue 9% bonds which are redeemable at their par value of £100 in 5 years time. Okay, fine. Alternatively, each bond may be converted on that date into 20 ordinary shares of the company, meaning either it will be converted or you can take cash also, par value 100. The current ordinary share price of Phototech PLC is 4.45 pound. Okay, share ka price, and this is expected to grow at the rate of 6.5% per annum for the foreseeable future. Share price today is given. Every year at what rate it will grow is given, 6.5. Now, can you take current share price, add 6.5 for a period of 5 years and ultimately work out price of the share at the end of 5th year? We can work out now, right? Don't work out now. Is it possible or not? Yes. That means you know basically what is the expected share price after 5 years. That can be sorted out. Next, Phototech PLC has a cost of debt of 7% per annum. What is that? We will see later on. Continue further. Calculate the following current values for each 100 convertible bond. Okay. Market price of the bond. Literally price of the bond he is asking. Then floor value of the bond. You know what is floor value. Then he is asking you conversion premium. So chalo, only 3 calculations they are asking. Chalo, so let's solve this. Right, sir. First calculation. Market price of share today, rupees 4.45. Expected price of share at end of year 5. 4.45, sir. Every year it seems it will grow at what rate? 6.5%. 0.065. Like that for 5 years growth is there. So please sort out this now. So each share is expected to have a price of 6.10. Sir, if you do not like that formula, you can take 4.45, add 6.5% equal to like that 5 times. That also will give you same answer. But this is smart work. You learnt all the future value formulas and all to apply, not for simply seeing once. You got to apply when you get the chance. Chalo, next. Price of the bond is equal to coupon amount into PVIFA. They have given you 7% for 5 years plus since it is a convertible bond, which one you have to take higher of? Maturity value. Maturity value is 100 or conversion value that we have to work out yet, whichever is higher, into PVIF 7% 5th year. 9% bond, okay, so it is 9 into PVIFA 7% up to 5 years plus maturity value is 100. What is conversion value? Each bond is convertible into how many shares? So 20 shares into, at the end of 5th year, price is expected to become 6.10. It's how much? 122. Huh? Between these two, whichever is higher, into 7% 5th year. 1 divided by 1.07, 1, 2, 3, 4, 5. Check out the final answer, sir. How much, sir? 123.89. Before we move on to the second bit of the question, I have a small sub question for you. Answer this. What is the requirement of first bit? Compute market price of the bond. Market price of the bond, if you have to work out, you have to discount with YTM, correct? Now we discounted it with 7%. Read in the question, 7% is described as what? They are describing the question 7% as cost of debt, but actually you have to discount it with YTM rate. Is cost of debt and YTM same? Same? No? Same, sir. Required return, if you discount, you will get fair value. Of course, we can assume that fair value and actual price are same because the bond is correctly priced. I don't have a problem. But the question is asking you, give me actual market price of the bond. If you have to work out actual market price, you have to discount only with YTM. So we need YTM rate. Question gave you cost of debt. We use it that only because there is no other discounting rate in the question. Then why did the question call it as cost of debt instead of calling it as YTM? That, listen. Sir, in your inter somewhere, cost of capital chapter you studied. In that KD formula you remember? Cost of debt. If you remember, formula was like this. Interest plus maturity value minus issue price of the bond divided by life of the bond divided by maturity value plus issue price divided by 2. You remember this formula? Isn't this formula similar to your YTM formula? Both the formulas are same only, sir. What is written to the investor, ade cost to the company. Isn't it, sir? It's not like YTM copied cost of debt formula. It's the other way around. Cost of debt formula is YTM formula. Whatever written investor is getting, that much cost company is suffering. So KD formula, YTM formula, both are same. That's the reason a question wantedly, very cunningly used the word cost of debt. Question, you please write this point. Cost of debt means YTM of the bond. Since the question directly gave you YTM, when you discount with YTM, obviously you will get the market price of the bond. That is the confidence with which he is asking work out the market value. Why did your minds easily accept when we give YTM formula? Because the formula structure you already knew in C Enter when you studied cost of debt formula. Same stuff. Okay. Market price is over. What is the second bit he is asking now? Floor value or straight value. Floor value of the bond, please work out. How to work out floor value? Take the coupons, ignore the conversion value, that's all. So which means I'm directly doing now 9 into PVIFA, 7% up to 5 years, plus ignore conversion value, 100 into PVIF, 7%, 5th period, 9 into 4.1002 plus 100 into 0.7130. $108.20. You got this? Very good. Floor value. Third question, independently, if you are able to answer, we'll be very, very happy. What is asking? Conversion premium. Now, carefully look at me. When they ask you conversion premium, without turning your head into formula, you tell me what is the meaning of conversion premium. Good. That's nothing but the extra amount paid by purchasing a bond instead of directly purchasing shares. Correct? This much idea if you have, formula you will write correctly. Write the formula. Is equal to market price of the bond minus conversion value. Okay. What's the market price of the bond? Don't search in the question. First bit answer you only solved. Other market price. 123.89 minus. What's the conversion value? 122. How did you get that? That is wrong. Adida trap. Sir, if I buy shares directly today, how much will be my cost? 6.1 rupee. 4.45. 4.45. So conversion value what you use for pricing of the bond. There you have to take share price at the end of 5th year. Expected of course. But when you are working out conversion premium, that has to be worked out on the date of investment. That means as on today. You observe, sir, that fellow very cunningly framed a question where third bit low conversion value we are using. First bit low also we are using conversion value. But they both are not same. Here conversion value is supposed to be standing at what point of time? 5th year ending. Whereas this conversion value is as on today. If you are thinking like how much extra investment I am making today in the bond, so share ka price also should be today only, no? So this conversion value should be as on today. Just because you already computed conversion value, don't pick up that as a trap. Number of shares per bond, which is 20 or 40 or 20 into rupees 4.45. Very important, sir. Small points, mistakes. It will catch off. They will not give you proportionate marks and all. Strike off that answer. Hello, sir. 89. 30. That's it. If you want, you can express this in percentage also. Mark this question important. Mark. Done, sir? Over? Chalo, move on next. Move on. Let's experiment on you. Come here. Question number 29. December 2024 examination question. When this question came in your exam, this kind of question is not there in your study mat or your past MQPs or past examination. The first of its kind question which came last exam. But conceptually same, nothing great. Read, Palsol Limited has issued a convertible bond with a face value of 1 lakh. Nice, 1 lakh. The bond pays a coupon rate of 6% per annum with interest payments made semi-annually. So half yearly bond. Coupon rate 6% per annum, careful. The bond has a term of 3 years, so 6 interest periods. And it will be redeemed at 1,10,000 rupees at maturity. Fantastic. Alternatively, the bond holder has the option to convert the bond into 50 shares at the end of third year term. Fantastic. The required rate of return, see the language of the question, how nicely they are giving required return. The required rate of return from the bond is 12% per annum. Fantastic. What else you want? Currently, the share price of Palsol Limited is rupees 2,000 rupees and the shares are expected to grow at an annual rate of 8%. Okay. The shares also pay an annual dividend of 50 rupees each. PV factors question only they have given. Total 6 periods they have given. PVIFs they have given for 3%, 6%, 8%, 12%. Now, what is the required rate of return of the investor? 12% per annum. But this is a half yearly bond. So all the cash flows will occur for every 6 months. So 12% you can't use, 12% ka half you have to take, which is how much? 6%. So out of the 4 rates given to you, only this is relevant for you. Rest all are traps. Are you getting it, sir? You should not do 6% ka half. 6% ka half you will do the coupon rate. That's not discounting rate. Discounting rate will never be coupon rate. No, sir. Discounting rate will be either required return or YTM. Sometimes they both are same also if the bond is correctly priced. Coupon rate will never become your discounting rate. So, PV factors are normally irrelevant for us. Only 6% is relevant. Continue. Analyze the value of the bond if it redeems at maturity. He is asking bond ka value, sir. Simple bond ka value. Chalo, sir, work out. But language you see. If it redeems at maturity. Right there, redemption means payment of maturity value. So he is not asking you actual price of the bond. Language wouldn't analyze the value of the bond. He never told price of the bond. Had he used the word price of the bond, I would have taken whichever is higher. Conversion value or maturity value, whichever is higher. What is he asking? Get me the value of the bond, assuming that it is paid in cash, not in shares. That means indirectly what is that? Floor value of the bond. What you are working out is indirectly floor value of the bond work out just there. Instead of asking that directly, he is telling that. Maturity value you consider. So, sir, do it up. Don't see, without seeing do. 29th one. It is considering okay, coupon amount. What is the face value of the bond given? 1 lakh into 6% per annum into 6 by 12. 3000. Maturity value. Question number, they told you that it is redeemed at premium of 10,000. So overall 1,10,000. Discounting rate per 6 months period is equal to 12% into 6 by 12. 6%. Value of the bond is equal to 3,000 rupees into PVIFA 6%. How many periods, ma? 3-year bond, but half yearly. Total 6 periods. Very nice. Continue. Plus 1,10,000 into PVIF 6%, 6th period. Into now, whenever the question gives you PV factors or PV factor table, use only that. Just because you know how to compute annuity factor, don't work out. Okay, question or whatever is given, use that. So 6%, 6 periods ka PV factor is given, no, sum total it 0.943, 0.89 plus 0.84 plus 0.792 plus 0.747 plus 0.705, 4.917. What is there, sir? We also will do annuity factor and take only 3 decimals. Sometimes, sir, that and this will not match because they expect you to use that only. Small rounding of error. Why to take that risk? Nobody will direct any marks for that as such, but still, the question gives you PV factors. Why to unnecessarily apply mind 0.705? Sometimes stupid people give wrong PV factors also. The problem. 3,000 into 4.917, 1,10,000 into 0.705, 92,301. Well. That's all, sir. Over. First question is only that much. Nothing very great, very normal, very simple. Move on. Assess the value of the share at conversion. There can't be a cheaper question than this. He's asking share ka value at the end of 6th period. Now you see, his share price is how much? 2,000. It is going to grow at the rate of 8%. And bond ka maturity date is how much? 3 years. So directly take 2,000 up to 3rd year ending at the rate of 8% annual growth. This is not cash flow, no growth rate. Directly only you can add, no problem. I hope they also have done like that only. No, correct. Good. Price of share, of course, expected at year 3 is equal to, what's the price of the share today? 2,000. Every year growth rate is how much? 8%. Like that it will grow for how many years? 3 years. Future value I want. Present value is there. Just to compound it. Square cube into 2000. 2519.42. Share price he has, we worked out. Next, sir. What else he wants? He's asking assess the value of conversion option. Conversion option ka value means worth of the shares. Conversion value at end of maturity is equal to conversion ratio into expected price of the share. Tell me, ma, each bond is convertible into how many shares? 50. Very nice. 50 shares into each share ka price is expected to become 2519.424. Multiply with that 125,971. Ask yourself, sir, concept is this small. It's coming for 7 marks. It will take hardly 7 minutes to solve this. Sir, SFM paper left with surplus time. Questions are much below the range what we are preparing. But safe side, sir, suddenly they can become big. So for that we have to cover ourselves with numericals, concepts and all. But Luckily, questions are very, very reachable. They are below your range actually. But you need to practice. In these mistakes and all we cannot do. Next. Advise which option is more advantageous for the bond holder. How cheap, sir? How cheap? Tell me. Which one will the holder take? Conversion value, maturity value ante? Toss chestada. He'll ask his friend, tell me. Whichever is higher. If you choose maturity value, how much will you get? 1,10,000. If you take shares, you will get 1,25,971. Isn't the decision very obvious? You are going to take shares, whichever is higher. That's the question. That's all right. Write like this, sorry. The conversion value rupees 125,971 is clearly higher than maturity value of rupees 1,10,000. Therefore, it is advantageous for investor to choose conversion option. Sir, the answer printed here is your suggested answer only, but conceptually that is wrong. What they have done is they worked out your conversion value ka present value, your expected dividends ka present value, they worked out. That they compared it with the floor value of the bond which we calculated in first bit. And they are saying that shares ka present value and dividends ka present value is better. Therefore, the investor should choose to convert the bond into shares. If you come to the question again, see the language of this. The bond holder has the option to convert the bond into 50 shares when any time, and in the next 3 years, any time you can convert. No. At the end of third year, today you cannot convert. That fellow wrote the answer as if you have the choice to convert the bond into shares any time. Are you understanding, sir? For example, first calculation ka solution, if you check what we have done, which is floor value. In this, we ignored conversion option. If we receive only cash from the company, the entire cash inflows ka present value is 92,301. Okay. Now, what is the second option I have? Instead of choosing maturity value, what can I choose? Conversion value. That fellow assumed that you have conversion option today also. If you have conversion option today also, immediately if you convert, what will happen? Your bond will translate into how many shares? 50 shares. On 50 shares, you will get what? Dividend income for the next 5 years, or sorry, next 3 years. And at the end of third year, a shares ka value also you know. So that you discount. Between these two compare, whichever is beneficial. But answer is wrong because the question clearly tells you that conversion option is existing for the holder at the end of third year, not during any time in the next 3 years. This answer, if you see, dividend income ka present value, 50 shares, sir. 50 shares you are having, dividend is 50 rupees per share. So total dividend is how much? 2,500 rupees. First year ending la 2,500, second year ending la 2,500, third year ending la 2,500. 2,500 ka present value. This is annuity factor. This is PV of dividends. At the end of third year, shares ka value is 1,25,971. We were calculated, that fellow rounded it off. Don't worry. That into 0.71 to the present value of the shares. The total value of your investment, if you convert this bond into shares right now, asal right now conversion ki choice is not there. I don't know what this fellow who wrote this answer was smoking. This answer is absolutely wrong for this question. The answer, when it will become correct, you know, here we should go and write during any time during the next 3 years. Then the answer is correct. Question clearly shouting you have option to convert only at the end of third year. As a third year ending lane shares, that too not compulsory. How foolish it is to take first year, second year, third year dividend into consideration, sir. You will never have a right to get them. Are you getting it, sir? So that is definitely wrong. If you want to LBQ, write a small note on that. Guideline answers given by institute for fourth question is based on assumption that option to convert bond into shares is available today itself. This is wrong, since the question clearly specifies that investor can convert the bonds into shares only at the end of year 3 and not before that. That's why whatever answer we have given is correct. We can't change the question to match his answer. No. Example, that question comes, you can't by heart this wrong answer and go and write. You learn what is right. Guideline answers they will give you, this is not the basis for valuation. So that's what they have given it to you, but valuer at the time of valuation they'll do correct valuation. Nothing to worry. Move on. Cheap sum you handle. 31 is over, 32 is over, 33 is also over, 34 is also over. Oh, come here, sir. Please write, please write. You're writing, huh? Sorry. Right. Or slowly write, no problem. Over, overing up. Okay. 35. Following information is related to convertible bond of A Limited, okay, which is currently priced at 1060. So convertible bond come market price is 1060. Conversion parity price is given. Tell me, ma, what is the meaning of this? Meaning, I don't want formula and all. Meaning, conversion parity price of the share formula. Meaning, by purchasing a convertible bond, what is the cost per share is called as parity price. What is the formula now? Market price of the bond divided by conversion ratio or number of shares is equal to parity price. Now, market price you know, parity price also you know. Can you work out number of shares now? That's all. That's the first question. Finish off that first. Anyway, you told me. parity price of the share is equal to market price of the bond divided by number of shares. This is 53, this is 1060, this I don't know. Well, now after finishing of this, slowly see what is the next question. Think over and tell me how to solve. What is the next question is asking, sir? Conversion premium he gave you, conversion premium. He is asking market price per share. Oh. First of all, you can go into formula level, somewhere substitute and get. That is one way. Conceptual thinking. Conversion premium percentage means what? Over and above the share value, how much extra are you paying? Correct? How much extra you are paying, that is only conversion premium. That means, that too he is asking current market price of share. That means, visualize this. If current market price of the share is X, the actual market price. This plus something is your effective cost of buying share. The effective cost of buying share, we are calling it as what? Parity price. Parity price already previous bit they gave. How much is that? 53. And now he tells you that the conversion premium percentage is 10.41667%. You know what's the meaning of that? It means that compared to your actual market price, your effective cost, which is nothing but the parity price, a parity price is higher by 10.41667%. That means if actual market price is 100, then parity price is 110.41667%. Now he is asking now second bit, tell me actual market price. How you have to solve? How you have to solve is, if this is 100, this is 10.41667. This is now 110.41667. Now tell me, this 110.41667 ka number is how much? 53. He is asking how much is 100. Do under calci. Right, 53 divided by 110.41667 into 100. 47.9999, 48. No formula, nothing, simple interpretation to one line answer. You see what they have done. This much calculation they have done. You need not solve. If you understand the logic. No sir, this much thinking we cannot do. We want formula. Okay. Tell me. Conversion premium ka formula you know? Conversion premium percentage ka formula. Market price of the bond. Wait. Market price of the bond is available? Available. Minus conversion value. That is conversion premium. Divided by conversion value into 100 is equal to 10.41667%. Correct? In that market price you know. Percentage premium you know. What you do not know? Conversion value you do not know. Conversion value work out. Number of shares per bond you already worked out. Conversion value divided by number of shares, you will get the market price of the share. That way also you can work out. Same 100% same answer will come. So sir, let's start. First formula, then logic. Both we will do. Conversion premium percentage is equal to market price of the bond minus conversion value divided by conversion value into 100. 10 point some number 41667 Market price of the bond is 1060. Yeah? Conversion value I don't know. Carefully solve this. So correctly process this circuit. Calculation and all, how will it work easily for you? I'm thinking. It's okay. Do the original one. 10.41667 into conversion value is equal to this side 100 to numerator I multiplied, denominator I throw it that side. Okay. Now 110.41667 conversion value is equal to 1,06,000. Therefore, conversion value is equal 960. Conversion value ka meaning is number of shares per bond into market price of the share today is equal to 960. Number of shares per bond already we computed as 20. If you find this one easy, stick to this. That's all over answer. My point is, it is much more easier to think like this. Never be lazy of thinking. Conversion premium is equal to 10.41667%. It means the effective cost is 10.41667% higher than actual market price. Effective cost a parity price. Effective cost a parity price of the share. Sir, this is all for your thinking. I am telling. Answer one line I will get. If market price of the share is 100 plus 10.41667%, which is equal to 10.41667, 110.41667. This is your parity price. So my question is this. If 110.41667 is representing your 53, he wants cross multiply. This will go here, this will come here, this will go there. So it will be, or else you can't think like that, think like this. 100 is how much? Any which way. 53 into 100 divided by 110.466. Directly you will get your answer. $53 into this divided by this. 110.4166753 అయితే 100 is how much? If you divide by 110, per 1 rupee will come into 100 multiplied, so 48 will come. Chalo. What is the next question is asking? Next question is straight value of the bond. Okay. Straight value of the bond you want. Any formula there? Directly have to work out. No. There is one more question they have given. Data, sorry. Percentage of downside risk with respect to straight value of the bond is 12.766%. Oh, then you should know that formula then. Do you know? Sir. Now tell. Percentage of downside risk. Tell. Market price of the bond. Wait, this one also I will only tell you. Straight value. Denominator you tell. Pinky. Percentage of downside risk means rise or fall? Fall. From where to where you can fall? From market price to floor value you can fall. Floor or straight both are same. So denominator who should be there? Market price is straight. Market price. Discount ki higher base. Premium ki lower base. So who should be there in the denominator? Market price of the bond. Into 100. Now, the percentage of downside risk you need not work out. That fellow gave you. How much is that? 12.766%. Don't write percentage there. Percentage is symbol. It said 100 undi kada. So just write 12.766. That's all. If you write percentage again, you end up dividing by 100 again. Wrong answers will come. Careful. If they are giving percentage, ka meaning is this side 100 is there. Again, if you write percentage here, then you will go and divide with 100 here. A double effect just careful. Percentage is only a symbol when you multiply with 100. Okay, not so fast. Tell me market price of the bond first. 1060. Straight value, that only we have to work out, no? Divided by 1006. 12.766 into 1060 divided by this 1060. 924.68. Good. Or sometimes printing error will be there, sir, from your suggested answers and all. Don't mind. This is the correct answer. Your guideline answers always need not be right. Your study mat always need not be right. But you have to learn what is right only. Over. How many marks is this question, sir? 7 beautiful marks. See here. The answer, what is? I did not write this answer. Don't misunderstand me. Printing error, sir. Printing error. Not my printing error. Original formula wrong. Guideline answers. Denominator of floor value or straight value if you are taking the premium over floor value, not percentage of downside risk. Just for the sake of this one question, you should not change the formula. No, other questions will go wrong. Careful. How much was the answer? We got 920. 924.68. Chalo, so this is done. Sir, with that our questions on convertible bonds are also done, sir. This one you can go through it, simple question like that is. Chalo, we'll move on to next concept called as forward interest rates. This forward interest rate concept is little heavy concept compared to all the other concepts till now. But you do not have a choice. Unfortunately, it's part of your syllabus. Now, okay, come here. Then the next concept what we were talking is forward interest rates. Forward interest rate ka general meaning, think like this. Sir, I am standing today. I am predicting what is the interest rate that is going to prevail at a later date. That is called as forward interest rate. Standing today and predicting after 1 year what rate is going to prevail in the market, that is called as forward rate. After 2 years, what rate is going to prevail in the market, that is called as forward rates. Now, estimating interest rate of a future period as on today is called as forward interest rate. Now, so it is like this, sir. Zero, first year, second year. This fellow is standing here and he is predicting what interest rate will prevail in the market for 1 year transaction after 1 year. That means, e period la, if a borrowing or deposit happens, that rate of borrowing deposit will happen at what rate? So, interest rate for 1 year, either borrowing or deposit. If this is estimated today, that's not discounting at all, don't misunderstand, that's not a cash flow, interest rate. Estimated today is called as second year forward interest rate. Sir, directly you started with second year forward interest rate. What about first year forward interest rate? Array sir, you tell me first year forward interest rate I need to predict. Already I know. There is nothing to predict there. This one, since you are not predicting, since you already know, we usually don't call it as forward rate. Forward rate, some estimation will be there. Today, if you borrow or deposit, what interest rate bank will quote? Bank will directly tell you no. Why do you need to estimate that? You need not estimate. That's why we don't call it as 1 year forward rate. But still, if you want, you can call first year rate as 1 year forward rate. No problem. But as such, we'll start only with second year. For this, there is another name. This is Basha. Another name is also called as one year forward rate, 1 year forward. Careful, sir, all these are examination languages. The interest rate what you are predicting now is for which period? Second year. You are standing at 0 time. After 1 year, what interest rate will prevail for 1 year transaction? That's what you are predicting now, correct? We simply can call it as second year forward rate. That's easy. But sometimes questions, so they will do overaction like this. 1 year forward rate, 1 year forward. What is the meaning of this? Look at this. Is second 1 year forward rate? Is there no second line? That means from here, go to 1 year. From here, if you make a borrowing or deposit for a period of 1 year, what interest rate will the bank charge? Our rate you are predicting. That is nothing but second year rate only. They both are same. They interchangeably use this. Okay, so second year forward rate is also called as 1 year, not first year forward rate. 1 year forward rate, 1 year forward. If I call it as first year forward rate, then you should ask me, sir, are you mad or what? Here second year, here first year. I am not calling it as first year forward rate. First year forward rate means this one. No. I am talking about 1 year forward rate, 1 year from now. That's the meaning of it. I hope there is no confusion now. Okay. So this is second year forward rate. Now you will tell me third year forward. Help me drawing the diagram, sir. Tell me, which period is borrowing deposit here? Third year forward rate means 0 to 2 is 2 years forward. Ah, good. So your borrowing deposit period is this one, or I'll put like this. So tell me now, borrowing or deposit is happening when? Second year ending. Be clarity, sir. When you write 2, the second year ka ending or third year ka beginning. So third year beginning la borrowing or deposit is going to happen. That is going to run for a period of 1 year. For that, at that time, what interest rate bank will quote, that if you predict today only, that is called as third year forward rate. Are you getting what I'm trying to say? So similarly here also, this is your borrowing or deposit period. This is also your borrowing or deposit period. Now E period la, what interest rate will prevail if you stand here and predict? Interest rate estimated today is referred as what, ma'am? This is called as third year forward rate. Very good. Or you will tell me this. I will write half, remaining you will tell me. 1 year forward rate. Good. Not 2 years forward rate. 1 year forward rate. Because the borrowing or deposit is going to happen only for a period of 1 year. That's 1 year interest rate. But the 1 year is how far from today? 2 years far from today. So what is the language I should use? 1 year forward rate, 2 years forward. This is distance from today. This is period of borrowing deposit. Clear, sir? This will be confusing only, sir, but handle it. Not difficult. Pay attention, it will be easy. Now, what is the meaning of fourth year forward rate? Fourth year forward rate means borrowing is going to happen at the beginning of fourth year, going to run for a period of 1 year. It is 1 year forward rate, 3 years forward, like that. Okay, next. Now you will tell me what do we call this? Zero, 12 months, 6 months. This is the period of my borrowing or deposit. This I am estimating today. That is definitely forward rate because it's for a future period ka estimate. Pakka forward rate hai. But how should I write this? Do you agree that estimating interest rate, this is nothing but this is a 6 months forward rate, comma 6 months forward. Is the language clear for you? From here, how much distance is there? That is second plane. First part is period of borrowing deposit. So this one is period of borrowing or deposit. This one distance from today till the date of borrowing or deposit. Clear, sir? Now, next question. Sir, how will I estimate that? Forward interest rates are estimated using expectation theory. Theory name is expectation theory. Now, for this one formula is there, sir, but a formula the flaw is You can only remember the structure of the formula, but not the formula itself. Because depending on the data, a formula ka powers and all will change off. So you should only know the basic skeleton of the formula. Depending on the case, you have to customize the formula. So that's why you have to learn the entire logic. There is no option. But this is not difficult, easy only. You need not write this, sir, because this is part of your concept book. So time being, just watch. Sir, I am taking a time frame of 12 months with two investors in my hand. One is Mr. A, other fellow is Mr. B. Both are having today an amount of 100 rupees to invest. Both are having same amount of 100 rupees to invest, and they are willing to invest money for a period of 1 year in same kind of investment. Imagine some risk-free bonds. That first fellow is also investing in government bonds, second fellow also investing in government bonds. So the level of risk they are taking, same. The amount what they are investing, same. The time horizon of their investment is 1 year, that is also same. But the only difference is, if first fellow will invest 100 rupees directly for a period of 12 months. Whereas second fellow will invest his money for a period of 9 months, withdraw the money, again reinvest it for a period of 3 months. First fellow will directly invest for 12 months period. So here direct 12 months period, this fellow first for 9 months period, later on for 3 months period. Ultimately both are investing for 12 months. Both are investing in similar kind of investment. Since risk level is same, return earned also should be same only. Since starting amount is same, risk is same, required return is same, climax amount also should be same. That means E number and this final number, they should be same. Okay, sir. Now let's take some interest rates for understanding. Let us say Mr. A went to the bank, asked the bank, bank, I am depositing money with you for a period of 12 months. What is the interest rate you will give me? Bank said 12% per annum. Okay, 12% per annum. Now you tell me, sir, for 12% per annum, what is the compounded value now? 100 will become how much, sir? 100 into 1 plus 0.12 whole power 1, 112. Clear? Similarly, Mr. B also went to bank, told bank, I will invest money with you for a period of 9 months. What is the interest rate? Fine. Bank told, interest rate applicable for you would be, not like that, so it won't be like that. 8%. 8% per annum. Now you tell me what's the future value? 100 into 1 plus 0.08 PIR into 9 by 12. Good. 106. Till here clarity is there. Now what is Mr. B going to do? After 9 months, withdraw the money, again invest it for a period of 3 months. At what rate he will invest means, at the time whatever rate prevails, our rate he can invest. My point is, standing today, I want to know this rate. I want to know this rate. How will I know this rate? Sir, you are both A and B are standing today. A went to bank, I will make a 1 year investment. What is the rate? Bank told 12. B went, sir, I will make an investment for 9 months. What is the rate? Bank told 8. But B in his mind knows that after 9 months he will withdraw the money, again reinvest for a period of 3 months. So what is the 3-month interest rate that will prevail after 9 months from now? I want to know this forward rate. I want to know 3 months interest rate after 9 months from now. Do you agree that a circled number is nothing but forward rate only? Because it's a future period ka interest rate. Sir, how will I know? How will you know? It's very simple. Look at the corner. Top root climax amount is how much? 112. This fellow also should have 112 only, because he is also investing in similar investment. He is also investing same amount. He is also investing for the same 1 year only. And therefore, confidently I can write, can't you work out the rate now? 106 rupees should become 112 rupees in a span of 3 months. Can't you work out rate now? It's easily we can work out. Okay, now 106 into 1 plus PIR is equal to 112. So PIR is equal to 112 divided by 106 minus 1. So 0.0566, or we can say 5.66%. But careful, this PIR, that means it is only 3 months rate. You have to annualize it, no? Annualize it. Annualized forward rate 5.66% into 12 months divided by 3 months to 4. 20. Everything is correct only here. Let's check. Correct only 106. 106. Everything is right. Fine, no problem. So 22.64%. That means, what are we trying to say is, if root 1 ka cash flow, root 2 ka cash flow ultimately has to be same, then after 3 months, market interest rate should be prevailing at 22.64%. This 22.64% is called as the forward rate. This is the 3-month forward rate. 9 months forward. That much huge gap will not be there. Just for understanding, I put, sir, it won't be 10 and 22. That much change will not be there. Small changes only will be there. But as such, that's how. Now, sir, every time we have to predict a forward interest rate, do we need to do the whole thing? No, sir. There's a small shortcut. Watch this shortcut, sir. See if you can understand this. Our entire period is how much did we take? 12 months. In this, first 9 months ka interest rate is how much? 8% per annum. This period interest rate only we have to work out, that we do not know. The entire long period ka interest rate is how much from here to here? 12%. Okay, no problem. 12% per annum. Now, formula is this: 1 plus short period PIR into 1 plus forward interest rate is equal to 1 plus long period PIR. Sir, what is this long short? Simple, sir. This is forward interest rate. This period is called as forward period. Remaining period lo who is long, who is short, you have to identify. Who is long? 1 year is long. Who is short? 9 months is short. Fill up, you will have your answer. So, if I fill up the numbers now, what is the short period PIR? 8%. 0.08 into 9 by 12. Careful, you should not fill up 8 directly. Interest rates are always on per annum basis. Into 1 plus, I do not know this, that only I have to work out. Actually, I know we computed, but 1 plus 0.12. That's anyway for whole year, no problem, directly you take. If you sort out this, 1 plus forward interest rate is equal to 1.12 divided by 1.06. The forward rate is equal to 1.12 divided by 1.06 minus 1, which is equal to 0.0566 or 5.66%. If you want, you can annualize it. You need not draw this entire diagram and do. This is for just understanding what is the logic behind it. E formula, if you remember, that's enough. E formula, only thing where people get confused is when I say short period PIR, people write this one. That is wrong. Why? This you don't know. No, this only you have to work out. This is your forward rate. This you do not know. E forward rate is this one, which you don't know. Remaining two you know. So one is short, one is long. Correctly fill up. That's it. E formula ka structure only you can remember. Sir, formula is easy now, will remember. Remember. But when I do 3 years, then you have to put squares, cubes and all. Within 1 year, you are seeing no powers and all. If I take one example, pick up the question book, sir. Come to the first example, please. They gave you market interest rate for 1 year, 10%, market interest rate for 2 years, 11%. Calculate second year forward rate. What nonsense are you talking? Second year already given? No, no sir. The 2 years ka rate. This 1 year ka rate. Sir, imagine you go to a bank, any bank, especially public sector bank, SBI or something like that. There, fixed deposit ka one chart board will be printed. That fellow will put like this. 1 year deposit, 10%. 2 year deposit, 11%. 3 year deposit, 11.5%. All the percents are quoted for per annum only. No, obviously. What is the difference? This is a 1 year time deposit. This is a 2 year time deposit. This is a 3 year fixed deposit. Like that only. 2 year transaction if you do, interest rate is this. 1 year transaction if you do, 10%. What I want is, after 1 year, if I do a 1 year transaction, what is the interest rate? That is called as second year forward. You understand, sir? Combined 2 years ka rate is available with you. Only 1 year ka rate is available with you. What I want, after 1 year from today, 1 year rate I want. But actual reality lo you will know only when you reach there. But today I am trying to estimate that. Okay, now come here. Question number 37. All this kind of questions, Loma, first you draw the timeline, life will be simple. 0, 1, 2. What you have to predict, first identify this one. This is called as what? Forward rate, forward interest rate. Now what is given to you is one long period rate they have given. They have given to you one short period rate. Short period rate is given as how much? 10% per annum. Long period rate is given as 11% per annum. Now you have to structure your formula. If you tell me your formula now, 1 plus short period PIR, periodic interest rate, next into 1 plus forward interest rate, which should be equal to 1 plus long period PIR. Do you agree? I have to put this. I have to put whole square. Why whole square? 2 years. Sorry, earlier example you did not put, no sir. Earlier example, long period was only 1 year. Why will I square it? As annual compounding law, whole power 1 only will come when you are investing only for a period of 1 year. Whereas here you are investing for how many years? 2 years. Is 11% not for combined 2 years? Per annum. So up to here 11, here to here 11. Total whole square. Fill up carefully. That's why I told formula ka structure only. Can't by heart the formula. Numbers fill up, sir. 1 plus short period PR, which is 1 plus 0.10. FIR I do not know. Long period rate I know. 0.11 whole square. Work out this. This is easy. Calculation is easy. No hurry, sir. Peacefully draw the diagram. Think on your own. Code the formula. Peacefully work out. How much is that? 1.11 whole square divided by 1.10 is equal to -1. 0.120091 or 12.0091. Questions will be easy, sir, but they are expecting you to be good conceptual, otherwise you can't handle. Okay, watch this. Sir, somebody directly makes an investment for 2 years. How much return is he getting? 11%. Somebody wants to make first year 1 year investment, withdraw the money, again make another 1 year investment. They should also get 11% per annum on an average, correct? But already first year they are getting how much? 10. So second year they will get 12.0091%. Simple calculation on your calculator, sir. 10 first year plus second year 12.0091% is equal to divided by 2. How much are you having? 11% average. That means what? What I'm trying to say is, somebody see, logic you should not forget. Where from the entire concept started from here, no. Whether you invest for 1 year directly or you invest the same 1 year in parts, ultimate answer should be same. So how much should be this rate which ensures that both the options are equally good? Somebody is investing for 2 years, they are earning 11%. You invest the same 2 years in 2 different installments, then also your return should be 11% overall. But exclusive second year, how much are you earning? This one. That is the meaning of this. So if you have any doubts, you have to ask. Sir, is it clear or is it confusing? Sir, formula substitute, yes, answer is very, very easy. Don't worry about the answer. Logic, try to learn. Somebody invests for 2 years directly. Somebody invests for the same 2 years in parts. Both of them should get the same answer, same return. That is possible when second year ka rate will become 12.0091%. Then only that is possible. That's all. Next question, please. 38. This time little next level he went. What is he asking? He gave first year rate, second year rate, sorry, 2 years ka rate, 3 years ka rate. He's asking you now third year forward rate. Watch me draw the diagram first, later on you can solve on your own. 0, first year, second year, third year. Tell me, sir, which period ka rate you have to find out? 2 to 3, correct? So this is what you do not know. Once you identify your period, now remaining period you have to identify it as long or short. Tell me, this period is long. Who is short? 0 to 2. Tell me, sir, short period interest rate is how much? 2. Good, very nice. 2 years ka rate I want, which is 11%. 3 years ka rate I want. Now I'll be very, very happy if you can code the formula. Nothing to worry. Don't hurry. Peacefully copy. Nicely do. First FIR if you identify, remaining is easy for you. Sir, will you tell the formula or I should write it? Then tell. 1 plus 0.11. Good. Whole square into 1 plus forward interest rate is equal to 1 plus 0.12 whole cube. That's all over. .12 square cube 0.404928 divided by 1.11 whole square. 0.14027 or 14.027%. What is this? Is it third year forward rate? Clear, sir? Are you understanding, sir? Meaning and a formula ka coding you should learn. A formula you can't by heart. You can only understand the structure of it. Move on. Next question. Now, whatever concept we have learned, our concept now I'm extending from interest rate to yield. Watch this question. 1 year bond if you buy, a bond will give you a return of 10%. Not coupon, yield. That can be coupon, that can be capital gain, that can be both. 1 year bond if you buy, you will get a return of 10%. Other 2 years bond if you buy, you will get a return of 12%. But question is, only second year ka return. Only second year ka return. Sir, 2 years bond if I buy, and you are saying that my return is 12% per annum, doesn't it mean that first year I earn 12, second year I earn 12? No, it won't be like that. It won't be like that. Why it won't be like that, I'll tell you. First, let's mathematically solve the numbers, then peacefully we'll sit and interpret. Okay, sure, do it, sir. This is one, consider it as 1 year interest rate, consider this as 2 years interest rate, get me forward interest rate first. Then we will talk. One plus 0.10. Tell me, ma, do you need to put square? Good. Into 1 plus forward interest rate is equal to 1 plus 0.12. Do you need to put square or not here? Here you have to put. Good. Next. Forward interest rate is equal to. Correct, sir. 0.14036 or 14.036%. Of course, per annum. This is your yield in year 2. Now I'll write one small interpretation. Go on writing with me. If we buy a 1 year bond, 1 year bond means maturity is 1 year. YTM is 10% per annum. That is yield in first year, it's okay, it happens, is equal to 10%. If we buy a 2 years bond, YTM is given as how much in the question? 12% per annum. It means in first year, investor will earn 10% per annum plus in second year investor will earn 14.036%. So when I say your YTM is 12%, it's not like every year 12 you get. You won't get like that. You first year your return will be 10. Second year your return will be 14. It is as good as you are earning 12% in each year. Okay, so just for understanding I'm telling, take your calculator. Write 100. Add 12%. Again add 12%. 100 plus 12% plus 12%. How much are you having now? 125.44. Correct? Leave it. Again, cancel it. Write 100 again. Add 10%. To that 110, now add 14.036%. You are still having the same answer, 125.44. What am I trying to say is, you invest in a bond with 2 years maturity. Your first year ka return will be 10, second year ka return will be 14. It is as good as you are earning 12% each year. YTM is that. But year to year 12 you won't get. First year 10 will come, second year 14 will come. That is the interpretation of that. Sir, how are you so confident? Simple, sir. Logic. Imagine there is a government bond, ma. First bond, 1 year maturity. That means it will start here, it will end here. There is another bond which is 2 year maturity. Now, from the given data, what I understand is, a 1 year bond if you buy, you will get how much return? 10%. If you buy a 2 year maturity bond, your overall return, the question tells you, is 12%. If you really believe that first year low 12% will come, second year low 12% will come, why that is wrong is, listen carefully. There is a particular investor, sir. Okay, he wants to invest in government bonds for 1 year. General question I am asking, between these two, where will he go? He wants to invest only for a period of 1 year. First bond or second bond? Where will he go, sir? General, simple question. Don't know. Second bond. Why? Second bond 12%, not interest, yield. Okay. So, if but he wants to invest only for 1 year, no? Why are you taking him to second year bond, 2 years bond now? You have an idea. What is that idea is? Simple, sir. I buy the bond now, 2 years bond only. Wait for 1 year. Sell off the bond. Then sell the bond also. No, you need not wait till maturity. You can always sell the bond. Then you are making your investment for 1 year. Moreover, you are earning a return of 12%. If this is true, market lo no fool will buy this bond. Correct? If nobody will buy the bond and people who already have the bond, they start selling the bond, what will happen to bond price? Falls. When bond price falls at one particular level, e-bond also will give you a higher return. Because bond ka yield depends on investment in the bond. If price of the bond falls, yield will again increase. So this is impossible that e-bond first year will give you 12% return. It won't give you. Whether you buy this bond or you buy this bond, next 1 year ka return will be only 10%. Why? Both are government bonds, both are risk-free bonds. How can one bond give you 10% return, another bond give you 12% return in the first year? Impossible. Impossible. Sir, then you told YTM is 12%. YTM 12 ka meaning is not every year 12. That's not coupon rate. Yield, return, compounded return. That means first year you buy this bond, you will get 10% only. Second year if you stay, then you are expected to get 14.036%. Overall, it is as good as you are making a return of 12%. That is the meaning of that. Do you understand, sir? If it is really like here also 12% return you get, here also 12% return you get, which fool will buy this bond first? Nobody will buy. In fact, people who already have, they also will sell. When they also sell, what will happen? Bond ka price will fall. Up to what level? Till it gives a return of 12%. Then again, this and this are same. No. What I am trying to say is, E bond first year what return it gives, this bond also will give you the same return because the risk is same. Sir, then how this bond is giving higher return? Extra return, whatever is there, that comes because of the future period. The Adi interpretation. Clear? Move on. The 39th question, sir. Come to 40th question. Here one beautiful interpretation is there. Calculate the price of 2-year bond having a coupon rate of 12%, face value 1000 and redeemable at par. Wait there. Bond maturity 2 years. Coupon is 12. Face value is 1000. Maturity period is okay. Redeemable is par. Okay, nice. Question A directly giving you YTM of this bond is 12%. This is 2-year bond. Ante the 2-year bond ka YTM means E12 is nothing but this 12. He is only telling, whereas yield for 1 year is, first year is 10% per annum. Which one? Ide data. And yield for year 2 is 14.036%. Same data. That means question 40 is derived from question number 39 ka data. Okay, now I gave you a 2-year bond. I am asking you to work out the market price of the bond. Normally, how will you work out market price of the bond? You discount all the bond cash flows with the yield rate, YTM rate. So how many years bond is this? 2-year bond. A 2-year bond ka cash flows whatever are there, which is coupon for a period of 2 years, maturity value at the end of second year, you will discount it with YTM rate. You got an amount of 10,000 rupees. Sir, why did I get 10,000 rupees exactly? That's because your coupon rate and your YTM rate both are same. When they both are same, bond will be trading at par value. That's the reason answer is exactly 10,000. But if you mathematically compute 1 divided by 1.12, 1.69005 into 1200, 0.7972 into 10,000. It will be something at 10,000.06 or something like that. I rounded it up to 10,000 rupees. Okay, sir. First one is normal tarikala, how you work out bond price, like that I worked out. Why I framed this question is to teach you another alternative. Another alternative is like this. Sir, you earning 12% per annum over a period of 2 years is as good as you are earning 10% in the first year, 14.036% in the second year. Watch the timeline of the cash flows correctly. It's very important stuff what is happening in front of you now. The first year cash flow is how much? 1200. Second year total cash flow is how much? 11,200. First year how much return will you get? Only first year 10%. Only second year 14.036%. So what I will do now is, if first year, whenever first year to 0 time we have to discount, I will discount using 10%. From second year to first year ending, if you have to discount, I will use 14.036%. Okay, because that's nothing but yield of that particular year. So E1200 is standing where? First year ending. And you have to drag it to 0 time. That means you have to discount it back by how many years? 1 year. And that 1 year falls under which year? First year. First year yield is how much? 10%. Discount it with 10%. I am getting 1090. What happened, ma? Face value is 10,000, no? Oh, I gave you some printing errors there. Wait a moment. 10,000 is. I'm sorry, sir. You're right. Please make it 10,000. Our own created question, no mistake happened. No problem. It should be 10,000. Okay. So my point is, if first year ka cash flow I discount it with first year ka rate. If second year cash flow is standing where? Second year ending. It has to drag to 0 time. But that will not happen directly. It will happen in 2 stages. First stage, from where to where? From second year ending to first year ending. That means you have to remove which year ka return now from that? Second year ka return, not 2 years ka return. Second year ka return. Second year ka return is how much? 14.036%. Discount with that rate. Now it stands here. It is standing where now? First year ending. First year ending to 0 it has to come. So you have to remove which year ka return now? First year ka return. Discounting means deducting a first year ka return you remove 10%. Then also you will get same answer, sir. And exactly it will not match. Almost approximately it matches. So that means you discounting bond cash flows directly with 12% is as good as you discounting first year cash flow with first year yield, second year cash flow with second year yield up to first year ending, from there to 0 again discounting with first year yield. Here what we are locking is discounting rate of each year we are locking. Whenever you pass through this zone, 14.036% is applicable. Whenever you pass through this zone, 10% is applicable. You can work out bond price in any of the two methods. Till now, all the sums, we applied only this. Forward interest rate sums, we should know this also. It will work like that also. Sir, 19 rupees is a big difference. No, sir. Array, sir, par value of the bond is how much? 10,000 rupees. 10,000 rupees, 19 is chiller. If it is 1,000 rupees bond, difference would have been 1.9. If it is 100 rupees bond, 0.19. Are you understanding, sir? Because I took a 10,000 rupees bond, 19 rupees approximation error is looking big for you. Had I made a 100 rupees bond, the difference would have been 0.19. That's a very small chiller error. Okay, but this will work. Where, ma'am? I didn't get you. It's price, sir. Okay, this one. That's 1200 only. Ikkad 0 this year. Yeah, please correct it, sir. From printing error happened here. Well, I should have checked it, but anyway. Yeah, it's all fine now. So guys, write this small question, sir. A small one. This is a CA exam question, but it is a quite old question. This is not part of your book right now, nor part of your study material and all. But a question, if you write, this will help you to understand and retain this concept better. Please copy this question fast. They have given you a AAA rated bond ka yield structure. Yield structure means per period how much return is the bond giving, that they have given. So a 3 months bond if you buy, you will get a return of 8.5%. Of course, that's on per annum basis. 6 months bond if you buy, you will get a return of 9.25. 1 year bond get 10.5. 2 year bond get 11.25. 3 year, 4 year, 5 year and anything above that at 12%. So this is the bond ka yield structure. Sir, you tell me, how will you interpret 11.25%? If you buy the bond with a 2 year maturity, or you hold the bond for a period of 2 years, your return will be 11.25%. That is YTM basically. 2 year bond ka YTM, that is 3 year bond ka YTM, that is 1 year bond ka YTM, like that. That's not first year, second year, third year. 1 year, 2 years, 3 years and above. That's the maturity period. Not time point, maturity period completely. So that is the duration of the bond basically. First question. Using expectation theory. Expectation theory means a long period, short period formula is called as expectation theory. Calculate the implicit 1 year forward rates in year 2 and year 3. Year 2 ka rate, year 3 ka rate he is asking. Why stupid boy is not asking year 1 ka rate? because year 1 ka rate is first year ka YTM only, which is given in the question. How much is that? 10.5%. Second year ka rate question did not give you. They gave you 2 years rate. I want only second year. Similarly, 3 years ka rate is given. I want only third year ka rate. So second year forward, third year forward is a question requirement. First year, it's apparently visible there, 10.5%, so they won't ask you that. That is something which we can easily handle off. Then write the second question also, please. If the interest rate increases by 50 basis points, what is the meaning of that and all? Will make you write. Interest rate increases by 50 basis points. What will be the percentage change in the price of the bond having a maturity of 5 years? What is the percentage change in the price of the bond having a maturity of 5 years? Assuming that the bond is correctly priced now at the moment at rupees 1000. If you have already written, first part you can work out, sir. Second year forward rate, third year forward rate, please calculate. For computing second year forward rate, which data is relevant for you? 2 years yield you want, which is how much? 11.25. 1 year yield you want, which is 10.5. With the help of the second year yield, you can work out. Okay, please work out that. I hope everybody has written the question. I'm just taking it off. If you want later on again, I'll hold it for you. So, answer for additional question. Second year forward rate. So 1 plus 0.1050 into 1 plus forward interest rate is equal to 1 plus 0.1125 whole square. 2 years ka rate to 1 year ka rate. Second year ka rate is balancing period. So forward interest rate is equal to 1.1125 whole square 1.1050 minus 1.12005. You can leave it, it's too much chiller, leave it 12%. Second year forward rate is equal to 12%. Then in the same question, they are also asking you third year forward rate. Third year forward rate if you want, which data you want? First year is not required, sir. Carefully think. I want third year forward rate, only third year. 2 years, not second year. 2 years rate you want, 3 years rate you want. Then a last third year rate will come out. What is 2 years rate given in the question? 11.25%. That's for first 2 years, no? Whole square into 1 plus forward interest rate is equal to 1 plus, what is 3 years rate given? 12%. Slowly solve this and tell me. I'm getting 1.3 0.13515. 0.13515. Check your answer once. This may be right or wrong, I'm not very sure. Check it once. Correct only. Third year forward. These two are easy, sir. Just like the previous examples what we solved, there is nothing new in this. But there is a good question they're asking next. What's the question they're asking is, if the interest rate in the market increases by 50 basis points. Tell me, sir, market if interest rate increases, what will happen up to the investor? Investor ka required return also will go up. What will be the percentage change in the price of the bond, which is having a maturity of 5 years? Okay, there is a bond with a life of 5 years. And now you tell me, a bond is presently giving how much return? Or how will I know, sir? Here hint, look at this. 3 years and above bond is giving a YTM of 12%. That means E bond is also giving presently a YTM of 12%. Presently. But now as an investor, I want more return because market interest rates have increased. He is asking, now definitely bond price will fall down. He is asking what is the percentage fall in the price of the bond. Assuming that the bond is correctly priced at the moment at 1000. Chalo, right, sir, in your notes. A 5-year bond is presently traded at its fair value of rupees 1000, which is also equal to the which is market price, which is also equal to the par value. This is the par value of the bond. It is given that three years or above maturity bond has a YTM of 12% per annum. Bond having YTM of 12%, trading at par indicates that its coupon rate is 12%. Coupon rate is also 12%. Now, interest rates in market increased by 50 basis points, that is 0.5%. Bracket for it, 100 basis points is equal to 1%. Therefore, 50 basis points is equal to 0.5%. Market language. When interest rate increases, therefore, revised required return of investor is equal to 12 presently, plus he also wants more. He won't get, but he will want 12.5%. Since he won't get what he wants, he will sell the bond. When everybody sells the bond, bond price will fall down. He is asking by how much percentage the bond price will fall. What is your work out the revised price of the bond? Revised price of the bond that is equal to, what is the coupon amount? 1000 into 12%. Coupon will not change. Discounting rate will change. Now feeling changes. Redeemable at par only into 1000 into PVIF 12.5% 50 year. So which will be 120 into 3.5606 plus 1000 into 980 2.1. Bond price decreases from 1000 to 982.17. Percentage decrease 1000 minus 982.17 divided by 1000. Discount, no, falling down, no, higher base. Look, a normal simple question, sir. Only thing is, a second bit if you have to solve, you have to pick up the data correctly from the question. Bond is trading at par. That's possible only when the coupon rate and required return are same. Presently, coupon rate RR both are same. RR is yield, which is 12%. Coupon rate is also 12%. But markedly interest rate jumped off. If interest rate jumps off, required return also increases. If required return increases, bond price will fall. A fall ka percentage is asking. Just you have to interpret correctly. Ee samlo what is difficulty is not this part. This bond price is easy. What is difficult is you catching this one. You should know that when the bond is trading at par value, RR and coupon rate are same. And a point you have to know. Then you can get this. And then this is a basic common sense. When interest rates increases, RR required return will increase. Then after story will come up. Coupon rate catch, correct. Very smartly planned question. Question you see coupon rate is not given. It is just bond is trading at par value. That's enough. You can pick up the coupon rate from that. Conclusion, sir. Everything has got a reason. Anyway, coming back to our questions. 40 question is over for us. 41 we can do. Okay, chalo, 41 we'll try. Naveen joined Excel Corporation as a finance trainee. He has given the following details and have been asked to find out the following, which are as follows. Okay, some data they have given and they are asking you to compute something. What data did they give you first? First year bond, 1 year maturity bond has got a YTM of 10%. And 2 years maturity bond has got a YTM of 11. 3 years maturity bond has got a YTM of 12%. They gave you yields of 1 year, 2 year, 3 years maturity bonds. Then, first question, what are the implied 1 year forward rates? Oh, 1 year forward rate means what? First year forward rate is how much? 10%. That's the fact that I need not estimate. Second year I want. That's not 11. Adi 2 years maturity ka YTM adi. What is he asking? Forward rate means only second year ka rate he wants. Similarly, only third year ka rate he wants. Can you work out, sir? Let's start off. The sum what you just now did is a pre-log to this question. In your study material, they gave it as a case study. Last one. Never came in the exam though, but it's part of your study mat. So question number 41. First question, right, sir? Yield for first year is equal to 10%. Now, if you ask me second year yield or second year forward rate, then I need two pieces of information, then I will work out the third one. I will take a 2-year bond, and what I would need is this period ka rate is my missing figure. First year ka return I know, only first year 10%. 2 years ka return also you know 11%. Basic common sense, answer should be 12. First year la 10, 2 years ki 11 at the second year it should be 12 only, roughly a variant of that. Anyway, we'll work out using formula only. 1 plus 0.10 into 1 plus forward rate is equal to 1 plus 0.11 whole square. So forward interest rate is equal to 1.11 whole square divided by 1.10 minus 1. It will be 0.12009. It is second year forward rate. Then we want third year yield or third year forward rate. MCQs, so they are playing with these. Small cute formula, answer will come off. All you have to do is a timeline ka diagrams and all you should be able to spot correctly. And you must understand clearly the difference between 2 years yield and second year yield. Sir, tell me, in this which one do I want now? 2 to 3 I want. So I want this one. So who will become long now? 0 to 3. Who will become short? 0 to 2. 0 to 2 ka rate question lo given now? 11%. 0 to 3 ka rate is 12%. Quote the formula for this please. 1 plus 0.11 whole square to 1 plus forward rate plus 1 into 1 is equal to 1 plus 0.12 whole cube. Square cube divided by 1.11 is equal to minus 1. 0.14027. Third year ka rate. So he asked us first year, second year, third year ka yield sir, and we have worked out that. Sure. Next question please. I hope you all have copied this one. Yes, second question, ma. Carefully read. Assume that pure expectation hypothesis of the term structure is correct. What's the meaning of this is, whatever computations you did, they are holding good. If the market expectations are accurate, at the first year 10, second year 12, third year some 14 you got, that only was prevailing exactly. What will be the pure yield curve? Sir, what is the meaning of that? Read in the brackets. That is, the yield to maturity on 1 year and second year zero coupon bonds next year. Sir, a question ka language should have been more clearer, but what is their intention I will tell you, try to understand. He is asking second 1 year zero coupon bond and 2 year zero coupon bond ka price he is asking and yields. Not today, but after 1 year. Now the point is this, sir. Watch this. B point, yeah. Sir, from the first calculation what we have solved, when you take a 3-year timeline, tell me sir, if first 1 year la, how much return will we get? 10%. Only second year la? No sir, not 11%. Don't make mistakes like that. Only second year how much? 12.009%. Only third year 14.027%. Am I clear here? This is every year return, sir. He is asking, if I buy a zero coupon bond, how much return will I get in this year? How much return will you get? 10%. Here, how much will you get? 12%. Here, how much will you get? 14.027%. But how did he frame that question very complicatedly is, he is making it sound like this. What is the yield on 1 year ZCB zero coupon bond and a 2 year zero coupon bond next year, which means you are standing here, because next year 1 year is over now, you are standing here. From here, 2 year zero coupon bond if you buy, what is the returns you will earn? Immediate year 12%, and next year 14.027%. If you buy a 1 year zero coupon bond, you will get a return of 12%. That's all you have to write. So write. First you write this structure first. Second bit question. At the end of year 1, one year zero coupon bond will give a return of 12.009% per annum. A 2 years zero coupon bond will give a return of 12.009% in first year and 14.027% in next year. You should not forget this line, ma'am. Not forget at the end of year 1. At the end of year 1, 1 year zero coupon bond means which one, sir? Which will mature here. 2 year zero coupon bond means which will mature here. So a 2 year zero coupon bond, first year lo this much return it will give, second year lo this much return it will give. So guys, this time can you work out this one? So 2 year zero coupon bond ka short period and forward period rates you know. Long period can you work out? 2 years ka YTM directly we can work out. No. Tell me how much is that? 1 plus 0.12009 into 1 plus 0.14027 is equal to 1 plus R whole cube, whole square. Slowly sort out this. So 1 plus R square is equal to 1.12009 to 1.14027 equal to 1.277205. So R is equal to square root of 1.277205 minus 1. Final answer is how much? 0.1301 or 13.01%. This is YTM of 2 year zero coupon bond 1 year from today. That's what he asked. Yes, sir. Approximate answers. It won't be simple average. Slightly differences. Your point is taken. In all the sums also we have seen the same thing, no? In every sum we have seen that this plus this average is this answer. You earning 13% here is as good as you are earning 12% in the first year, 14% in the second year. But it won't be accurately matching. Perfect answer you want, this is how you have to solve. That study mat fellow, he spoiled this. He went unnecessarily into too much imagination. You can check the answer if you want. Same answer, eh? Tarika different. He made too much of assumptions there. He imagined a zero coupon bond with a face value of 1000 and he worked out the price of the bond. Again using the price, he worked out YTM. That much drama not required. It is smart work. All you know is one formula. Formula here and there you have to do and get the same answer. What that fellow did is, look at this. He imagined a bond having a face value of 1000, worked out the price of first year zero coupon bond, 2 year zero coupon bond, 3 year zero coupon bond, and then after 1 year again he worked out the prices, and here to here, here to here he mapped and worked out the YTM. A YTM how he calculated he did not even show. See our answer. We clearly know E period low you will get this return, E period low you will get this return. He is asking yield of a 1 year zero coupon bond 1 year from today. 1 year from today means I am standing here. 1 year zero coupon bond means E period. E period ka return. E period ka return don't I know? 12.009%. Answer over. Then he asked me, tell me YTM of 2 year zero coupon bond 1 year from today. 1 year from today now first stand here. 2 year zero coupon bond means which period? From here to here. I know the returns. First year lo I know. I mean 1 to 2 I know. 2 to 3 also I know. I want YTM now. It's like I know short period. I know forward period. I want long period. Work out. That's exactly what that fellow also got. You understand, sir? That fellow did not even explain how he got this. We have our answer. Move on. If an investor purchases a 2 year zero coupon bond now, okay, what is the expected total rate of return over the next year? Sir, if you buy a 2 year zero coupon bond, then how much return will you get? You tell me from this. From this you tell me. You buy a 2 year zero coupon bond today, how much return will you get is what he is asking. In the next 1 year you will get 10%. Next 1 year you will get 12.009%. The question, sir, already we computed that. Cheap question. Next. What if you purchase a 3 year zero coupon bond? What if you buy a 3 year zero coupon bond, then also in the next 1 year you will get the same return. Second year you will get the same return. Third year you will get this return. That means, moral of the story. Earlier I told you one point. Where did I tell you this? This one. You see here. You buy a 1 year maturity bond or you buy a 2 years maturity bond. That's your wish. Whatever bond you buy, in the next 1 year you will earn only 10%. Sir, but second 2 years maturity bond is giving me 12%. No, sir. That means first year lo 10 you will earn, second year lo 14 you will earn, average ga 12 will come. Correct? Like that only he is asking. He is asking, if you buy a 2 year zero coupon bond, next 1 year lo how much return will you make? If you buy a 3-year zero coupon bond, next 1 year how much return will you make? Array sir, you buy any bond, next 1 year ka return will be same. A point you have to write. Please write. Third question. Whether we buy a 2 years ZCB today or a 3 years ZCB today, the return, rather yield, in next year, that is first year, would be, how much was it? 10%, 10% per annum only. The concepts are that concept ka direct question is asking. You know how he solved? Look at the answer. What that fellow solved is, he imagined a hypothetical bond which is having a face value of 1000 on maturity. He discounted that, worked out first year ka means 1 year bond ka price, 2 year bond ka price, 3 year bond ka price. After 1 year again worked out the bond prices and he compared it, and he tells me that second 2 year bond will give you a return of 10%, 3 year bond also will give you a return of 10%. For that, why to compute? Why do you need bond price? The concept of it. Buy any bond, next 1 year return will not change, it will be 10% only. You buy 1 year maturity bond, you buy 2 years maturity bond, you buy 3 years maturity bond, in the next 1 year you will get only 10%. That's the concept. Correct? No? If you know that, why to imagine a hypothetical bond and solve? I don't need to do that. That stupid did, he does not know. Continue. What should be the current price of a 3-year maturity bond? Okay, 3 years maturity bond ka market price is asking now. With a 12% coupon rate paid annually. Okay, fine. He's simply asking you bond price, coupon rate they gave. Okay, discounting rate I know. How do you know? Top paragraph you see, dabbalo. 3-year maturity bond ka YTM is how much? 12%. Simply you discount bond cash flow, 12%, answer is ready. But you know what? That fellow did not give you par value of the bond. If you do not give me par value of the bond, how will you work out coupon amount? You will assume something. You have to assume either 100 or 1000 or 10,000 or whatever you want to assume. But concept. What is the coupon rate? What is the discounting rate? Answer will be, do you understand why I made you write one question and solve? Our question is inspiration for this question. 5-year bond, 12% coupon rate. Our question is the inspiration for this question. Do you understand, sir? I do not know what is the face value, but I know the price of the bond will be par value is equal to face value. Are you understanding, sir? Basic concepts. How strong you are in time value of money, that much easy these things will become. Chalo, right, sir? Not only that, Bhagat is asking one more question. If you purchased it at the price, up par value if you buy, what will be your total expected return over the next 1 year? Haha. Sir, just because you buy a 3-year bond, which is giving a YTM of 12%, does it mean that first year 12, second year 12, third year 12 return you will get? No. What is your return structure? First year 10, second year 12.009, third year 14.02. This is kept as a case study in your study method. And a stupid answer he wrote, assuming some price of the bond and all, not required. You can just play with the formula like this. Understanding. Chalo. Third bit, fourth bit answer. To compute price of a bond, with 3 years maturity or 5 years, 3 years maturity, and a coupon of 12% per annum, we have to discount bond cash flows with YTM of 3 years bond, that is at the rate of 12%. Now conclusion, since coupon rate is equal to YTM is equal to 12%, the bond rate set par value. I do not know what is that par value. Question did not give. Why should I assume and work out? 1000 you assume, answer will be 1000. 10,000 you assume, answer will be 10,000. Why should I work out? Sir, he asked price, no sir. Then he should have given me face value. Answer is par value. You assume any par value, answer is right only. Then he is asking, though this bond gives a overall YTM of 12% per annum, in the next 1 year, yield would be how much? 10%. In the second year, he did not ask this, I am only writing again. Yield would be some number you computed, no? 12.009%. In the third year, yield would be 14.027%. On an average means it's not simple return, compounded effect. On an overall average overall yield is 12%. That's all, sir. That is the end of your forward interest rate applications. Heavy, huh? It is heavy. I can feel it. No, it's heavy. You can't help it. Studying professional course, things will be like this only. Quite unfortunately. Well. There is one more, the cheap question that you will handle now only in front of me. Keeps copied these others. I am making you write this because that fellow unnecessarily spoiled their answer. Study mat answer. But that fellow unnecessarily went into imagination. That much hallucination not required. Simple shortcut, you can handle it. Same answers will come. You see, 10%. Okay, chalo. Next, come to 42nd question. This is a normal YTM, sir. It's not based on forward interest rates. Please read. A financial institution issues two type of bonds with 1 year and another 3 years maturity. Okay, got 1 year bond, another one is 3 year bond. The first bond pays 10,000 a year hence, and it is now selling for 8929. The first bond ka future cash flow is only 10,000 rupees, nothing else. So looks like it's a zero coupon bond because directly maturity value is there, coupon not there. The second bond, under 3 year maturity bond, which pays rupees 100 next year, rupees 100 after 2 years, and rupees 1100 at the end of third year, which means what? First year 100, second year 100, third year 100 plus 1000. Proper coupon paying bond, annual coupon, is now being offered at 997.18. Means what did they give you? They gave you coupon rate, they gave you maturity value, they give you price of the bond also. What is he asking? Find out the implied rates of these two bonds. Please underline this, ma. This is nothing but YTM. You have to calculate YTM of the bonds. YTM how to compute? IRR model you work out, it's easy. So let's start. 42nd one. YTM of 1 year bond. The 1 year bond ka present price is how much? Oh, price of the bond. Good. Maturity value is 10,000. This is 8929. How cheap, sir? He is asking e-return. Can you work out this? How? Don't tell me calculator. Formula. Or logic, anything. I want R. How will you get? Present value, future value formula if you apply, answer will come. Or single point inflow, single point outflow, a formula also you apply. Square root of or nth root of inflow divided by outflow minus 1. Any which way you do, answer will be same. Chalo sir, do it. So R is equal to inflow 10,000 by 8929 whole power, not whole power. Nth root is whole power only, whole power 1 by 1 minus 1. You do not like this formula, leave it. Future value is equal to present value into 1 plus R. 0.8929 12%. Nothing is a whole power 1 by 1 only. It's like that. 0.12 or 12%. This is YTM of 1 year bond. Why to do this much difficulty, sir? We'll do like this. 10,000 minus 8929 divided by 8929 into 100. This also will give you same answer. Kani, it is simple letter. Then why is it matching? Because the 1 year bond, simple and compounded will give you same answer. If I write that answer, no sir, you try to do that in 2 year bond also. That's why I'm not writing that answer. That looks simple, but that will give you confusion. And it coincidentally matches because of the 1 year bond. Reinvestment ki time may not there. So like that. Next. He is asking you YTM of a 3 years bond. What are all the cash flows given? First year, second year, third year. First year 100. Second year also 100. Third year 1100. Price of the bond today, that fellow tells you 997.18. He is asking what is a YTM, which means what, sir? What discounting rate you will use in order to discount all these cash flows equal to 997.18. This will become your YTM. Sir, do you need to work out trial and error, sir? Of course you have to do that, but you are smart. What will you do? Approximate YTM formula you throw. Second one, that will be almost matching to the actual YTM and leave it there. What is the approximate YTM formula? Coupon amount. Coupon amount is how much here? 100 plus maturity value, which is how much? 1000. Don't take 1100. 100 plus 1000. That much common sense you should apply. Minus 997.18. Life 3 years divided by 0.6 into 997.18 plus 0.4 into 1000. Of course, outside into 100. Start out. $10.11. That's it, sir. This is your answer. Sir, when single point inflow, single point outflow is there, answer directly you can work out present value, future value model. But with the multiple inflows, shortcut is not there. You have to go with approximative YTM formula. Sir, is the correct answer? It's nearly correct answer, not accurate answer. I want accurate answer. Then what will you do? Do trial and error. Start with 10.11%. Pakka fail auto, sir. Then try with 10.5%. Again you will fail on the opposite side. Sit and interpolate. Correct answer will come somewhere. That's the original method. I'm not doing that. That's not worth it, sir. Exam also not record unless they ask you. Our boy, how he solved? Excel sheet lo solve chestadu. He will not show all this inside. Final answer only outside he wrote. How will you solve that, sir? On paper it's impossible to solve. You have to write some formula, no, some trial, something you have to do. No, stupid did not show anything. Directly answer he wrote. But we have to solve if it comes in the exam. We cannot remember and go. Chalo, sir. With that we are done with our forward interest rates concept. Okay. Now the last aspect is money market instruments, sir. Now if you check money market instruments, in our book, where is it written? Come here. Sir, money market instruments ka meaning is short-term instruments, short-term debt instruments whose maturity period does not exceed 1 year also. That means borrowings are made by the entity for a period less than 1 year, less than 12 months. These kind of instruments are called as money market. The term money market means a short term, sir. Remember that. Sir, in money market instruments, what kind of papers, what kind of instruments are traded? Let's see one by one. First one is called as commercial paper. Commercial paper is a debt instrument which is issued by a highly rated corporate company. A company with a top class credit rating, a AAA rated company can issue a commercial paper. When you are supposed to issue commercial paper, RBI you have to submit all this. And RBI, if it is satisfied that okay, you are very credit worthy, you are very respected, secured, reputed, then only RBI will give you permission to issue commercial paper. A commercial paper ka maturity period can be anything from 7 days to 364 days. Or sometimes 365 also they will give in the questions, but broadly it is not supposed to cross or equal to 12 months basically. So 7 days to 364 days. So this is called as commercial paper. Just have to remember one small point, that it is issued by highly rated company, normal companies. Next come treasury bill. I already told you in some context. Treasury bill is issued by Reserve Bank of India on behalf of Government of India. Okay, so this maturity also will be around 91 days to 364 days. Next, call money, notice money. So tell me, in your Enter Anywhere, did you do banking company ka accounting? You did banking company. Now call money, notice money ka meaning is, sir, this one bank to another bank ka borrowing. For example, opposite road lo there is a Kotak Bank. I am premium customer of Kotak Bank, sir. I have a dedicated relationship manager and all. So wherever I want money, nearest Kotak Bank ni I'll get. Now, the opposite road, whatever Kotak Bank is there, that's a very small branch. In and around small shops, whatever are there, they are maintaining their money there immediately. Now, I happen to come here and I'm going to stay here, let's say for a period of 2 weeks. Suddenly, I needed an amount of 1 crore. My account lo money is there. If I go to that bank, ATM I can't draw 1 crore, ATM lo not possible, I have to go to the bank. I cross the road. I tell the bank that bank, my customer relationship number is this. I want to withdraw my money 1 crore. Our bank will not have 1 crore with them. But that is my money and I'm premium customer. If I ask money, they are supposed to give me. They don't have. Can they say, I don't have money, please withdraw in parts, take 25,000 in ATM like that? No. What they will do? They will immediately borrow money from the nearest bank. A corner SBI main branch is there. We call SBI manager. Sir, I am Kotak, opposite side of your road only. I want 1 crore immediately. when will you repay? Before tonight evening we'll pay. If within one day we'll pay off. So immediately SBI fellow lends money to Kotak guy. Kotak fellow will give me my money. I will withdraw my money. And Kotak, from the Kotak head office, money will be transferred back to SBI. The process of time gap is there. On the time gap, interest is charged. A 1 day ki interest. That is called as call money. Call money ka meaning is it has a duration of 1 day. Sir, what is notice money then? Notice money is also similar, sir. Only thing is if the period of borrowing is not 1 day, but it is more than 1 day, up to 14-15 days. That is called as notice money. Since I told you example of Kotak. Kotak company, Kotak bank is an Indian bank only. So their head office fellow will easily transfer money to SBI within a span of 1 day. That's not a problem. But imagine, I'm trying to withdraw money not from Kotak, but from something like Dutch bank. A Dutch bank ka main premises 1 crore money is not there because nobody transacts with them. A foreign bank. Or I'm withdrawing money from something like a Standard Chartered bank, international bank, global bank. But multiple branches and all are not there. Suddenly I want 1 crore means from where will they get? They borrow from SBI and they pay me. So how will they repay SBI? They have to get approval from their head office in New York. From there approval should come and then they will release a payment. E period will take more than 1 day. Then it becomes notice money. Call money duration is 1 day. Anything beyond 1 day is called as notice money. Right? Finally, certificate of deposit. Certificate of deposit is something similar to normal fixed deposits, sir. Normal FD, what do? We invest money and on that money compounded interest will keep on coming for a period of 3 years or 5 years or whatever period of investment. It is also same thing. Only thing is your fixed deposit you cannot transfer it to somebody, but certificate of deposit you can transfer it to somebody. That means you can sell your certificate of deposit. You can tell somebody that, see, I made a deposit there. Our deposit will give you 1,33,000 rupees after 4 years. Today, paper I am selling it to you, give me money. Whoever gets that paper to the bank after 3 years, that fellow will get the money. So it's like a zero coupon bond, sir, indirectly. Future money is already decided. Today trading can happen among investors. That's certificate of deposit. Most important point is this one. All the above money market instruments are issued at discount and redeemed at par. What does it mean? Let it be commercial paper, let it be T-bill, let it be certificate of deposit. All these are issued at discount, redeemed at par. A gap, whatever is there, are the interest. So if you ask me, sir, what is the price? What is the issue price of commercial paper? Big deal. Tell me what is the price of zero coupon bond? Maturity value ka present value. Like that only commercial paper, T-bill, certificate of deposit, for everything same answer. Take the maturity value, discount it to today. That's all. Sir, how many days after discount? Gap. 91 days, 364 days, 50 days, 60 days, depending on that. That's all. That simple it is. Then there is the small concept called as repo and reverse repo that we will see after doing some small cheap questions. Come here. Money market instruments, where are you? Trading. Not you. 28. Who told 40? Oh, question number. Nice. Please read, ma. RBI sold a 91-day treasury bill, face value 100, yield of 6%. He is asking what is the issue price. Don't see the answer there, are stupid answers. Institute answers are bad, sir. First presentation, if something is there, that is that only. You apply your mind. Treasury bill is like a zero coupon bond only. Issued at discount, redeemed at par. What is the maturity value? 100. Face value. Redeemed at par means maturity value is 100. What is the yield rate given? 6%. Issue price will be nothing but present value of 100. Simply do that. Don't see all that formulas and ugly formulas. As less, that much better it is. Chalo. 43. Draw a small timeline, sir, as usual. Our favorite concept timeline. 91 days. 100 is the maturity value. What you have to do, you have to take this and discount it to today, that's all. This will become your issue price. What is the yield rate given? 6% per annum. Sir, a question lo they won't tell you per annum money. Yield, interest rates, all these are always expressed only on per annum. So chalo discount it. Sir, how will I discount it? Arey sir, discounting formula sir, single period cash flow 100 divided by fair future value divided by 1 plus PIR. What is the interest rate? 0.06. Tell me sir, my cash inflow is how many days for? 91 days for. But the 6% is for 365 days. So you have to do into 91 divided by 360. 91 days ke interest rate I want. Don't do 3 by 12. Approximately same answer will come. Don't do. Question gives you days, you have to do it in days. How will you solve denominator? 0.06 into 91 divided by 365 plus 1 divided by equal to into 100. 98.5261. You got a different answer? Huh? Oh, if you get different answer, let me know. 98.53, same answer I got, no? Why did you get different answer? Same answer you got, huh? Nice calculator then. So, now, did you calculate this in one shot or two steps? Huh? One shot, over. Take your calci now. This one shot, how to solve? Write on your calculator 0.06 into 91 divided by 365. How much are you having? 0.01495 plus 1 is equal to, wait there. You are having how much? 1.0149. This is in the denominator. Divided by equal to you do. If you do divided by equal to, the number that is there in the denominator will jump into numerator. Already numerator, who is waiting for you? 100 is waiting. Multiply with that 100. 98.526. Divided by equal to is a powerful technique, sir. That coupled with M plus MRC, within seconds, you need not even write anything. Very hardly you have to write something. The practice వచ్చేస్తుంది. Directly first line formula, second line answer directly. But anyway, sir, what is the formula they wrote? Don't bother about it. Sir, you tell me, is it one period or multiple periods? One period. So I can do simple return also, no? Simple return formula is what? Future inflow minus initial investment divided by initial investment into 100 is equal to 6%. Solve X. Means I initial investment you have to solve. That also you can do. Try to remember formula to the extent possible. We will try to avoid it. So leave it. Next, come here. Z Limited issued commercial paper worth 10 crores as per the following details. Date of issue 16th January 2019. Date of maturity 17th April 2019. Number of days. You are very lucky that fellow gave you a number of days. Otherwise you have to calculate. Interest rate 12.04%. What was the net amount received by the company on issue of CP? Again same question. Previous sum lo T-bill is sum lo commercial paper. Both are discount instruments. Both the cases, so that fellow is asking you what? Issue price. Issue price is nothing but present value only. Discount it. Finish it off please. $91 days. What is the maturity amount? 10 crores. Don't open zeros and waste your time. Keep it like this only. I want the issue price. So all I have to do is drag it here. So which will be 10 crores divided by 1 plus, what is the interest rate they are giving me in this? 12.04, 1.1204. Idi per annum ki. Our CB is having a life of 91 days, proportionate rate. 0.1204 into 91 divided by 365 plus 1 divided by equal to 10. So that will give you 9.70857. So many decimals, why are you writing? Are the crores? That's a little bigger decimal root. Formulas unnecessarily don't touch. This is the repo reverse repo model. This we will see. Okay. Last case, sir. With that, story is over. The chapter gets over. Listen. Repo and reverse repo. First of all, repo ane word ka meaning is repurchase. The word repo means repurchase. Whatever I sold now, I will again buy it back from you. That is called as repurchase. Now, sir, in borrowing, money market, what is selling, buying, sir? What are you talking? Look at this. I am bank A. Other side is bank B. Okay. Now, if bank A is in need of money. So if this fellow is in need of money, he has to borrow money. Now, who is lending money to bank A is, in our story, bank B. So, lends, or let's say borrows amount. Borrows amount from B. Now, sir, now that I borrowed amount, I have to repay the amount also. Now, before I repay along with interest and all, one small point I am asking. Sir, when you borrow money from somebody, that somebody is taking risk by giving money to you, what will he ask? Give me some security, the land document or something. Sir, a bank will not have land, buildings and all which will be given as security. So what usually will happen is, bank A borrows amount and bank A will transfer some of their investments as security. Investments of bank A are given to bank B. Now, in future, what will happen is, a bank A fellow will repay the loan to bank B. Sir, when you repay the loan, what will happen to the investments? Whatever investment your investment which you gave to bank B as a security, investments again will come back to you, no? So this time arrow will be from bank B to bank A. Investments released. Carefully watch. First step, what happened? I borrowed money. I am bank A, okay? I borrowed money. I gave my security investment to you as a security. After some 6 months, what happened? I repaid the loan to you along with interest. Whatever investments I gave it to you as security, that amount you have given it back to me. Correct? No, sir? This is a normal, ordinary lending transaction. In this, what is very great, what is very difficult? Nothing. But I will make it sound posh now. How? Instead of calling it as borrowing and repayment, I will call it as sale and repurchase. What am I selling? investments I sold for some amount. In future, what did I do? I again repurchase the investments by paying you some amount. So there is a sale price, there is a repurchase price. A normal borrowing lending, but I will do overaction by calling it as a repo transaction. Repo means repurchase. Repurchase, if you are doing means first of all you sold. It is the sale and repurchase. Sir, why did you sell and why did you buy, sir? Because that is fake. There is no sale, there is no buy, it's a loan transaction. So I took loan, given something as security, I repaid the loan, my security came back to me. Sir, then you can call it as security. No, sir, why are you calling it as sale? Sir, if I pledge something, tomorrow if I default it, that fellow has to file a case on me for getting the ownership of the secured asset. Other if I sell it off to him, tomorrow if I don't pay, he said don't pay, no problem, I'll sell off the investment because he became the owner now. Do you understand, sir? There is a difference between, so for example, I borrow 50,000 rupees from you. I told you that, you go, mobile phone I'm giving as a security. You said okay. Tomorrow I did default. What can you do? You have to first file a case on me. Sir, he put this mobile phone as security. He did not pay me that. Please order him to give this possession to me so that I can sell it and cover my money. And you have to file a case on me. And the legal hassle unnecessarily. Other if I structure this as a sale and repurchase, what will happen? I sold it to you. You paid me money. Repurchase also we wrote another contract. Tomorrow, if I don't repay money to you, what will you do? You will sell off. You need not file case on me because you are prima facie the owner of the asset. Are you understanding, sir? What can be directly structured as a loan agreement with a security is now structured as a sale and repurchase agreement. This becomes very favorable to the lender. He becomes more secured in this. That's the logic here. Am I clear till here? Next. Come here. Based on this, one or two small applications are there. Come to 46th one. Slowly read, sir. Bank X enters into a repo for 9 days. See, repo for 9 days means your borrowing period is how much? Just 9 days, say. With Bank Y. In 6% government bonds 2022. Please underline this. Or box it, call it as investments. If I have to borrow money, I have to give you some investment, no? Our investment is government bond for an amount of 2 crores. Okay. First leg proceeds is 200 lakhs 6,750. First leg proceed means, come to our diagram. First leg means which one? A top one, blue color one. I am borrowing 2 lakhs 6,750. That's the first leg. Then what is he saying? Second leg repayment amount is 2 lakhs 31,759. So how much I am borrowing? 200 lakhs something. What am I paying? 200 lakhs 31,000. Gap is what? Interest only, no? Next. Then initial margin is 1.25%. Sir, what is the meaning of margin? You tell me, sir. I want to borrow, sorry, let's say I am giving an asset to your security. Our asset worth is 100. How much amount will you lend me? 100 or something less than that? Something less than that. You want to keep your own safety? No, sir. 100 valuations are hardly correct. So if I give you an asset worth 1 lakh rupees, you won't lend me 1 lakh. You will lend me something around 70,000 or 80,000 because interest also you have to cover. No. So our margin is 1.25%. And days of accrued interest is 240 days. Ante ee bonds whatever is there on this bond 240 days ka interest is also accrued. So apart from the face value there is some accrued interest also. So apart from the bond price there is accrued interest also. Assuming 360 days a year, calculate number 1 repo rate. Repo rate is nothing but interest rate. Repo rate is nothing but the interest rate. Sir, how to compute interest rate, sir? What nonsense? You borrowed this much, you are repaying this much. The extra amount, whatever you are paying, are the interest. For how many days? 9 days. Convert that into percentage terms. That's all over. Okay, start, sir. Question number 46. What is the bank name given? Bank X, Bank Y. Okay. Write it quickly. Draw a diagram. Bank X. First leg. Received how much, sir? 200 lakhs. 6,000 now. 1,050. Second leg. How much are you repaying? Rupees 200 lakhs. 31,759. Of course, that side joker is Bank Y. Apart from this, what are they transacting? They're also transacting investment. I gave my investment and in future I will receive my investment. This will happen after how many days? 9 days. He is asking repo rate. So 200 lakhs, 6,750 I borrowed. On that interest I have to pay. Overall I have to pay 200 lakhs, 31,759. Future value, present value formula, nothing else. PIR is equal to 200 lakhs, 31,759 divided by 200 lakhs, 6,750 minus 1 is equal to 0.00125. 0.00125 is your PIR, or multiply with 100, you'll get 0.125%. Annualized interest rate is equal to 0.125% is for 9 days. He asked you to assume how many days in a year, ma? 360 days. So don't multiply with 365, huh? 360 days to multiply. Round number will come. That's why he asked like that. .125 divided by 9 into 360. 4.9999999 is observe, lot of story drama is there. Ultimately, what are you computing? Interest rate, YTM type you compute it. Single period cash flow. Directly you compute it. A background story is a flavor. Matter is still the same. You are not learning any computation extra. Story you are learning extra. Chalo, move on. Next question. He is asking, compute something called as dirty price of the bond. Okay. So dirty price means what? Bro. Okay. Something, sir. Listen carefully. Dirty price, clean price ka meaning is, sir, do you know the concept of accrued interest? Accrued interest ka concept is like this. It's an accounting concept, sir, very easy one. Suppose there is a bond which pays interest on 30th June and on 31st December semi-annually. These are the interest due dates. Okay. Now, if you buy the bond on this date, on 1st of July, and hold the bond for 6 months, how many months interest rate you will get? How many months interest you will get? 6 months interest. Do you know that even if you buy the bond on 1st of October, November, December, you hold the bond for a period of 3 months. You know how many months interest you will get? 6 months interest you will get. A company will not keep a track of which bond holder is holding for how many days and all. Whoever is holding, that fellow will get full 6 months ka interest. But this fellow held the bond only for a period of 3 months. But he will get how many months interest here? 6 months interest. Is he gaining or losing there? Gaining extra by how many months? 3 months. Then who is losing? What company, sir? Company, it doesn't matter. Company anyway has to pay to somebody. The other person who sold bond to this fellow, he already held the bond for 3 months and he sold off to this fellow. and this fellow will nicely eat the interest of 6 months. The other fellow is losing. No, nobody is stupid like that. He is no fool. What will he do? Adding interest of this 3 months only, he will sell it. So in the price of the bond, what he paid for the bond price also, 3 months interest also. Ultimately from the company he will receive 6 months interest. Are you understand? So this price, whatever you pay here, price of bond between two interest due dates includes accrued interest from the last due date. This only in accounting we call it as come interest price. Have you heard about this wording? Come interest, X interest. Come interest means cumulative of interest. X interest means excluding interest. That is come interest price. Come interest price, what will be there? Price of the bond will be there. Plus also it includes what? Interest accrued. This come interest price ne we call as dirty price. Come interest price ne we call it as a dirty price of the bond. Why are we calling it as dirty price of the bond? It does not represent bond value. Bond value plus accrued interest also. That's not the real worth of the bond. Then tell me, what is the clean price? From the dirty price of the bond, if you remove the interest and take come interest price, if it becomes X interest price, that is called as clean price of the bond. Clear, sir? Concept book, everything is written. What is dirty price? What is clean price? Anyway, here in the question currently he is asking, tell me what is the dirty price. So first of all, if I have to tell you dirty price, there should be a bond, no? Which bond is there here? Some government of security bond which you have sold it, no? A bond ka value is asking, dirty price. Now, sir, how will I know that bond ka value? Look at this carefully. First, how much did you borrow? 200 lakhs, some chiller you borrowed. He told you that initial margin is 1.25%. That means if the total worth of the bond what you gave as security is 100 rupees minus 1.25, 98.75% of your original bond value is given to you as borrowing. So 98.75 is representing your 200 lakhs 6,750. What is the worth of the bond given? That is your market price, worth of the bond basically. Let's work out. Chalo sir, second bit. Amount borrowed by giving bonds as security after deducting a margin of, how much margin? 1.75 or 25? 25% is equal to rupees 200 lakh 6,750. Therefore, market value of bonds given is equal to 200 lakh 6,750. It is after deducting 1.25. So this is representing how much? 98.75. The worth of the bonds delivered is 200,06750 divided by 98.75. 202 lakhs 3,000. The market value of the bonds. That's what he also got. Number of bonds given as security. Number of bonds given as security is somewhere he is giving here 6% government bonds for an amount of 2 crores. Here only you write, sir, the face value of the bonds. Question on rate. A 2 crores is face value of the bond. So you basically gave 2 lakh bonds. 2 lakh bonds you have given as security. Therefore, market price per bond is equal to 202 lakhs 60,000 divided by 2 lakh bonds. $101.30. The price of the bond, sir. This is dirty price of the bond. This bond includes how many days accrued interest? 240 days. The accrued interest for 240 days. Last question that boy is asking you, clean price of the bond. Clean price into X interest price. So this question is a very popular question in CA final, and these concepts are part of CMA final also, just that the question did not come yet. If it comes no sir, then it keeps on coming again in loop. They'll ask every 2-3 exams once they'll repeat, but first time if you directly see in the exam you can't handle this. You have to know the story in the background, so then it's very easy. There's nothing much in that. Clean price of the bond is equal to dirty price of the bond minus accrued interest. Dirty price is common interest price 101.30 minus accrued interest 100 rupees. What is the bond ka coupon rate given? See first line low 6%, 6% into 240 divided by 360 days. That will become 97.30. Just one small point you read, a clean price, a dirty price, whatever is there, no, this is called as, this is actually nothing but overaction done for common interest price. This is clean price is nothing but X interest price. Of course, this I already wrote here. That's all, sir. This is the end of your bonds. Well, before this, one more question is there, that is homework. The same story with a different requirement. Before this, same another question is there, that's homework. Requirement is different. This time, repo is for 14 days. Clean price question only given. What is he asking? Dirty price is asking. Or what you have to do? Clean price, you know, you want dirty price. What do you have to do? Add accrued interest. For how many days here? 262 days you have to add. It's easy. Then he is asking repayment amount. Repayment amount, how to work out? First, starting amount you have to work out. A starting amount you have to pay interest for a period of how many days? 14 days. Interest rate is this one. That's simple. Same data, sir. Is the requirement different or the requirement different? Solve. If you solve, you will get it. That's all, sir. With that, you are done with your bonds. Next, we have to hit shares, that will be in the next class. See you tomorrow, sir. Thank you so much.